All right, good morning, everybody. Welcome to Yahoo Finance Live, 9 o'clock here in New York on this Friday morning. Miles Udland here, along with Brian Sozzi. Julie Hyman is out on assignment today. Let's take a look at where futures are trading right now as we head towards the week's final opening bell. Mixed open. We are set for, once again, the Dow and the S&P right now are in the red. Nasdaq futures are in the green. Last night, surprisingly, U.S. Treasury Secretary Steven Mnuchin appearing to pull the plug on several pandemic lending programs, clashing with Fed Chair Jay Powell as the U.S. economy continues its recovery from the pandemic. We're going to get into all that in just a bit. And Pfizer and BioNTech set to apply for emergency use authorization from the FDA today for their coronavirus vaccine. Cases continuing to surge here in the U.S. Let's begin with the COVID situation. Anjali Kemlani joins us now with the latest on this news out of Pfizer and BioNTech. Anjali, certainly encouraging, certainly expected to some extent after what we heard from the companies recently, and this coming as we are likely set to hit another daily record in the number of COVID cases.
That's right, Miles. Unfortunately, with the ongoing pandemic, this is even more crucial than ever. And of course, the companies do know that. Pfizer and BioNTech first out the door with an emergency use authorization filing this morning, just 2 days after they told us that their vaccine proved 95% efficacious. And of course, I'm following Dr. Fauci's advice and making sure that I say efficacious instead of effective, because as we know, while the results are still due, by the way, from the companies, we do not have a look at that data just yet. The efficacy number is a little bit different from what will actually be effective out in the real world. And that is yet another thing to watch in the future. Of course, Pfizer and BioNTech right now, their vaccine is the one that requires that ultra cold chain supply, which Operation Warp Speed has been addressing and paid attention to with the distribution of these ultra storage freezers, ultra cold storage freezers throughout the country. So as it stands right now, states are looking to possibly be ready to accept a vaccine starting mid-December. And we know that the Vaccine Advisory Committee is set to meet next month. So we will see how it all plays out. So we've heard Operation Warp Speed say that within 24 hours of an approval or authorization, they will be ready to ship those vaccines out. So all of this happening within the next few weeks, and all eyes on that right now, Miles.
And this, of course, Anjali, we're trying to square the two realities of the pandemic right now, because we have all this positive news on the vaccine front. It does appear that vaccines will be in the arms of Americans by the end of 2020. But at the same time, we see more states increasing their restrictions as a very nervous holiday period quickly approaches.
That's correct. We're seeing additional states look at restrictions. We know California is looking at more curfew. And so this is really the strategy that has unfortunately been taking place in lieu of a full national strategy. So each state or each municipality in some cases is taking on either mask mandates or curfews or stricter restrictions. We knew New York City just sent schools into full remote with the anticipation that we're going to hear something about further with the indoor dining with gyms. We know that also in Illinois, there's been a hint about that happening, with Chicago taking the lead in that. So around the country, this has been sort of the crucial center for any of the strategies to unfold. We have concerning states like South Dakota and Wyoming marking very high positivity rates, but no really strict measures coming down from there, and some criticism from health experts on that.
Anjali, before we came to air, you made really a great point. Essentially, we have two small biotech companies really in a race to save the world.
That's correct. As it stands right now, while Pfizer is getting sort of the name credit and mention as a longstanding vaccine company, looking at the two actual companies that came up with the technology, Moderna as well as BioNTech, are the two small biotechs that started this. And so when we look at what this has done, really there's a lot of conversation happening right now about, number one, two small biotechs saving the world, two, the validation of the platform that has never come to market before. mRNA has never been on the market, but it's been in production for the last several years, I think a decade now. And so looking at it from that perspective, it's very interesting that in a compressed timeline, the traditional sort of companies that you would expect, especially vaccine makers, are sort of slower in the race than these smaller companies.
All right, Anjali Kamlani with the latest on the coronavirus outbreak. Anjali, we'll talk to you in the next hour. Well, yesterday afternoon, some surprising news for investors that the market initially did not like, but has since sort of digested and perhaps shaken off or understood more deeply. And that was a surprising decision by the Treasury to shut down several of the Fed's emergency lending facilities. The Fed, in a letter saying they disagreed with that decision. Brian Chung joins us now with all of the details. Brian, you are on the Fed beat, so I would just start by saying, were you surprised to see this exchange between the two organizations? And as you've had some time to think about it, how is it best understood by investors just exactly what is happening and why?
Absolutely. So when a lot of people hear liquidity facilities, they might not know what we're talking about. So to back up, the Federal Reserve and the Treasury were appropriated $454 billion in the CARES Act back in March to team up together and provide some backstops to financial markets, which, as many recall, during that time were in a lot of turmoil because of the COVID-19 pandemic picking up here in the United States. Now, the question is whether or not they should be extending those financial market backstops past December 31st, because as designed, the Federal Reserve and the Treasury were going to allow a lot of those liquidity facilities to expire. So the Treasury Secretary sending a letter to Fed Chairman Jay Powell yesterday saying it's time to close them down. Not only is it time to close 9 of these 13 liquidity facilities down, but it's also time to return the unused money. So the Treasury, again, saying their stance is to close these things down, but the Federal Reserve clapping back with their own statement, saying on their part that the Federal Reserve, quote, would prefer that the full suite of emergency facilities established during this pandemic continue to serve their important role as a backstop for their still strained and vulnerable economy. And while many may not see why that statement would be such a big deal, I can tell you from personal firsthand that this is as close as you'll get to the Federal Reserve essentially arguing in the public sphere with the body that they've essentially been teaming up with together for the last 8 months. It's really been a breakdown between these two bodies that have tried to engineer a pandemic response from the U.S. government side of things, now falling apart with the disagreement over whether or not to extend these facilities. So a lot worth watching. It looks like Steven Mnuchin is speaking on CNBC right now, some headlines crossing saying that he thinks that, quote, people are missing the issue and criticizing the decision on the Fed, likely referring to the optics of trying to shut down these emergency backstops right before a new administration takes place next year in January. But a lot worth watching as the coronavirus cases do hit new record highs this week.
Brian, let's stay on that new administration topic. What does this mean that these facilities, all right, so they were to expire, the Fed gives that money back. What does that mean to President-elect Biden and his team?
Yeah, so let's back up. I mean, there are a number of liquidity facilities. They are each designed to target different things. We had that full screen that we showed you of the different types of facilities that exist. So the Treasury is telling the Federal Reserve to close down specifically those that target the corporate bond markets, what they call the primary, secondary market corporate credit facilities, in addition to that landmark program that's gotten a lot of attention, the Main Street Lending Program, which is targeting small to medium-sized businesses, in addition to help to state and local governments through the Municipal Liquidity Facility. Now, as we know, it's those small businesses, in addition to state and local governments, that have been hurt the most. So these are the types of businesses and entities that the Biden administration will really need to help once they do come into office in January. Obviously, all that chatter about a fiscal package leaning heavily on whether or not the Senate can flip blue based on the results of those Georgia runoff elections, which we won't know until early January. But it does seem like the Biden administration will have its work cut out for them, especially if those Fed backstops are not available after December 31st.
Hey, Brian, I know you follow the Fed's balance sheet as well. Finally crept up to a record high as of the prior week. I'm just wondering, the Fed has always said that they stand committed to deploy additional resources. Does any of this change the Fed and the Treasury's cooperation potential over the next month? How do you see this playing out? And is it just really an optics hiccup that'll be forgotten about in an hour or so?
Well, this is a good point that you bring up. I mean, it seems like markets have gotten over the speed bump already, but what is definitely true is that the uptake of the Fed's facilities have been remarkably low since they opened them in the beginning of this pandemic. Now, of course, the argument is that the uptake is low because borrowers have been able to find cheaper credit in the private market, and that's because the Fed backstops exist. So it's a little bit of a chicken or the egg argument when it comes to the effectiveness of these facilities. But when we talk about forward looking, what's going to be useful as these markets kind of continue to look for help, especially with these coronavirus cases surging, who's to say that we won't get back into a tizzy in financial markets again, which is, I think, the Fed's argument for saying this is why we need to keep these facilities open. So when it comes to the cooperation between the Treasury and the Fed, another interesting moving part that's worth watching is that the the Treasury Secretary will be a different person once the Biden administration takes office in January. So when that does happen, that could reopen the door for Chairman Powell, who will still be in this seat through the remainder of 2021 because his term expires in 2022. So that avenue could be open. But again, the question is not what's going to happen in January. The question is, can we make it to January without any sort of issues in the financial markets in the meantime?
All right, well, let's stay on this topic. Brian Chung, you're going to stick around. We're joined now by Randy Krosner. He's the Deputy Dean for Executive Programs at the Chicago Booth School of Business. He is also a former member of the Fed's Board of Governors. Randy, thanks so much for joining us this morning. I'd love to get your thoughts on what we saw from Treasury and from the Fed yesterday and how you understood the news. Are you concerned by this kind of exchange of letters, or to you, is it pro forma and makes sense at this point in the proceedings?
Well, this is sort of a new world. This is really the first time since the reforms that followed the global financial crisis, the so-called Dodd-Frank reforms, that required sign-off from the Treasury Department in order for the Fed to undertake emergency lending programs. This is really the first time that we've seen that, and this is sort of the first time that we've seen now a difference of points of view. Certainly, when these programs were started, Congress provided money to the Treasury and directed the Treasury to backstop these programs. And the Fed went ahead and did that. Now, of course, there are different points of view on whether the program should continue. But because of the way the Dodd-Frank Act is set up, if the Treasury says no, the Fed can't continue them.
Hey, Randy, it's Brian Chung here. I wanted to ask you about what the Fed's options are here. So it is my understanding that they had to work together to set these facilities up. But with the Fed statement yesterday, it does seem like they're at a crossroads here. Does the Federal Reserve have to return the money, the $195 billion of the $454 billion that were already allocated to its existing facilities? Or are they legally binded by the Treasury's statement here to return that money?
So I'm not sure what the legal requirements are, the specific legal requirements, but I would think that regardless of what the legal requirements are, they should do so because the Treasury has requested for them to do so. The Congress had given the money to the Treasury and gave the discretion to the Treasury on the extent of the programs, and so the Treasury has decided that they want to wind those programs down. It then I think would be the Fed's obligation to make that repayment.
Randy, do you think this development is the type of situation that causes financial conditions to tighten and causes a major risk-off move in asset markets?
Well, I don't know if this in and of itself is going to do that because, as you had mentioned earlier, these programs, or at least the ones that Secretary Mnuchin has talked about winding down, those have not grown very large. Some of the other programs, and those other programs are ones that had been stood up when I was there a little bit more than a decade ago, that are providing support for the money markets. Those are still continuing, and the Secretary said those should continue for at least another 90 days. And so it's not like everything is being pulled back. And the biggest thing that the Fed is doing asset purchases, and that's not affected by any of this.
Jared Blickery here. Just wanted to follow up on some of the mechanics of all of this. I was reading some headlines coming from a Mnuchin interview just minutes ago. And it says he wants Congress to reappropriate the money and that he wants to spend the money on small business PPP loan. If I look at the Treasury general account balance at the Fed, it's $1.5 trillion. Is this really necessary? Is it possible there's something else going on behind the scenes in terms of where they want this shuffling to go, and what can they exactly accomplish by doing this?
Well, I think from what you've just reported to me, so I haven't heard what the Secretary has said, but from what you just reported to me, it suggests that he has a different priority now and would like to funnel more money into the payroll protection plan. And in order to do that, I believe he would need direction from Congress in order to have that happen. So it's sort of a change of priorities given the change in circumstances of where we are relative to March, April.
And Randy, you mentioned some of the facilities that you were part of setting up, back during the financial crisis. So maybe we could just finish by zooming out and take stock of what has happened in the last 9 months, and whether you've been pleased by the effectiveness of the Fed's ability to act quickly and with size to stabilize the economy in March, and if that should give folks confidence in future crises that the Fed's mandate enables it to do what it needs to do to assist the economy in those kinds of instances.
Yeah, I think that's right. And actually, this the passage of the Dodd-Frank Act, which pulled some of the ability of the Fed to do certain things back from just being a Fed decision to being a joint Treasury and Fed decision. There had been concerns that the Fed would not be able to act quickly and boldly. Well, obviously, you go back to March. In a matter of days, what took us quite a few weeks to create these new programs that so we had sort of pioneered them. They stood them up, and they brought interest rates down to effectively to zero very, very quickly. So the good part was that for at least many of the programs of like asset purchases and interest rates, the Fed could act quickly and boldly, and did, regardless of the changes that came with Dodd-Frank. These specific lending programs that they were also able to move very rapidly and even more boldly because of money coming from Congress. But now this is one of the challenges, that once you have Congress and Treasury directing the Fed to do certain things, they can continue to direct them to do certain things or not do certain things, rather than being a Fed decision. So this is going to be very interesting to play out over time, and thinking about Fed's independence, Fed's crisis response. But the key responses are being to buy assets, reduce interest rates. They're able to act boldly on that and continue to do so.
All right, Randy Carlson with the University of Chicago Booth School of Business, also a former member of the Fed's Board of Governors. Randy, thank you so much for joining us this morning.
Delighted.
All right, coming up on the other side of this break, we're going to talk to Tom Lee about everything going on in the stock market these days. We're going to discuss Bitcoin as well. We're back with that in just 2 minutes.
Welcome back to Yahoo Finance Live. Stocks may be limping into the weekend, but that doesn't mean there aren't tailwinds out there for the bulls to absolutely rip apart. One of those bulls is Tom Lee of Fundstrat Global Advisors, who joins us now. Tom, always good to see you. Certainly, you put out a really great list of 10 reasons why you should be bullish into your end. But I do want to quickly start on the Federal Reserve news and this battle now with the Treasury Department. Do you think this is the type of event that could cause financial conditions to tighten, and that spreads over into the stock prices, and we see a correction. Is it that serious?
I think investors are naturally going to always be a little hesitant when they see any action that could affect market function or liquidity. So I'm sure the knee-jerk reaction is this is negative, but if you listen to the rationale for the Treasury Secretary's actions, I think it makes a lot of sense. That the money and the liquidity that's needed is really less about supporting corporate credit, and it's more about getting money into the hands of people and that financial bridge. So, I don't know if they should be treated as one versus the other. I would say my preference would be keep everything open, but I don't think it's really going to be as bad as it looks on the surface.
And I think, Tom, this morning's futures action is kind of suggesting that once people had a second to digest it. I want to ask about your recent price target, S&P 3,800. We've seen a couple 4,000s by the end of next year from your colleagues across the street. You're looking for a little bit more multiple expansion next year. How are you thinking about the setup for markets at this point?
I think that's exactly the reality that people think that there's an inherent cap on PE. And so they say, oh my gosh, PEs are, up by 2 turns. Number one, I think into year end, I think just a normal Santa Claus rally is 7%. So 3,800 just says this is another typical year, but there could be so many other good tailwinds supporting that, from vaccine to, just a lot of positive tailwinds. But into next year, I think anyone who thinks that we're going to be capped on equity risk premia, or essentially PE, because there's some sort of historical rule, that is not how bond markets have acted. Investment grade bonds, the PE you pay to buy an investment grade bond, which is the same bond issued by an S&P company, is 51 times. And for the last nearly 100 years, equities have always traded at a higher PE than their equivalent corporate bonds. So those two have to meet somewhere in the middle. If that means S&P PE goes up, I'd say that's a more likely route to mean reversion.
And this leads me to think about something that you were discussing, and I think we talked about this back in January, February, before COVID was part of the conversation, was this idea of certain stocks, certain sectors, certain styles driving a kind of performance chasing. I think the example at the time was maybe Tesla, the Russell 1000 growth index. And I'm curious, as you think about the end of this year and into next year, if that's also a dynamic you're on the lookout for, considering a lot of people have been flat-footed, not just for a month or 2 months, but really since March, because things were quite scary, but the snapback was fast and it didn't really stop.
Yeah, that's right. Miles, what you're referring to is, back in January, February, we wrote about how the Russell 1000 growth managers at the start of this year had almost no weight in Tesla. And we thought that if they went just to a market weight, it would create enormous buying pressure. So with price indiscrimination, meaning Tesla had the probability of becoming quite parabolic. Today, that same setup exists for epicenter stocks, because if you look at the market weighting, epicenter is roughly 25% of the market index, but most growth managers have a 0 weighting in epicenter because it hasn't paid to be in epicenter stocks or cyclicals. Into year end, I think if the economy is recovering and we get therapeutics, we're going to see a huge move in the epicenter stocks. In fact, the last 2 weeks, the S&P has been essentially flat. Actually, it's been down slightly, but the epicenter stocks are up about 15%. So I think just sort of the fourth quarter leadership, it's already revealed its hand, and I think people need to be a lot more cyclical.
Hi, Tom. Jared Blicker here. Want to get your big picture take on potential headwinds. We saw in February, as the market was at all-time highs, how quickly bad news got priced in, and we have incredibly low liquidity. And I see a lot of bullish factors out there, but I'm just wondering what's on your radar? What makes you change your bullish view, at least in the interim?
Yeah, the biggest risk to markets is always when people say they don't think anything could go wrong. Because I don't know if you remember, that's kind of the view people had in February. And then, of course, you can't just have that, but you have to have positioning. The reality is there's $4.5 trillion of cash on the sidelines. So people have taken money out because of COVID correctly. People should have liquidated. but nobody really got back in. You might say that everybody is long stocks. They're not. Otherwise, how could there be $4.5 trillion of cash on the sidelines? And especially if you look at retail money market balances, they're up almost 500 billion from February. So people are largely sitting out this market. We did a webinar yesterday, and we don't reveal all the questions. We received about 100 questions in that webinar, but some of them were like, hey, I'm 70% cash. Should I be buying stocks now? These are people who have been advisory customers of ours, and they're in 70% cash. So if they're receiving our research because they believe the world is half full and they're in 70% cash, imagine what's happening to most investors. I think people are pretty cautiously positioned.
All right, we'll certainly touch upon that more. Tom Lee, Fundstrat Global Advisors, Managing Partner and Head of Research. Hang with us. We have the opening bell coming up here next.
All right, welcome back to Yahoo Finance Live, 2 minutes away from the opening bell here on Wall Street on this Friday morning. And we have continued to get more news on the vaccine front. Pfizer and BioNTech today announcing they will file for their emergency use authorization with the FDA. It is expected that perhaps by the end of this year, if their vaccine candidate is indeed approved, people will begin getting the vaccine. And Brian Sazi, I know that this good news comes as, we had that conversation about the Fed earlier. Some questions remain and I guess have not been answered in any way, shape, or form about what the next 60 days look like before the Biden administration gets started.
Well, Miles, you were the OG Fed correspondent, so I will leave you to chime in more on this. But when this news broke last night, you thought you were waking up today and you would see the Dow down 400, 500, 600 points. That's not is what happened. I think you're getting, as we start to dig more into this, you're starting to see that this may not be the event, Miles, that tightens financial conditions, causes a stock market correction. Is it good? Absolutely not. You don't want to see this ahead of a incoming new president and President-elect Joe Biden. This is not how any administration would want to start, Miles. But ultimately, for right now, the market is shaking it off.
All right, Jared, we got about 45 seconds before the opening bell. Sazi mentioned maybe there'd be a huge move in markets, but right now things look fairly muted. And it's nice to see, I guess, after an eventful couple of weeks, but really the last, I'd call it 5 or 6 trading days, things have been a bit calmer than we got used to around the election.
Yeah, they definitely have. And just looking at the futures and the Wi-Fi Interactive over the last 5 days, we're kind of ending the week on a low note here, but we're really just consolidating by highs that we've been tracing out over the last month or a few weeks or so. So we had this nice run up we're getting to new highs, and now we're backing off a bit, waiting for that next catalyst.
All right, and there you see the opening bell down on the floor of the New York Stock Exchange. Omnichannel Acquisition Corp. This is a SPAC looking to make acquisitions in the D2C, healthcare, beauty space. We're going to be talking to Omnichannel's CEO, Matt Higgins, coming up right around an hour, sometime around 10:20, 10:30. We expect Matt to be joining us for what should be a really interesting conversation. We are still joined by Tom Lee. He is with Fundstrat Global Advisors. Tom, we talked in the first segment about the stock market, and I think we know where we got to go next. We got to talk about what's happening in crypto. Bitcoin continues its rally on a market cap basis. We have seen Bitcoin at a record high on a price per coin basis. We're within spitting distance of the record. What have you seen in this space? And I guess the natural follow-on is how much institutional interest do you guys continue to get in your work? And I think a lot of people view that as a proxy for sort of where Bitcoin is headed.
Yeah, it's an interesting year because number one, we know that Bitcoin as a digital asset or internet money, it's really thrives off network value. So the more people who adopt it, the more parabolically the price rises. We've seen a pretty substantial increase in engagement this year. And I've been pretty surprised because it is institutional. We always thought US would be sort of the most important market to watch for adoption. And it's really taking off here. Fortunately, we are one of the few firms that sort of sits between institutions and digital assets. So we've seen a lot of interest and a lot of engagement. The halvening happened this year, which of course historically is good for price because you're reducing supply. But history also says that the year that follows the halvenings is much more important. So I think if Bitcoin was the best performing asset last year, 2019, it's killing it this year. It's just crushing all other hedges and asset classes this year, 2020. But in 2021, I think Bitcoin could be the year of the fireworks. So if people are interested, they really should realize that the best is probably yet to come.
Tom, want to get your take on some of the other crypto assets, Ethereum 2.0 coming down the pike here. Are you interested in this or any other tokens or cryptocurrencies for that matter?
I mean, yes, we are. In fact, our senior digital lead, David Grider, does a lot of work on specific projects, and he's actually probably good enough to do code audits. And I think that people have to keep in mind, Bitcoin is really the cornerstone of digital assets and digital money and sort of the importance of why people need to have exposure. But there's going to be so many other pathways to realize asset appreciation. So I think Ethereum has a proven community. There's a lot of other projects out there. I don't want to sort of pick favorites here because David has done a lot of work. And if you're interested, you should check out his work. But yes, in general, people should look beyond Bitcoin as well.
Tom, I do want to quickly, before we let you go, back onto equity markets. That 4.5 trillion you mentioned that is in fact on the sidelines. Where do you think that goes in terms of sectors? And what's a trigger point for a good bit of that money coming back into the market within the next few months?
Well, I think it's going to be really interesting because let's say people are really interested in thematic and ETFs, and machines and algorithmic systems and systematic trading, also will enter via ETFs. So number one, as the money does move off the sidelines, plus as the VIX falls, we know that value at risk or institutional leverage will rise. I think the indexes will rise broadly. So that means growth stocks will keep up with the S&P. But when people look for alpha or opportunities to beat the market, it's really going to come through small cap and cyclical stocks, which we call epicenter. They've already revealed their outperformance since the S&P's, like for 2 weeks, done nothing, but these have been on fire. That's a really big signal as we go into the Santa Claus rally, because people who want to outperform that 7% aren't going to suddenly dump the cyclicals. They're going to buy that tiny sliver of the market. And I think small caps similarly could really be quite dramatic in their upside move.
Tom, we've been talking about kind of nearer term or more intermediate term type moves for the market. But I remember, I think it might have been 2015, and you correct me if it was more recent than that. But, you had a note out talking about maybe basically just like millennials maturing and the generational cycle that was likely ahead for the market, a multi-decade kind of cycle that had you excited. Has your view changed on that at all based on what we've seen here, or is these kinds of hiccups expected along those very long positive, inflection points for markets?
Yeah, Miles, that's something that we don't write often enough about, but I think demographics have explained markets better than anything. So we like to really show our clients that for the last 100 years, you could have called every market top by just following generations of people aged 30 to 50. And the millennials are such a huge cohort, and they're about to inherit $68 trillion over the next 20 years. So they'll become the richest generation ever in the history of the US. That is historically tied to incredibly powerful bull markets. And yeah, so we are probably just in the first inning of a bull market that could last till 2038. I know this sounds crazy, but again, if history's a guide, the S&P will probably peak around 15,000. So I think for people who think there's no upside left, they're not really students of history. And I know I'm not going to try to sound crazy. I'm just going to encourage you to look at some of our work. History has not only been a good guide, it's almost been textbook. Even 2020 is actually acting pretty textbook. So, again, don't write me off as a crazy loon. I would just encourage you to look at some of the work we've done on that.
Tom, I'll try to find a link from posts I know I wrote a couple of years ago, looking at some of your work from a few years back. Tom Lee at Fundstrat, always fun to have you.
Updates.
Yeah, always fun to have you on the program, Tom. Really appreciate you taking the time.
Thanks.
All right, coming up on the other side of this break, we're going to talk about Lincoln's new Nautilus. We're coming up with that in just 2 minutes.
Lincoln is following up on its 17% third quarter sales increase with a redesign for one of its most important models, the Nautilus. For more on that, we are joined by Lincoln Motor President Joy Falatico. Yahoo Finance Senior Auto Reviewer Praz Subramanian is also here. Good morning to you both. Joy, let me start with you. The new Nautilus, some upgrades on the exterior, but a lot of focus on the interior. Why'd you make that move?
Yeah, absolutely. As you mentioned, we have some refinements with our signature grille and lamps on the outside, but a lot of work on the interior with our new Sync 4.0 system. It's going to have an intelligent digital assistant, bringing infotainment in a 13.2-inch screen. So lots of work on the interior.
Hey, Joy, Praz here. I wanted to kind of pivot to the brand itself and the revamp you guys are going through. You guys noted you had one of your strongest October ever. Third quarter sales up, over 15%. You know, how much of this, I mean, I know a lot of it's driven by just strong SUV sales, and you guys have a new kind of lineup with the new Aviator also recently kind of the new model, the Navigator from a couple of years ago. How sustainable is that as a way to kind of grow? Because, you know, do you need to kind of expand the sedan line too? Like what's the engine here?
Well, we're focusing on the growth segments, which is, as you mentioned, an SUV, and our new Nautilus is really in the heart of the utility segment in the medium premium utility, and that makes up 34% of all luxury sales. So we're really excited to refresh this vehicle, and we're really confident in our SUV lineup. And as we look forward, you know, we're looking at electrification. We actually began our journey last year with our Aviator GT, and we're working on an electrified vehicle that's fully electrified. And so we feel really confident in our lineup.
Joy, can you explain why the Lincoln brand is so popular in China? This is not a new phenomenon. It has been going on probably for well over a year. And are you concerned on the rise of these electric vehicle companies in China? Certainly outside of Tesla's been doing well in China, but you have XPeng, NIO. They're making a lot of inroads into the market.
Yeah, you know, we've had a really great run this year, really resilient and nice bounce back with COVID in the market there, especially in the premium segments. And we've actually had record sales months the last 5 months consecutively in a row. We're really comfortable with our lineup there. We're so pleased that the Guangzhou Auto Show is going on right now. And just yesterday, our Aviator won SUV of the year. So really excited in the luxury segment. And we do have electrification that we're working on with a fully electric vehicle that'll be coming in the future. So we're really excited about the growth in the China market.
Jared Blickery here. I want to get your take on the bigger picture after COVID, the trends that we've seen. You mentioned the trending hires, these luxury automobiles and SUVs, which is right behind you right now. Anything else, anything surprising? What are the consumer trends here?
Well, you know, with COVID, it's really about having a safe environment for everyone to transact. And we've been really focused on that, the safety of our employees being number one and our clients as well. So we've got real good protocols in our dealerships. And, you know, with Lincoln and our brand transformation, it's not about just our great products, but it's about our service experience as well. And we've had effortless sales experiences that provide the ability to have remote pickup and delivery, remote sales delivery. We have what we call Lincoln Showcase, where you can virtually tour a vehicle. And so really the safety is an important trend now with all luxury clients.
Hey, Joy, I kind of want to go back to what you said about electric vehicles. You know, earlier this year, Lincoln canceled plans to build a vehicle on the Rivian platform, a company you guys, Ford, has invested in. Since then, you've had a new CEO, Jim Farley, talk about how these kinds of electric cars are fundamental to Ford's future and also the Lincoln line. You mentioned a little update. Do you think anything more on that? Is there going to be a Rivian-based Lincoln coming up too?
Well, as you mentioned, we reviewed our plans early this year and mutually decided not to proceed. And we're focusing at Lincoln on building our own fully battery electric vehicle, and we'll have more to say about that in the future. But we really began the journey last year when we launched our Aviator hybrid grand touring vehicle. And next year in 2021, we'll be bringing out the Corsair hybrid vehicle as well. So we're well on the journey here to electrification.
All right, we'll leave it there. Lincoln Motor President Joy Faltico, thank you so much for joining us. And Yahoo Finance Senior Auto Reviewer Pras Subramanian, always good to see you, bud.
Thanks for having me.
And we'll be right back. And you're welcome. And we'll be right back.
All right, welcome back to Yahoo Finance Live. Miles Sutherland here in New York. We're about 15 minutes into today's trading session. Right now, we got all three major indexes in the U.S. trading slightly in red figures here. Real estate and financials, the lagging sectors in the S&P. Over in Europe, we had a bit more of a positive session going right now. Oscar Williams-Groot joins us now for the latest on everything happening across the pond. Oscar.
Well, Miles, it looks like we're going to end the week in the green, but only just. The best performing index here in Europe is the FTSE 100, but that is only up by 0.33% at the moment. The UK index has been boosted by better than expected retail sales this morning here in the UK. We've also had Barclays Economics upgrading their GDP forecast for Britain next year. They bumped it up by 1.6 percentage points, saying they now expect GDP to expand by 5.4% in 2021. Elsewhere, Barclays' European equity strategy team are advising clients to buy any dips that we see in the foreseeable. They say that despite this sort of ongoing battle between hope versus reality in markets, the unwind of the 2-year-long flight to safety may just be getting started, and the direction of travel is towards stronger growth. UBS Wealth Management also advising their clients today to buy into equities, saying they expect interest rates around the world to remain lower for longer due to the big debt binge that we've seen this year. But despite all these bullish signals that we've been getting from investment banking desks today, really the mood is consolidation here today in markets. There's a sense that after the recent major gains we've had on vaccine news, that perhaps we should just wait a little to see how the second wave plays out before we go any higher. That's why we're seeing pretty muted gains here today. But as I say, broadly positive.
All right, Yahoo Finance's Oscar Williams-Groot with that update from European markets. Oscar, have a great weekend.
You too. Thanks, Miles.
All right, let's turn our attention back to what has happened in U.S. markets this week. And Jared, we have a number of very interesting kind of setups here for the market. We had Tom Lee talking earlier about the Santa Claus rally, and however you want to define that, December tends to be a pretty good month for the equity market for a variety of reasons. Tom's price target towards the end of this year is essentially looking for an additional 7% increase. But as you see the indices right now, you kind of see them as at a crossroads of sorts. And why is that? And how do you maybe expect that to break?
Yeah, so let's take a look at the week that was first, and then we can get into some of the longer-term chart patterns, because we are indeed at a critical point for the market. So here's the Dow on the Wi-Fi Interactive. You can see down just 16 basis points for the week, but definitely off the highs here. And then the Nasdaq, kind of the opposite situation, faring much better as we had less of the cyclical and value trade and more of the growth trade. And then the S&P 500. It's still in the lower end of its range for the week, but you take a look at what's happened over the last 3 months. This is going to be very familiar with our viewers, and we broke out of this range, and we've just been consolidating in this pennant formation, and the market wants to break higher. There's strong internals. Tom Lee had his reasons. JP Morgan is looking for 4,500 in the S&P 500, but that's at the end of next year. And yeah, we got the Santa Claus rally. That's a huge tailwind for the markets at this time. But we have lockdowns that have not been priced in, call them curfews or pauses, whatever you want. That could definitely get priced in negatively very quickly if sentiment changes. And sentiment here is very positive. You look at the AAII bull bear report, investors are very bullish. Those are the retail investors. So sometimes they get it wrong. In fact, it's almost a contrarian indicator, but you got to balance that with all the dry powder. Tom Lee talks about $4.5 trillion in cash. JP Morgan is talking about this virtuous cycle of getting volatility down, allowing the systematic traders back into the market. We have a lot of tailwinds, which should be able to support the market in the long term. But the point is, if we break down a little bit over the next few days, I would say today or next week, we could be in for another 10% sell-off.
And we have seen a couple of those. They've come up quickly. They have been bought. But yeah, certainly in an environment like this, VIX is lower, but still in the 20s. You are certainly liable to see 7-10% corrections come in very quickly in that kind of environment. All right, coming up on the other side of this break, we're going to have more here on Yahoo Finance Live. Brian Sazi will tell us why the holiday season is so much fun over at Williams-Sonoma. We'll get into that coming up in just 2 minutes.
Welcome back to Yahoo Finance Live. Inez Ferre is standing by with a closer look at the markets. Inez.
And Brian, just taking a look right now at financials and energy. Those are some of the sectors that are lagging right now. But I wanted to show you some of the tickers based on earnings that just came out. Foot Locker, which had actually opened in the green. It was in the green in pre-market. Now it's in red territory. Their earnings call is going on right now. I was listening to part of it. Their back to school demand was strong, even though it came in late. It kicked in a little bit late. The company did beat on the top and the bottom line for its latest quarter with same-store sales, which rose 7.7%. But remember that same-store sales rose 18% in the second quarter. So sequentially, it's a little bit of a slowdown. The company is not providing any full-year guidance. Also looking at Hibbett Sports, same-store sales increased 21% year over year for its latest quarter. The company beating on the top and the bottom line. The stock seeing nice bump up more than 5%. Year to date, it's up 58%. And I just wanted to mention Workday, which reported their quarterly results after the close yesterday. The stock is now down 7%. It was a strong quarter, but the company did warn that the pandemic could affect new net bookings demand in 2021. And it could not give a forecast for fiscal 2022, which begins in February. The stock is down 7%, but year to date, it's up 30%. Brian?
All right, Nez. Again, Workday, interesting to be in that kind of SaaS bucket. Stock is almost 20% off its 52-week high, but as you mentioned, has had just a killer year along with a lot of those other kind of smaller SaaS plays, although at this point, Workday, certainly a company of formidable size. Brian Sazzi, you heard Inez talking there about what we've seen from a couple of retailers and a company out last night with its results. And another huge quarter for them is Williams-Sonoma. This is a stock that was at $30. I think 35 was the low back in March. It's now trading closer to 110. And it's really, been a success story for them for some time at the West Elm brand. But the results across all three of their brands, Pottery Barn, West Elm, and Williams-Sonoma, just on a tear this year.
Oh, Miles, you can't be surprised. I see your background. It looks very Williams-Sonoma, West Elmish. But yes, this quarter was really another mind-blowing one for this company. Same-store sales up 24%. You have Pottery Barn up 24.1%. West Elm up 21.8%. Williams-Sonoma up 30.4%. Even the teens business was up close to 24% in terms of sales. The interesting thing here, Miles, is you're seeing new households, new customers to Williams-Sonoma up 30% year to date. Take a step back. Where is that coming from? All this migration from urban areas into suburbia. People need furniture, and they don't necessarily appear to be getting the broken down stuff that you can get at IKEA. They look to be paying up and getting real stuff like you with that great furniture in the background.
Well, look, Sazzi, we've had a couple. First of all, I am doing this show on a tiny West Elm desk that probably isn't the right ergonomic height. The chair I'm sitting in, also from West Elm, it's okay. If I had to sit in it for 8 hours every day, maybe it wouldn't be my favorite thing, but I do get to migrate around the spacious 400 feet we have here throughout the day. But yeah, look, I think you have all those catalysts in place for all of these brands. And the question, and you look at the stock, you look at the way investors have thought about it, the question that I would have for West Elm, and RH is another company in this position, is this a step change in the company's trajectory? Does the customer who bought a home and is really excited to trick it out with a bunch of all-clad pans, how often are they coming back for those kinds of things? Or are they saying, I'll fill in the gaps around the edges at Home Goods, which I think is sort of where the longer-term trajectory of home ownership takes you. It takes you down the stack. Mm-hmm. Williams-Sonoma is very exciting the first time. You can't go to Williams-Sonoma every quarter and buy $500 worth of stuff you don't exactly need.
Yeah, well, the bulls who have piled into Williams-Sonoma are sure hoping this is sustainable. I do want to know, too, we're not just seeing it at Home Depot, Williams-Sonoma. We've also seen a big surge this month, close to a little more over 20% in lumber prices. Lumber prices have been on fire. Existing home sales have been on fire. You wrote about that in the morning brief newsletter this morning. The whole home space is on fire.
Yeah, it is. And it's really crazy. You talk to some folks who are actually selling homes and they will tell you some stories about the last couple of months. All right, Brian Sazzi, very exciting to track all of that and big times coming up with the Black Friday holiday. Always exciting for Williams-Sonoma and those retailers. All right, before we go to break, do want to thank Jared Blickery for stopping by during this 9 a.m. hour. Jared, we will talk to you next week. Coming up on the other side of this break, we're going to have more here on the markets as we get the final day of trading underway here on this Friday. We're back in just 2 minutes. right, welcome back to Yahoo Finance Live. Miles Udland here in New York, joined by Brian Sozzi. Julie Hyman is out on assignment on this Friday morning. Let's take a quick look at the markets here about a half hour into the open on this final day of trading, final full week for the month of November. Right now, we've got all three majors lower, though no major moves today. The Dow is the biggest loser, off 23 basis points. You heard Jared Blickery talking just in the last segment about the S&P as well as the Dow kind of sitting at these, and I mean the Nasdaq as well, but the S&P and the Dow slightly trending down, really sitting at inflection points at this point in their market journey over the last couple of weeks. It'll be very interesting to see where things shake out over the coming months. And I think as investors start to figure out the future here for markets, the number one concern is what is happening on the vaccine front, also happening with COVID cases. For the latest on all of that, we're joined now by Yahoo Finance's Anjali Kamlani. Anjali.
Thanks, Miles. So, of course, the big news of the day is that Pfizer and its partner BioNTech have filed for an emergency use authorization for its vaccine. Of course, the good news being that within weeks, we will know whether or not the FDA is likely to authorize and then distribute this vaccine, making it the first out the door. And it's a big news on a number of fronts. Number one, the fact that it is an mRNA platform, which has never been on the market before, but also the fact that we are getting this vaccine by the end of the year. More than likely, states are already expecting some sort of shipment before the end of the year. So fingers crossed and hoping that it all works out. Meanwhile, in the treatment space, we've got some news as well. First of all, last night, the World Health Organization, a number of doctors in an article in the British Medical Journal did say that they do not recommend remdesivir, and that is Gilead Sciences treatment that we know has been used in hospitals, despite the fact that many health officials, including Dr. Anthony Fauci, have said that the results have been sort of mediocre in terms of actual impact to the patients. And so that's very interesting. Gilead, of course, saying that with the U.S. approval of its drug, it clearly indicates that based on those robust trials, that there is some sort of improvement, and especially at a time where we don't necessarily have very many, some critics saying that generics that are less expensive than the $3,000 price tag that Gilead has are such as dexamethasone are more impactful for severe cases, and so should be used more broadly. But also the FDA did approve a combination of Eli Lilly's arthritis drug with remdesivir yesterday. So, of course, coming back full circle to the U.S. is fully behind this and pushing it forward as well. And so that adds another treatment option for patients with COVID right now. Miles? And
certainly positive to hear those treatment options increasing with hospitalizations right now sitting at a record high. Anjali, quickly want to ask about some of the rollbacks we've seen in a number of states. California, I think the most notable among them. A majority of their counties, covering I think 94% of the state's population, now have, I guess we could call it a soft curfew in place from 10 p.m. to 5 a.m. And, you know, just kind of thinking about how people who aren't in the news like us see this. On the Today Show today, they were bringing up the CDC's announcement yesterday about recommending folks don't travel for Thanksgiving. I think we perhaps have lost a little bit of the plot on how much it matters for the CDC to come out and say something like that, and certainly signals that we're in a new phase as it relates to the quote unquote reopening that was underway here in the summer and the fall.
That's absolutely correct, Miles. We are looking at the CDC giving us this broad sort of blanket statement, which is hasn't been done before. There have been guidances, but there hasn't been the do not travel, if you will, that was given for Thanksgiving. Of course, hoping to stem the curve of what is likely to be another surge post Thanksgiving, if in fact people do not follow that recommendation. Meanwhile, similarly across the country, you're seeing a patchwork of strategies that have been unfolded, and that is similar to what we saw earlier this year, but of course with much more on the line right now, as we know that a majority of the country continues to be heavily impacted, and we're setting record numbers, whether it is a metric of positivity rates or daily cases or hospitalizations, and increasing deaths, unfortunately, is what we are seeing as well across the country. So all of this put together, of course, to say that while there is not yet a national strategy, we are at least seeing, like in California, the curfew, as well as some stricter restrictions either at the state or local level happening across the country, and hoping that it will all come together to curb the transmission.
All right, Anjali Kemlani with the latest on the state of the pandemic here in the U.S. Let's turn our attention back to what's happening in financial markets. For that conversation, we're joined now by Andrew Slimman. He is a managing director, senior portfolio manager over at Morgan Stanley Investment Management. Andrew, it's great to have you on the program this morning. I'd love to begin by asking about how you see the markets in the context of us doing this program every day, and just about everyone who's come through our doors has been bullish in the last 10 days, looking at the rest of this year, rest of next year. How do you see that outlook? Are you as positive as I think a lot of our guests have been?
Well, I think near term, look, I mean, the market's up 10% for the month. You know, you've seen some of the sentiment figures swing wildly more positive. We've had very strong kind of flow data. So people that were on the sidelines have largely capitulated and have moved into the market. So on the surface, I'm shocked the market has hung in there and has not pulled back at all as we've got, bad COVID news. The other thing that's going on, however, is the breadth has been unbelievable. So breadth is, the number of advances versus decliners. Usually when you get big pullbacks in the market, what precedes that is a narrowing in the number of stocks that make advances. And that's not happening today. There's actually a broadening out, which is a very, very healthy sign for the market. And I think to your question, what's really going on here is that the market is starting to anticipate that vaccine will cause the economy to recover next year, and that many of these stocks, more cyclical stocks that really got crushed earlier this year, they'll start to benefit fundamentally next year, and the market always being a leading indicator. So, I'm not. So I think that the point is we're going through a churn now where the market's not making much headway, but it's going to burn off some of this overbought situation. But for the near term, I think the market is going up. I do agree with that. Where I don't agree is I think the market will have a tougher go of it at some point next year when we actually get through COVID, because then all the good news will be priced into the market, and that's when I think the market will struggle. So I'm not so sure next year overall is going to be a great year for equities, although I do concede maybe the first part will be pretty good.
Andrew, why do you think 2021 might be more difficult? If we do start to get mass immunization, theoretically that would be good for the economy. You get earnings estimates moving higher again. Why do you think it would be tough?
Sure, because for all the four primary reasons, there's four reasons the market is really moving, has been strong coming off this low. Number one is obviously the Fed has been very accommodative, and they've shown that they will continue to support financial markets. And the first thing, well, what happens if next year at post-COVID they won't change policies, but maybe their tone could change a little bit, and I think the market would react negatively to that. Secondly, keep in mind, very few people predicted this V-shaped recovery we have had. Stocks respond to whether they beat or missed expectations. It's not, whether they had plus 10% or minus 10% earnings growth. It's what was expected. And right now, the expectations were below where companies are coming in. What happens if we get through COVID and then all these economists and all Wall Street raises their outlook next year? The bar is going to be tougher next year for companies to exceed it. That's the second thing. A third thing is, we will get these vaccines, and I think that will price in. And fourth, and I hear this over and over and over, I hear people say, well, I'll feel more comfortable investing when we get through COVID. Well, that sentiment is a contrarian indicator, and we know there's piles of cash, even though cash has started to come back in, there's piles of cash still on the sidelines. Once that comes back in the market, I don't, you're going to run out of that buying power. So the four reasons why I think the market's moving up now, I think that will reverse at some point next year.
Andrew, it kind of sounds like you're outlining like a Frankenstein version of 2017's market, right? Where we pulled forward all the tax cuts and everyone got all excited. Is that kind of analog that is interesting to you?
Absolutely. You're dead on right. The stock market's a forward predictor. I'll give you another analogy. 2009, 2010. In 2009, off the low, the market went straight up. We had a very good year off the low, and yet, boy, oh boy, people were very cautious because they're looking backwards in the financial crisis, and will the banks survive? The market continued into 2010, and it was at a point when financial conditions started to feel a little better. The Fed backed off a little bit, the market got a little bit more volatile, and the returns regressed. So the point is the market pulls that good news forward at a time when it doesn't feel very comfortable. And I think that's what's going on today. That's why these reopening stocks are working. I looked yesterday, there was bad news on the cruise ship lines, and yet they're up. So I think you have to look at the messages of the market. And, I'll say, don't think you're smarter than the market. The market is a very good indicator. And I think if you look under the hood of what the market is saying, it is saying we like the cyclical recovery stocks. And I think the message of that is we're beginning to price in a recovery next year.
Well, the old cliche is, what's it? Greedy when others are fearful. And there's a reason that cliches endure. It's because they often end up being true. Andrew Sliman.
Well, I'll give you one other. Don't fight the Fed, right? Don't fight the Fed means to be bullish when the Fed's accommodative. The problem is the Fed is accommodative when there's a problem out there. And so people tend to focus more on the problem than the Fed. So it's a great line.
All right, Andrew Sliman with Morgan Stanley Investment Management. Andrew, really appreciate you taking the time today. Hopefully we can talk soon.
Take care, Miles.
All right, let's turn our attention to the world of politics. The Associated Press calling Georgia for Joe Biden, who I guess is already the president-elect, though not officially. Rick Newman joins us now to tell us why not officially and sort of where we stand, Rick, in this whole process. The Rudy press conference yesterday just sort of, to me, encapsulates what's going on, which is like a kind of a clown show. But what's the actual serious thing that is happening with respect to deciding when the next president will be affirmed, I suppose, by the powers that be as the next president?
The serious thing that's happening is Trump is clearly trying to undermine the will of the voters. It's almost certainly not going to work. But I think everybody who cares about democracy and the outcomes of elections in the United States needs to be paying attention to what's going on here. So what Trump is trying to do most recently is get representatives of the legislature in Michigan. Republicans control the legislature in Michigan. He's trying to get them to essentially invalidate the results of the election in Michigan, which Biden won. And he wants this is a real back channel effort that almost certainly won't work. But no one has ever tried this before. So look, the votes are just against Trump. It's clear Joe Biden won the Electoral College, but the Electoral College does not make this official until December 14th. So we are going to see these desperation moves like we saw yesterday in that crazy press conference, at least up until December 14th. And who knows, maybe even after that.
And Rick, I guess I would also ask, does this final episode, this final chapter, I suppose, of the Trump experience, does it change anything based on how people had probably already thought this whole period went? And, rarely do incumbents get voted out of office. And I think that's a strong enough signal in and of itself, how the country felt about this. Does this last sort of gasp change anything for you about what this, means for American politics or whatnot?
I think it does. I think that President Trump has demonstrated several weaknesses in the U.S. governing system and in the U.S. electoral system. I think it's really important to point out to anybody watching and anybody not watching that, look, we had integrity in the 2020 election, despite major efforts to undermine the election, mostly by Trump and probably also by all the other interferers we know about, Russia and China and Iran, for example. Look, the vote count worked. This was a good election. But we're watching a president try to undermine what the voters said they want to happen. So this is important going forward because who knows? Some other aspiring dictator might try to do the same thing. Trump himself may run for office again in 2024. I actually don't think he will, but some people think that's on his mind and he's going to want another shot at it. So if he does, Trump is going to have to account for what he did at the end of his first term if he's asking voters to give him a second term in 2024. Trump has shown us a lot of weaknesses in the system, and I think it's important to address those.
All right. Yahoo Finance's Rick Newman. Rick, you joined us last Friday, and we chatted briefly about the Steelers. They're now 9-0. So best
I'm
of luck
aware.
to you.
I'm
Best
aware.
of luck to you this weekend. Jaguars, typically a slip-up game for the Steelers, so we'll see how they handle it this weekend.
Right.
All right, coming up, we're going to have more here on Yahoo Finance Live. We're back in just 2 minutes.
A big tie-up this week between media giant Sinclair Broadcast Group and casino operator Bally's Corporation. The 10-year deal will see Bally's and Sinclair work closely to capitalize on sports betting and iGaming. Joining us to discuss is Sinclair Broadcast Group President and CEO Chris Ripley and Bally's Corporation President and CEO George Papanier. Good morning to you both. Chris, let me start with you here. I'm just going to tick through some of the things that you are receiving as part of this deal. You have a naming rights fee. You can get a 15, or you will take a 15% stake in Bally's, also an option to get 15% more. As an investor looks at this deal, how does this change your financial trajectory moving forward?
Well, look, there's really two key things about this deal that make it so great. First, we're taking and bringing together the largest collection of sports rights in North America that can be regionalized and localized on a state-by-state basis. That's really important because when you take a look at national players like ESPN, they have lots of sports, but they can't put sports betting on there. You only see fantasy. And we're combining that with Bally's, who, as you point out, we're going to have a significant stake in. And Bally's is an up-and-coming player here. They have a leading access footprint, which means they're going to be 50% more profitable than online players who pay others for their footprint at maturity. They have an end-to-end technology stack that's built for the U.S., and they have a complementary land-based casino portfolio that with a large player database. So we think it's a great combination. Putting those two together going to be really powerful to make a new leader in the sports betting space. And by having a big stake in Bally's, that is going to have a huge economic benefit to our shareholders.
And George, I'd love to get your thoughts from the casino side on where you think we're at in this sports betting cycle, and some of the dynamics that you think have played out last couple of years. And obviously, this is a longer term deal, so I would assume you believe this is quite early in that process of a maturing market in the U.S.
Well, first, thanks for having us. And if I could just take a step back, we just announced two pivotal transactions, which were just the last two pieces of a complex puzzle for us to become the first omni-channel gaming operator in the U.S. We had capital, so we certainly like to operate with a low balance sheet. We had high levels of liquidity, and that allowed us to continue to build our portfolio of bricks and mortar assets, which now put us at pending licensing at 14 casinos in 10 states. And that led us to the access to these markets, which allows us to now go into these markets for sports betting and iGaming. Then we also had the brand, which we just added about a month ago, which is the Bally's brand, which we will now use over both our bricks and mortar side as well as our interactive technologies. Then we added these two last integral pieces of the puzzle, which were the tech stack, which was the deal that we did with BetWorks, and we announced yesterday for 100% interest and ownership of a proprietary tech stack, which was critical for the last step, which is where we are today, which is this media relationship with Sinclair.
Chris, do you think this alleviates some of the concerns on the street on the 21 regional sports networks that you received from Disney as part of their spinoff? Do you think this alleviates some of the concern on the street about how you extract value from those key assets?
Well, look, we are on a path to transform sports, and more specifically the RSNs, through direct-to-consumer, through gamification, and through fandom-based community features. So this is a major cornerstone for us in that transformation, and does, I think, answer a lot of questions in terms of the intrinsic underlying value of these sports rights, which are extremely valuable.
And so, Chris, just following up on that, given the uncertainty, or actually, I guess, relative certainty we've seen in professional sports, but changing of those kinds of schedules, and there's been you've had to jump through a lot of hoops to get those games on the air. Are you guys, I guess, as bullish as you've ever been on the value of those assets, even with a very strange spring and I think still a somewhat uncertain season, especially for the baseball, basketball, hockey rights that are so integral to those networks?
Well, look, I think if anything, COVID has proven the value of sports. And our main programming post-COVID was the regular season of baseball, and our ratings and our advertising revenue per game were up during that period, even though there was a bunch of doubleheaders, they were at different times. There was lots of reasons for people not to tune in. And they tuned in record numbers for us. And I think when things get back to normal, which I expect there could still be some shifting of the seasons next year. Obviously, basketball is starting here in late December, and we're going to. I think you'll see that viewership will be strong when things get back on a normal pattern.
George, you and your team have spent the pandemic really getting some very attractive assets on the cheap. As you take a step back, how do you think the casino industry will emerge from the pandemic?
Sure. So, this is certainly unprecedented. But if you look over the last 20 years, we had to deal with a couple critical events as well, including 9/11 and a really long in duration Great Recession. So the industry has proven itself to be pretty resilient. And, once we were allowed to start opening again, our first property opened in May. And then within a month after that, we had all our entire portfolio open. We felt there would be some pent up demand, and there certainly was, but it's allowed us to kind of evolve to where we're now dealing with the pandemic, and it's forcing us to go with much less amenities than we have historically opened with. But as a result of that, we're seeing improvements in our margins. So we think some of that is sustainable long-term. As far as, how we see ourselves continue to operate with the pandemic, we've always had the interests of the health of our employees and our customers first. We're going to continue to adhere to CDC as well as our departments of health, states' departments of health guidelines. And, might be a little rocky from now through the point of where we actually can hopefully be able to utilize these vaccines and the therapeutics. But, we think, again, the industry is resilient And we're going to just continue to evolve, and you've seen some of that with the evolution to sports betting and iGaming, which we're preparing ourselves for to be very competitive in that space.
Chris, last one to you before we let you go. Live sports is back. Hopefully, live sports will stay back in 2021. Any update on you being back on YouTube TV and Hulu?
No updates there, but I am optimistic now that we have dates for the return of live sports.
It's definitely good to see sports back. And again, congratulations on this deal. Sinclair Broadcast Group President and CEO Chris Ripley and Bally's Corporation President and CEO George Papanier. Have a good weekend, guys.
Thank you.
Thanks, Brian.
And we'll be right back. Cool.
Clear, guys.
Thanks,
you so
guys.
much.
Really
Thank
appreciate you
you.
taking the time.
Yeah, thank you. Appreciate it.
Chris.
We'll talk to you soon.
Hey, George.
All right, welcome back to Yahoo Finance Live. Miles Udland here in New York. Let's take a quick look at the markets here about an hour into today's trading session. Another mixed day, but not a lot going on. The Dow's off about 46 basis points. The Nasdaq right now hanging on to gains. Well, 2020 has been an amazing year in markets, and it's been defined by a number of themes. One of those is the SPAC boom. This is a special purpose acquisition corp. Basically, blank check company comes to market, then says we will buy something coming up later. The latest SPAC coming to market today is Omnichannel Acquisition Corp. And the company's CEO, Matt Higgins, joins us now for a conversation about everything going on in the markets here. Matt, it's great to talk with you on this exciting day for you guys and just an exciting time for the markets in general. I'd love to talk through what you guys have set up at Omnichannel, both to you as the CEO and the board is just a really interesting collection of people across industries and what you're hoping to eventually surface through your search process.
Well, thank you for having me. It is an exciting day. This SPAC has been a long time in the making. And first and foremost, we're focusing on the consumer sector. There's been a massive disruption in how commerce is transacted. We've seen 5 years of e-commerce growth compressed into 6 months and 7 months. It's been extraordinary. And as a result, the future is omnichannel. And what that simply means is removing friction from the consumer journey. Whereas in the past, the channel would dictate the experience. If you were going on mobile, it's one thing. If you walked into retail, it's like 50 first dates. No one at the register knows you. The future is about removing friction so that the channel recedes to the background, and however you receive your goods is up to you. And that takes work. And so the purpose of this SPAC is to identify great consumer companies that need support in moving along that omni-channel journey. And that's why I put together a tremendous team of operators that's really hard to come by in the marketplace.
Matt, are you a believer in retail stores?
I'm sorry, say it one more time.
Are you a believer in physical retail stores?
I am actually. I co-teach a course at Harvard Business School with Professor Len Schlesinger, and I say that a couple things. One, retail is not dead. Malls may be struggling. Retail is going to be reimagined. Two, the idea of a pure play, digitally native brand where you only exist digitally only exists for a period of time. What happens is, once you discover a marketplace unto yourself, you start spending ads against it, you do paid search on Google and Facebook and whatnot. What inevitably happens is incumbents jump in, they bid up the cost of your acquisition, and you begin to eat away at your margins. Every business needs to go omni-channel, and that includes retail. And what studies show that if you are a digital brand and you have a physical touch point, no matter what that is, your returns go down, which makes sense, right? People become more comfortable transacting with your brand. And at the same time, your customer acquisition costs go down, your long-term value goes down. So I am bullish on retail. I'm actually bullish on brick and mortar, because what you're seeing with Walmart and Target and what Bed Bath & Beyond has done in 1 year is that they actually have a leg up in this next year because they have stores that they could turn into distribution centers to handle last mile logistics.
You know, Matt, we've talked to a lot of people who kind of said everything people predicted in retail has finally started to come true a little bit through the pandemic. And do you have that sense? Like in 2010, we would have said, oh, distribution is the next big thing, and it didn't happen for years. Do you feel like this is finally the moment for those strategies to be realized? And is that part of what has you guys excited with this SPAC?
Yeah, I do feel that. It's funny why things just take maddeningly a little bit longer to materialize. I'm not sure why brick and mortar woke up in 2020 and said, hey, I think the internet's going to be a big thing. But whatever it is, it's happening. We are definitely going omni-channel. And here's the opportunity that and the gap I saw in the SPAC marketplace. Obviously, it's frothy and a lot of people have launched it. But what I have not seen is a great team of operators. There was a study that McKinsey put out actually in September that tried to identify the operator premium. And what they found is not all SPACs are created equal. When you have an operator-led SPAC, they tend to outperform other SPACs by 40%, and they actually outperform their sector by 10%. So my vision here in putting this together was put together a team of operators that can help a consumer business along this journey, because it's been a chaotic year and it's not easy to go omni-channel if you're not comfortable operating at retail or digitally and whatnot. Put together a team of operators and create value in the combination. On my board of advisors and board members, we have 10 founders. We also have a level of diversity and inclusivity that reflects where America is going, where America should be going, and at the same time that reflects the values of these great consumer brands, right? 78% of customers want their CEO to stand for something, and they want their company to stand for something. So the mission-driven companies do the best, and our SPAC mirrors that movement.
I'm curious, Matt, about the decision to go via SPAC, though, because I mean, you wouldn't have any problems raising a private fund if you wanted to go buy something. Bobby Brown's not going to have any issues going to raise a fund if she wants to go buy something. So I'm curious about the decision to finance it through a SPAC, because as you mentioned, the operators you guys all have Rolodexes far, more than deep enough to get, $1 billion or whatever you would like to raise to go make an acquisition. So I'm curious about the financing thought process there.
Well, it's a great question. I'm partly motivated by the fact that I think there is a place in the marketplace for SPACs. They make a lot of sense, but they need to be reimagined. They need to be operator-led, in my opinion. I think there's a hierarchy. Number one, operators. Number two, M&A experts. And number three, public company experts that can nurture the company through that threshold, right? It's a very uncomfortable process to go from private to public. And so I am excited by the fact of reimagining what a SPAC should look like. But it is a great question. Clearly could have raised a fund. But I think this product should exist, will exist, but could be done better.
Matt, I think part of the sizzle here with this SPAC is you. in your story. 8 years, I would say, running financial operations for the New York Jets. You launched RSE Ventures with Miami Dolphins owner Stephen Ross, who is a big player in real estate, of course. And you're still the vice chairman of the Miami Dolphins. Really heck of a story. What do you attribute your success to?
What do I attribute my success to? I think a little bit of touch of defiance. I'm always willing to go my own way. I grew up dirt poor in Queens, taking care of my mom. I have a crazy early story. Dropped out of high school, went to college 7 years a night, then Fordham Law, and then was one of the first employees overseeing the redevelopment of the World Trade Center. So I always take on hard challenges. I go my own way. And most importantly, I'm really passionate about working with my founders and all the businesses I've backed. I was the first customer of Gary Vaynerchuk. I think I have a pretty good eye of talent, and then I became his partner. I've incubated companies from scratch. So I'm just really passionate about helping founders go through that journey in a servant leadership approach and a very empathetic approach. And this is a great vehicle to do that because it's really uncomfortable to go from private to public, and I think I could add a ton of value.
All right, Matt Higgins, Tua time has arrived. Congratulations on that. Enjoy the rest of this season down there in Miami. Matt Higgins with Omnichannel Acquisition Corp. Thanks so much for taking the time. Hope we can talk soon.
All right, thank you for having me.
All right, we'll have more here on Yahoo Finance Live right after this short break. All right, Yahoo Finance's Rick Newman recently sat down with New York Senator Kirsten Gillibrand to talk about all things election, transition, and any role that she might play in the upcoming Biden administration in the latest episode of Yahoo Finance Presents. Take a listen.
Well, I certainly hope we can get back to the negotiating table. I've heard from a lot of New Yorkers, and they are truly struggling. People don't have enough food. They don't have any sense that they'll be able to provide for their families in the new year. Unemployment insurance runs out at the end of the year, and they're concerned about whether anything will change. And so we really need relief going to our state. We need money for state and local governments, for healthcare workers, for food stamps, for rental relief, for unemployment insurance, for small businesses, for our restaurants, for all the industries that have been crippled because of COVID. And we need it now. Unfortunately, we've not found that common ground yet. I'm hoping that Mitch McConnell hears from his constituents over the holidays. And so maybe that will be reason to get everyone back to the negotiating table.
So we have these two runoff Senate races in Georgia on January 5th. Those will determine the makeup of the Senate, which party controls it. Is it Do we have to wait to get past those before Congress can do anything about another stimulus bill?
Well, no. I mean, we could start negotiating a stimulus bill right now. Speaker Pelosi has already passed 2 bills in the House on a bipartisan basis. She's lowered her number from $3 trillion to $2 trillion. Mnuchin got very close to that at 1.8, I think. But Mitch McConnell is stuck at about $500 billion. And so he's nowhere close to where the other 2 negotiators are. So I hope that perhaps after Thanksgiving, in a couple of weeks in December, that we could work on a common sense bipartisan COVID relief package that meets the needs of the families of my state and across the country.
So if Republicans would happen to win those 2 races and retain a thin margin in the Senate, Mitch McConnell would have a lot of leverage. In that scenario, would Democrats just have to accept something like $500 billion, a lower number, which is around 1/4 of what Nancy Pelosi in the House wants?
I think if we just caved into Mitch's demands, it would really harm the country. So one of the poison pills in Mitch's bill right now is blanket liability protection. And we remember what that looked like when meatpacking plants would be opened, where no one would have personal protective equipment, no masks, would be working shoulder to shoulder, and COVID ran through those meatpacking facilities like wildfire. So we don't want to see that again. And without any ability to hold an employer who doesn't take the lives of his workers seriously and care, then you're putting a lot of workers and a lot of Americans across the country at grave risk. So I think those kinds of poison pills are really harmful, and we don't like to be bullied into bad policy. I think the Democrats in the Senate would negotiate, would lower their total number, but not at the price of harming employees.
President Trump obviously has not acknowledged Joe Biden's victory in the Electoral College and the fact that Joe Biden's going to be president in 2021. And he's still trying to invalidate the election results. It's not partisan to say this is a shameful effort to undermine voters. And almost no Republicans have come out and acknowledged Biden won. I'm very interested whether Republicans say to you privately, look, we know Biden won. We just need for Trump to get over it. Do Republicans basically get what's going on here? Are they sort of in league with Trump in an effort to overturn the results of the presidential election?
I think most Republicans who have not acknowledged the election are afraid of Trump and are unwilling to stand up to him and don't want the consequences of a backlash that he might create for them. The ones who have stood up, Susan Collins, Lisa Murkowski, Mitt Romney, Ben Sasse, they've stood up to President Trump in the past on different issues. So frankly, you just need leadership. You need independent leadership to stand up to him and to tell the truth. So it's disappointing that my colleagues, that more of my colleagues haven't been willing to do that, but they haven't been willing to do it in the last 4 years because they are afraid of losing the support of Trump supporters or just afraid of the backlash. And frankly, you need much more leadership than that here in Washington.
Do Republicans on Capitol Hill acknowledge that privately, or do they just basically bury their heads in the sand?
They do not acknowledge it.
Let me ask you about the agenda for a Joe Biden administration, what Congress might be able to get done. Biden has a lot of items on his agenda. I can't go through, like the top 10 and just ask you one at a time. But what do you think are priorities for the next Congress? And I'm talking about things that might actually be doable. It would either be done with a very thin Democratic majority in the Senate or a very thin Republican majority. So it would have to be something where at least a few members of the other party would agree with the majority of one party. What could get done?
So I think there's a lot of things that are deeply bipartisan. I do think COVID relief and rebuilding the economy is the most bipartisan idea there is, and something that everyone shares a desire to do. I think we could begin to rebuild our infrastructure, begin to create more robust job training through our community colleges and our state schools. I'd like to have a national paid leave plan, something that is already bipartisan in the House and I believe can be bipartisan in the Senate. Personally, I'd like to work through my committees. I'm on the Armed Services Committee, and we've been doing a lot for our service members. We have legislation on burn pits, for example, that men and women who participated in the war on terror were subjected to the horrible toxins that came out of burn pits in dozens of countries around the world. Those service members, now veterans, are dying of horrible cancers because of the toxins released from those burn pits. We could pass legislation on that. So there's a lot of really easy bipartisan work that's already ready to go that we could work on together in a Biden administration.
What about measures on climate change and global warming and it would not be the Green New Deal. That is not likely to get through the Senate, but there are other less extreme measures that some Republicans and some Democrats support. Anything that could happen there?
Yes, there is. So if you break down all the ideas within the Green New Deal, most of them are already bipartisan. For example, investing in science, technology, engineering, and math, investing in renewable energies and energy efficient buildings and appliances. We could also invest in redeveloping and cleaning up brownfields. Every state in this country has legacy pollution that, if cleaned up, could create opportunity for development and growth and new businesses and new hotels and new industries. So those are the kinds of things that we could fund today. And I do believe if we fund a large infrastructure investment nationwide, it can be green energy investment. So it can be rebuilding our infrastructure to be energy efficient, to use mass transit, to use new technologies. That would be the smart way to rebuild. And I think a lot of states would be really interested in that. So those are the kinds of ideas that are already bipartisan that are part of this vision for how to tackle global climate change.
So if Republicans retain control of the Senate, some Republicans might vote for bills like that, but we saw during the later years in the Obama administration, Mitch McConnell really just tried to prevent almost anything from happening that Obama might be able to claim as an accomplishment. Do you expect the same sort of obstructionism if he remains Senate Majority Leader, just trying to prevent stuff from happening, prevent cabinet appointees from taking their jobs and things like that, or do you think he would be more cooperative?
I don't know. I mean, the difference is perhaps that Mitch McConnell knew President-elect Biden when he was a senator. So there may be some commonality there. There may be some willingness to work together. So I do believe there's a possibility that Mitch McConnell treats President Biden different than a President Obama. But I don't know. He was really quite destructive during the Obama administration, being unwilling to find common ground and do good things for the country. He'll have a smaller majority. Maybe that, again, will make it easier to get more bipartisan things on the table. But I haven't given up on Georgia. I think we have a real shot of winning Georgia. We've got two great candidates in John Ossoff and Reverend Raphael Warnock. So I'm very hopeful that we can get every vote out and really organize ourselves in Georgia to win those special elections or those runoffs in January.
The 2020 elections are still underway going into 2021. Democrats did underperform, at least according to polls, which we now know are somewhat faulty. Do you feel like you understand why Democrats did not take back the Senate and lost seats in the House instead of gaining seats?
Not particularly. I think that we had great candidates across the country, and they really ran on issues that people do care about. But perhaps some of those states were redder than people thought. Some of those districts were not yet ready to turn blue. But it doesn't mean the work that we did didn't matter, because it did. And we organized more people, got more people involved. And maybe those candidates or candidates who care about the same issues can win the next cycle. So I'm still optimistic that the people who did run did a great job, because they moved people's opinions and minds about the vision and agenda that Democrats have. And it's one of the reasons why Vice President Biden is now President-elect Biden.
And these are some of the issues a lot of people are already thinking about with regard to the next set of elections, 2 short years away from now. And we hope we can talk to you many times before then. Senator Kirsten Gillibrand of New York, thank you for joining us.
Thank you so much.
Welcome back to Yahoo Finance Live. It has been a big week of retail earnings on the street. And if there's one thread that ties all these reports together, it's some blowout online sales by some very big names. Yahoo Finance editor-at-large Dan Roberts joins us for more on that. Dan, some of these e-commerce gains, Walmart, Target, really mind-blowing.
Mind-blowing, Sazi, and I think that the only takeaway has to be this is where things are going, and it's here to stay. This is not a pandemic-only trend. As you guys know, just to zoom out a little, I mean, I have thought that the most fascinating business story, and it really encompasses everything we discussed during the pandemic, has been which trends that accelerated or were created during this time will actually remain after the pandemic and which will go away. We can debate separately something like Peloton. Clearly, a lot of investors think that once a vaccine is here, people are going to stop buying Pelotons, they're going to go back to gyms. But the shift from brick and mortar to e-commerce, which of course was already beginning in earnest before the pandemic, is clearly going to stick around. Walmart CEO Doug McMillon basically said that on the earnings call. He said, we're convinced that these trends are going to remain even post-pandemic. And guys, the numbers on this, we mentioned Walmart and Target, those two chains, but let's look at the whole space. E-commerce's share of all US retail spend has gone from 10.6% a year ago to now 14.3% at the end of Q3. I mean, huge surge. And in Europe, by the way, just in the European apparel market, I saw McKinsey put out a study that basically the e-commerce gains have done in just 6 months what should have taken 6 years without the pandemic. Now, of course, the e-commerce share at the end of Q2 was even higher. It was 16% of all US retail, but that's because it was the height of lockdowns. There was no physical retail. And in Q3, a lot of stores reopened.
You know, what's interesting, Dan, about that comment that you brought up from Doug McMillon, it really jumped out to me on the conference call because it certainly is right that it is kind of the way that things are going. But the next sentence was people who begin orders online or shop online spend more, and they spend more in the stores. And this is something that Jeff Bezos has talked about for years. Amazon Prime members spending so much more with Amazon after paying the privilege to spend the money with Amazon. And so it's a double win, I guess, from their perspective here, where not only do we get to meet customers where they are, we actually can encourage them to spend even more because I guess people are slightly less inhibited when they're shopping online.
Yeah, I mean, I think there's a little bit to unpack there. I mean, one thing is that the idea of same-store sales rising along with e-commerce can be misleading. I mean, we're not saying that because of e-commerce rising, all stores will die, although Macy's might, we can talk about that. But there are people who are loyalists. And I think often when they talk about, oh, people who are shopping online are also more likely to buy from us in store, well, it's loyalists who do all their shopping from a place like Target or from Walmart. But you can just see where the puck is headed. I mean, the share is going to shift over to e-commerce. We're at 16%. It's still surprising to some people when you hear that. They think it would be higher. I mean, if you ask the average person, they probably think the e-commerce share is even higher already. But you got to look at the trend line. I mean, one is hockey sticking, one is flat.
Sounds like more Macy's store closures to me. Yahoo Finance editor-at-large, Dan Roberts. Good to see you.
Thanks, guys.
And we will be right back after this short break. Stocks right now are in the red this Friday morning. Thank you, Stephen Mnuchin.
All right, welcome back to Yahoo Finance Live. Miles Upton here in New York. Mixed market in the early going on this Friday, but it's been a big week for the retailers. And Brian Sozzi, I think Macy's is a company here that bears a second mention as we wrap up the biggest week of the year for retailers ahead of the holiday season.
Well, in today's head-scratching moment, Miles, you had Macy's CEO Jeff Gennette on his earnings call yesterday, which I dug through last night because I have no life and that's all I do. He seems to think that his business is like an Amazon, Walmart, and Target in that it is an essential retailer and should not be closed if stores are closed because of the COVID-19 pandemic. Newsflash, they don't sell food. They don't sell a lot of the products we need. Macy's is not an essential retailer. Sorry, but not sorry.
And this coming at a time when a number of states increasing their restrictions on movement. And we are just 1 week away from Black Friday, a banner holiday for a company like a Macy's. Going to be different for them and their peers in this sort of environment. Let's take a quick look at what's going on in markets here. About an hour and a half into today's trading session. Just want to quickly look at S&P sectors right now. 9 of the 11 sectors are in the red in the early going here. All right, that's going to do it for us here on Yahoo Finance Live, the 9 o'clock hour for Brian Sozzi. I am Miles Upton. Over the next couple of hours, Zach Guzman and Akiko Fujita will have you, and we'll see you guys back here 9 o'clock Monday morning.
Welcome into Yahoo Finance Live. Happy Friday, everybody. I'm Zach Guzman alongside Akiko Fujita as stocks remain mixed again today. The Nasdaq breaking into the green a short moment ago. The Dow, the biggest laggard today, still off by about 0.5%. And right now, all but one sector in the S&P currently in the red. Communication services, the lone green wolf at the moment. Investors heading into the weekend digesting the news that Treasury Secretary Steven Mnuchin is pulling the plug on several pandemic lending programs, clashing with Fed Chair Jerome Powell as the U.S. economic recovery here continues to struggle. We'll chat those updates in just a moment. But first, Pfizer and BioNTech making good on their promise to apply for emergency use authorization from the FDA for their COVID vaccine, with that application coming today as cases across the nation approach a record 200,000 per day as the CDC pleads with Americans not to travel this Thanksgiving holiday season. Let's start there with Yahoo Finance's Anjali Kamlani, who has the latest details on the status here with Pfizer and BioNTech's plans to get that FDA approval. And Anjali, I mean, we've seen this research come by quicker than a lot of people expected, and now in the final innings.
That's correct, Zach. There are a lot of things to highlight about this emergency use authorization filing. First of all, of course, with Pfizer being a vaccine company, it's no surprise that they were able to get it this quickly. But BioNTech really adds a different flavor to this filing. And the same goes for Moderna, which we expect will also follow suit shortly, because it's validating that mRNA platform. It's never been tested on the market. So not only are we seeing a vaccine developed in record time, but also on a very new platform. And so that's really important to see just how well it does, of course, for the US broadly and the world. But of course, this filing expected, and we did hear, of course, from them earlier this week after we heard that their vaccine was 95% effective, that they were going to be filing within days. And so right on par this week for that, expecting some sort of information to come out of the FDA in the coming weeks. There is a vaccine advisory committee that needs to meet, as well as the FDA career individuals looking at this to then estimate when it might be out there. We know that states are already setting up to receive shipments before the end of the year, likely for that high priority group, which will include frontline workers, but still more details from the CDC needed in terms of who else will get it after. And then, of course, for the general public, looking at March or April for general public vaccination.
Meantime, Anjali, when you look across the country, no real signs of these infection rates slowing down. We saw more than 187,000 cases reported yesterday. We've seen a number of states implement restrictions. What are you hearing from the doctors you've been speaking to about how effective this is likely to be, just given just the scope of the spread this time around?
Well, Akiko, that's sort of a mixed response, because there are some places doing it right and some places that are not. And this, of course, is a repeat of what we saw earlier this year. We have some states that have statewide curfews and restrictions. California looking at limits and curfews overnight on more than 90% of its population. Meanwhile, you have municipalities like New York City rolling back schooling to remote monitoring. And Illinois just saw a shift to more restrictions after Chicago had already put them in place. And then you see, at the city level, Philadelphia and Newark calling for restrictions and overnight curfews, but nothing really at the state level just yet. So this patchwork, level of restrictions and strategies is really making it harder to curb the pandemic. Meanwhile, in concerning states like South Dakota and Wyoming, which are hitting record numbers across all the metrics, no specific restrictions or strategies there. Meanwhile, in Texas, we know El Paso has done something, but at large, the state hasn't done anything. So once again, health experts are very concerned about what this means in the coming weeks and months, especially as we know, the incoming Biden administration has talked about mask mandates and the like. So that in-between period is really of concern right now.
All right, Anjali Kamani bringing us the latest there on the COVID front. Appreciate that. Let's dig into the updates on the vaccine front a little bit more, though. Of course, Pfizer and BioNTech are the ones first to apply for the emergency use authorization there, but Moderna not far behind after we got those results, both about at that 95% effective rate, well above the 50% threshold the FDA had established earlier. So let's bring on a doctor who is part of that Moderna clinical trial there, and Dr. Reynold Panettiere, professor of medicine at Robert Wood Johnson Medical School. And doctor, appreciate you coming on to chat here today. I mean, we were discussing before the show just the speed in which we got here. I mean, talk to me as a doctor who was part of the research going into this, how surprised you are at the pace that we see ourselves approaching the final chapter.
Yeah, this is truly a remarkable and stunning turn of events. The fact is that we didn't even have the genomic information about the SARS-CoV-2 virus. It was about 9-10 months ago that we finally cloned and had the genetic code. And to go from that instance to deployment of a vaccine within 11 months is warp speed doesn't define. The science behind it, the efficacy, and the speed with which everything's occurring. It's phenomenal.
I've heard you talk about sort of the key differences between what we have seen from Moderna as well as Pfizer, saying that on the one hand, Moderna's development is more significant because it does look across the full data set. And unlike Pfizer, it doesn't require these special freezers. How are you looking at these two developments right now? And more importantly, how do you think the public should be looking at it in terms of how things are likely to be distributed when it does in fact come to market?
So let's be clear, the efficacy signal that we see with Moderna and Pfizer are pretty comparable, pretty amazing too. As it was mentioned earlier, this is an mRNA platform, a platform that effectively has not been leveraged to this extent. So the fact that two companies with two molecules have very similar efficacy is quite encouraging, frankly. Coming back to okay, what happens now? Well, the logistics is really mind-boggling because we're talking about hundreds of millions of people, if you look globally, billions to be vaccinated. You are correct that the Moderna approach doesn't require some of the sophisticated freezing, the minus 96 Fahrenheit that's necessary for the Pfizer vaccine. Some of these logistics could be solved by regional freezer farms that could then serve as the springboard to send the vaccines out. But it is one hurdle, right? It makes it a little more difficult than using the Moderna product, which could be put into any freezer, your home freezer. But remember, the Pfizer freezer is about 5 times colder than anything that you would have in your home.
Doctor, looking at it from the standpoint of administration, not only is distribution a problem, but they are both 2-dose vaccines. And of course, we know the adherence and compliance of that is also going to be a concern. As it stands right now, what are your thoughts on how that can be addressed and whether or not we will see people sort of skip that second dose?
Yeah, that's a very good point. The mRNA vaccines require 2 doses, an initial priming dose and then a booster. And you have to have the 2. You have to have the 2 to have the efficacy. So it is another logistics challenge. I think people realize the severity and the consequences of a COVID-19 infection. So hopefully that will drive an improved adherence, but there's no guarantees. The other more traditional viral vector vaccines, the ones being developed now by Janssen or by Merck or by AstraZeneca, that's more traditional, and certainly the Janssen one's a single dose. But moving forward, I think we have to recognize that adherence can be a stumbling block. There has to be an understanding by individuals that you must get that second dose. It's again another logistics challenge.
Yeah, and we've already seen how hard it's been to even get Americans to wear masks up until this point as well. But doctor, when we talk about the timeline here too, we were just discussing how quick we've moved. But the question now becomes how quickly the FDA is going to want to approve this. In your mind, having seen this all play out, Pfizer says in their release here that they're going to be able to get the vaccine to high-risk populations by the middle to end of December. What does the timeline now look like to you?
Yeah, so just to step back and get a little more granular here, there takes 2 things that the FDA is looking at, right? They're looking at efficacy and safety. So both of those have to align to get the EUA. Now, both companies have done a phenomenal job, actually, in the quality of the studies that have been performed. We were directly involved in the Moderna trial. So very well done studies. I think the data's there, and I think it'll move swiftly through the FDA. Now, getting to your other point, okay, if you have an approved vaccine, where do we go with that? Well, as mentioned, it's going to be frontline workers, healthcare workers predominantly, potentially police, firefighters, as well as EMTs. These are the individuals who get the most exposure. So that's going to be critical. That's going to be critical to get those doses to the patients. The original prediction was that we were going to be nowhere near this year having the opportunity to vaccinate. I think truthfully that we will be vaccinating towards the second week in December. Already the companies are formulating the doses necessary to get this done. How the distribution of the doses will be is likely going to be a state-driven initiative with federal support. And hopefully, as alluded, that the general populace will be injected probably the beginning of the second quarter or towards the end of the first quarter of 2021. But again, this is a massive effort to vaccinate an entire country, not only an entire world.
Yeah, and as we've all been watching this play out, it's been amazing to see the progress and the speed at which it's been achieved, but obviously not completely done yet. But Dr. Reynold Panettiere, a professor of medicine at Robert Wood Johnson Medical School, appreciate you joining us to discuss all that.
Thank you.
I want to shift gears a little bit here as we've been watching the response play out. Yesterday, President-elect Joe Biden had been stressing some of the concerns here in the time that it's taken for his administration to get the data that they need to ensure that the rollout of that vaccine goes smoothly. For more on the questions surrounding that, as well as our economic response here and stimulus questions still up in the air, I want to bring on our next guest, Julian Castro, former Secretary of Housing and Urban Development under President Obama and host of the podcast Our America, joins us now. Secretary Castro, appreciate you coming on to chat with us today. We'll start there, just as we heard the doctor describing some of these challenges in rolling this vaccine out. As a former cabinet member yourself, talk to me about how concerning it is to see this process and the transition here between the Trump administration and President-elect Joe Biden's take this long, and what concerns you have.
Well, it should be concerning to every single American who wants to make sure that they and their family are able to access this vaccine as quickly as possible. There's no question that our scientific community has done a tremendous job of bringing this vaccine to the brink of production and distribution so quickly relative to how long these things usually take. And they deserve a lot of credit for that. But now is the real important part, which is making sure that we're able to get this vaccine distributed in an efficient and effective way. And that's going to require enormous coordination from many agencies within the federal government and states and local communities, healthcare facilities throughout the United States. That means that we don't have a single moment to waste if we want to be effective. So we simply can't tolerate a president of the United States who is determined to put his own ego and hurt feelings above the public health. It boggles the mind that this president has not been able to set aside the fact that he lost this election and is hung up on that instead of allowing the Biden transition team to work with the CDC, with HHS, with these other departments they're going to need to work with so they have a running start and they can make sure that this goes as smoothly as possible for the benefit of the American people that everybody is supposed to be there to serve.
Secretary, let's talk about what's happening on the ground as we await for this vaccine to come to market. We've got more than 180,000 cases reported yesterday, and you've got millions of people out of work. I heard you say recently that you believe Governor Abbott should be tapping into a rainy day fund to help the most vulnerable Texans, but you've also got Congress, which has been dragging its feet for several months now, not acting on a new stimulus bill. And then you've got, in the meantime, 3 million people, or more than that, falling into poverty. And so where do you think the responsibility rests right now? Is it with the local government? Is it with the federal government, especially for those who need the money the most?
You know, I had a lot of hope coming out of the gate in this when the CARES Act was passed, that Republicans in Congress would set aside their partisanship and work with Democrats to make the investments that needed to be made to make sure that people could stay in their homes, that the public health investment dollars were out there to combat this virus. They passed the CARES Act. That money got through. That stimulus money helped people to be able to stay in place and get by at a time when our economy absolutely shut down. But the HEROES Act was then passed, I think, in May, and that's been sitting on the doorstep of Mitch McConnell and the Senate for months now. Washington, D.C. absolutely has the foremost responsibility to make sure that people are not getting evicted right now,
and that public health investment is there. However, because Leader McConnell and the Senate has failed to make that investment, and the White House as well, that means that the states have to be as resourceful and creative as possible. My remarks about Governor Abbott related to the fact that Texas has billions of dollars in what it calls a rainy day fund that it has been saving for the proverbial rainy day. Well, I don't know what could be worse than what we're going through right now, when small businesses are still shuttered, when many people are still out of work in the state, when El Paso is over capacity in terms of its hospital beds, and they're having to use mobile morgues, 10 of them, and prisoners to move the bodies of people who have deceased because of COVID-19 complications. We absolutely need to dedicate those resources to ensuring that people can survive right now. And the state is not doing that. It's failing. In fact, Governor Abbott and other Republican governors seem to have taken this notion that if they just be quiet, if they get out of the way, that they won't get blamed. And politically, they've decided to take that tack. It's absolutely a mistake, and it's leading to more COVID outbreaks and to hospitalizations and deaths in Texas and elsewhere.
If you're talking about just additional help here, obviously you've talked about a number of issues that need to be addressed in a state like Texas. But if we're talking strictly additional help for unemployed Americans, unemployed Texans, those who need it the most, what do you think is the capacity of the state? Are we talking an extra $600, an extra few $100s? What can the state do in the absence of any federal help right now?
The state can do, I think, several things. Number one, early on in this pandemic, the Texas Supreme Court instituted an eviction on moratoriums. That lapsed, so they could do that again, and that would be very helpful. In addition to that, the state can work with cities around Texas, like San Antonio, Dallas, Houston, and others that have implemented their own rental assistance funds. In my home city of San Antonio, they did that to the tune of $25 million. Could go a long way with more state resources to help more people be able to stay in their homes. And also, this is significant, we know it's not just a problem for the renters, it's a problem for the landlords too. Many of those landlords, I mean, they're not huge corporations. They own a duplex, they own a fourplex, they own a single family home that they rent. So their needs need to be addressed as well. The state could help with that. In addition to that, as you suggest, when it comes to unemployment benefits, Texas, like some other states, could top off federal unemployment benefits to ensure that people have enough to get by. That is something that Texas has not done in the way that other states have done, but they have the resources to do it, and they should do it.
And Secretary, I mean, when you address some of those moratoriums on evictions, I mean, we've been hearing reports that even protections that were supposed to be in place through the CARES Act haven't been held up. There was an Arizona Republic investigation into about 8,000 evictions in Maricopa County, obviously a county that was closely watching the election cycle here, about people getting evicted that shouldn't have under those CARES Act protections. About 10% appeared to violate those protections there. So, I mean, talk to me about how some of this just hasn't worked as well as it was expected to in helping people stay in their homes in a pandemic like this.
Oh, no question. We have seen instances like the one that you cited, whether it's in Maricopa County, other places in the country where apparently, there's not enough concern among these judges who are adjudicating these evictions cases and allowing for evictions to take place. It just shows you, look, we're in this system of federalism, and on top of that, in local communities, sometimes these things happen. People run their own show, unfortunately, even when it ends up hurting families desperately in need in the middle of the pandemic. I believe that state attorneys general ought to take an aggressive approach to making sure that these laws, these eviction moratoria are followed where they're in place at the federal level. I also think that instead of just a pronunciation by Donald Trump that there would be an eviction moratorium, the HEROES Act should have been passed by the Senate to extend an eviction moratorium that was in place and to address the needs of people who are paying on a mortgage, so that whether it's FHA insured or relates to FHFA in the private sector, people who are paying on a mortgage have some relief. And they're also not going to find that in a few months, their bank is going to call and say, okay, well, you owe us 7 months worth of your mortgage payment. And that a landlord is not going to call the renter and say, you owe us 7 months of back rent, because then we're truly going to find ourselves with millions of people kicked to the curb with nowhere to go and homeless.
Secretary, let's turn our attention to another thing that you've been quite outspoken about, which is the issue of immigration. As we speak, we're talking about hundreds of children who are still waiting to be reunited with their families, those who are detained at the border. When you ran for president, you campaigned on the issue of decriminalizing unauthorized border crossings. And you look at the makeup of Congress right now, it feels like there's not a whole lot of progress that can be made on this issue of immigration reform. How are you looking at that policy under this new Biden administration? And what would you consider progress? What are some starting points, you think?
Look, I was encouraged to see the transition team and President-elect Biden and Vice President-elect Harris state that reinstating DACA would be one of its very first actions, so that you're providing some relief to millions of dreamers, or about 800,000 dreamers who are in limbo right now and have been a target for the Trump administration. That's good. There are other things they can do immediately. Removing that Muslim travel ban, undoing the migrant protection protocols or Remain in Mexico program that has caused a lot of misery. I'm encouraged that the president-elect has said he's going to form a task force to ensure that all of those 666 children that are still separated from their parents actually get to reunite with their parents. Also, that the ones who are here with their parents get the mental health counseling and other resources that they need to get over that trauma of separation, which is very real. More broadly than that, though, some of this is going to depend on what happens in those 2 Georgia runoffs. Obviously, if Democrats win those 2 Georgia runoffs, there's going to be a lot more running room to get good things done on immigration and other things. But even if that doesn't happen, look, we need to compromise. I'm somebody who fully understands that you're not going to get everything that you want. But it is time to reform our broken immigration laws and to replace the cruelty of the Trump administration with some common sense and with some compassion. Put people on a pathway to citizenship, make sure that we improve the legal immigration system, because that's just as broken. And we want to encourage folks to go through that legal immigration system. Mm-hmm. And there are many different steps that can be taken, both when it comes to undocumented immigration and the legal immigration system, to improve it.
Yeah, a lot of agenda items that the transition team and the administration's going to be pushing through here. But you're right. We'll see how those Georgia races shake out, those runoffs in January. Julian Castro, former Secretary of Housing and Urban Development under President Obama. Appreciate you taking the time to chat today.
Great to be with y'all.
Coming up, the Treasury Secretary pulls the plug on some of the Fed's key lending programs, why Secretary Mnuchin says corporations don't need the money, even as the economic recovery shows signs of slowing. We'll discuss after the break. Welcome back to Yahoo Finance Live. Treasury Secretary Steven Mnuchin saying the Fed still has plenty of firepower left, even as he pulled the plug on some key lending programs from the Fed. Brian Chung is following that story for us. And Brian, it was an interesting back and forth that we saw here in these interviews on CNBC earlier. Chicago Fed President Charles Evans saying that he's disappointed in Mnuchin's decision, which seemed like a pretty strong statement for the Fed, which often doesn't want to be quite political.
Absolutely. When we actually spoke with Richmond Fed President Thomas Barkin before all of this drama unfolded earlier in the week, and he was saying at the time that pulling the Federal Reserve's emergency liquidity facilities was taking a risk. But to back up, we need to understand exactly what's at stake here. So over the last 8 months or so, the Treasury, in addition to the Federal Reserve, have stood up 13 liquidity facilities to backstop everything ranging from the market for risky corporate debt, in addition to municipal bond markets. And the Federal Reserve has set up an expiry date of December 31st in conjunction with the Treasury for a lot of those liquidity facilities. 9 of those 13 liquidity facilities, though, are being directed to close per a letter from Steven Mnuchin to the Federal Reserve yesterday. Now, this is particularly interesting because the Federal Reserve doesn't appear to agree with that particular order from the Treasury. The Federal Reserve clapping back in a very rare rebuke in a statement yesterday, saying that they would prefer that the full suite of emergency facilities established during the coronavirus pandemic continue to serve their important role as a backstop for our still strained and vulnerable economy. So some disagreement between the two major economic policy centers there. We did hear from Steven Mnuchin, as you mentioned this morning on CNBC. He was saying that people are misunderstanding the decision to close down those facilities. He's saying that simply what they're trying to do is reallocate the money that wasn't used in those facilities back into some sort of fiscal stimulus package. Now, of course, we don't know to what degree there's the political willpower on Capitol Hill during this lame duck session to actually get a fiscal package done. And then secondly, we don't know to what degree taking away these backstops may have an effect on the markets once they do expire December 31st. Again, still some disconnect between the Fed and the Treasury. Very interesting to see how this will shake out in the coming weeks.
It certainly will be. Thanks so much for that, Brian. Let's turn to our guest, Emily Rowland. She's a co-chief investment strategist at John Hancock Investment Management. And Emily, you heard Brian sort of lay out the back and forth that we've seen between the Fed and the Treasury over the last 24 hours or so. Secretary Mnuchin saying this morning that the corporations don't need the money anymore, that this money should be reappropriated for programs like the PPP. What do you make of the Treasury's move, first of all, and do you agree with the Secretary?
Yeah, I mean, we were very surprised to hear the backlash here. And, you know, this is a time certainly where you want the chairman of the Federal Reserve and the Treasury Secretary to be working in lockstep as we look at the number of COVID cases rising here. We look at this soft patch that's starting to play out in terms of the economic recovery over the next few months. And, you know, there's some element of Mnuchin's proclamations that's correct in a way. So if we look at the total amount in the primary and secondary corporate credit facilities, about $750 billion was designated for this. And they've only used actually about $30 billion of that total facility. So it was really just the announcement of the creation of these special facilities on March 23rd that actually restored the calm to the fixed income markets and provided that sort of liquidity backstop that markets have reacted to. And you saw, you know, that was the day, we can all look at the charts, that we saw the peak in both high yield and investment grade bond spreads. And we've since seen them, of course, narrow quite meaningfully. I think you could see that narrative shift a bit, particularly as it relates to the high yield bond market. And you might see the Fed kind of move back to the more traditional tools that they've been using throughout this, like QE.
Yeah, that was going to be my question too, because obviously you can have the debate here in terms of how effective some of those policy positions and programs that hadn't really been tapped as much as people thought they would be, what the impact would be in the credit markets when we saw that kind of come off, or the plans announced by Secretary Mnuchin there, because you know, it hadn't proved to be as effective, I guess, than what maybe people were hoping for back in March when all this was starting to just first play out.
Well, I think it was effective in the sense that investors have felt very comfortable embracing corporate credit. But what's been really notable to us is that since March 23rd, spreads have narrowed both in the investment grade and high yield bond space. And I think it's important to remember that, the Fed can do a lot here, and it's been incredibly important what they've done to, again, provide liquidity to the market, but they can't prevent defaults from happening. And we've seen this interesting dynamic in the high yield bond market where spreads continue to come in, yet the forecast for default rates is actually moving higher. That's a very unusual dynamic. We usually see those happen at the same time. So we do think that there are some risks there, that investors actually haven't been adequately rewarded for being invested in the high yield bond area. That's been an underweight for us. We do continue to like investment grade corporate bonds here. The fundamentals are more really sort of appealing to us in that part of the market. But I also think this is a time where you're going to start to see active management become a lot more important in this space as well, as you don't just have that automatic backstop in place. You actually need to do some fundamental credit analysis to start to add value or add alpha in a portfolio.
Having said that, Emily, how do you think that the macro environment is shaping up right now when you look at the increased case counts, the possibility of some of these small businesses having to face closure again, although not probably to the extent they did early on in March and April? There's no question a lot of these businesses are going to be struggling increasingly. How are you looking at that, and how does that shift your investment case?
Yeah, it was a pretty sober analysis from the first couple of guests that you had on today. Not only the work that we still need to do in order to figure out how the vaccine's going to get distributed, who's going to get it, as well as a reminder of some of the really significant challenges that we're seeing right now on the economic front, as we need to recognize how many people are really struggling right now and how worse that might get if we don't get an extension of some of the fiscal stimulus and other benefits that folks have been receiving at the end of the year. So I do think the economy here is in for a bit of a rough patch. We've started to see a real deceleration in the pace of improvement. You look at things like retail sales, which have disappointed. You look at areas like initial jobless claims that just increased after a 4-week decrease just yesterday. Markets are clearly looking past that. We all know that markets are forward-looking. Economic data is backward-looking, and they're pricing in the vaccine and the reopening in 2021. And we want to have some exposure to that. We want to have cyclical areas of the market that will benefit from a reopening in a portfolio. But we also don't think this is the time to completely abandon those more defensive positions. So areas like quality growth that we continue to like. Sectors like consumer staples and healthcare, we still want to own in a portfolio. And we actually think that the reopening narrative and the choppy economic environment over the short term means that a portfolio should really have some of each and really have some balance.
Yeah, some good takeaways there. Emily Rowland, co-chief investment strategist at John Hancock Investment Management. Good to talk to you today.
Thanks for having me.
All right, we're going to take another quick break here on Yahoo Finance Live. But when we return, the rollout PlayStation 5 and the new Xbox out there will spotlight what the impact is on a lot of the game makers and the just constant excitement around that rollout as holiday season approaches. Stay with us. We'll be right back after this. Welcome back to Yahoo Finance Live. Of course, we were discussing earlier this week the rollout of the new gaming consoles and the new Xbox and PlayStation 5, but new data shows the gaming industry was already seeing a strong year even before those came out. And joining us now for more on that is Yahoo Finance's Dan Howley, who has the details on that. Dan?
That's right, Zach. Basically, the gaming industry has seen kind of this massive explosion in growth for 2020, and that's a result of the gaming industry just continuing to grow naturally as more people get into gaming, but also the fact that the pandemic has forced people to find new ways to entertain themselves. And so without something like movies to go to, there's only so much Netflix you can watch. Gaming has really taken off. And so some of the numbers, according to NPD Group, and again, this is before the new console launches, year to date, the gaming industry has pulled in $37.5 billion. That's 20% more than in 2019. And a lot of that is going towards hardware, video games, content themselves. In October, spending was at $3.8 billion. And then as far as hardware goes, which is really interesting, you would expect that hardware sales, as we got closer to November, where Microsoft and Sony were going to launch the Xbox Series X and the PlayStation 5, that you would see kind of console sales peter off. But as a result of the pandemic, that did not happen. And so in October, spending was up 41% to $249 million on hardware itself. And that's year to date is at $2.4 billion, 23% higher than last year. So people are continuing to spend on these despite the fact that those new consoles were coming. And then, of course, the big seller here has been the Nintendo Switch. It's a cheaper console, $299. It can be used on a TV or you can use it in handheld mode. If you can get your hands on it, it offers a lot of great gameplay opportunities. And then one of the big games for that was Animal Crossing. And part of the reason for that was it was a good escape. But, for Nintendo, they've seen the previous best high set for console sales in October. They beat that. That was originally set by the Nintendo Wii. So it looks like that company is kind of on the upswing again after their Wii U debacle. The Nintendo Switch has been doing incredibly well. But, just to see these kinds of numbers out of the gaming industry, you can expect this to continue. As like I said, the new consoles came out earlier this month, and we're going to continue to see this as the winter goes on and people begin to lock down again.
So, Dan, when you talk about a company like Nintendo, as somebody who actually went out and looked for a Switch early on in the pandemic, you couldn't find them anywhere. In many ways, a lot of investors are frustrated that the company wasn't positioned well enough for the big uptick. What are we hearing from these individual companies about inventory, how they've actually shifted up production in anticipation of a huge surge, especially during the holiday season?
Yeah, Nintendo has been pushing out more and more consoles, and they've been raising their estimates for their fiscal year every quarter, just because of how much kind of anticipation there has been for this and the need for people to be entertained. I mean, look, you can't go anywhere anymore now, especially with the winter. Nobody wants to eat outside when it's 30 degrees out. So what you're going to have is more people playing games. So they have boosted the production of those. But look, Microsoft and Sony, botched is too nice of a word in describing the rollouts of their consoles earlier this month. If you try to get your hands on a PlayStation, good luck. They're going for 3 times the value that they really go for on Amazon because scalpers are on there. Ditto the Xbox. When they originally rolled out pre-orders, that was a huge failure. People said that they had them in their cart ready to go, and then their pages would time out. So they need to get on it and step up. I imagine that as we get closer to Black Friday next week, that we'll see more and more of those consoles hit the market. But, as investors look at this and say, aren't these supposed to be big money makers, especially for Sony, which the PlayStation is a big part of its annual revenue. Microsoft obviously has a little thing called Azure and Windows, so they're not as heavily dependent. But, if these companies want to see these consoles do well, you have to make them and make them available. And they're really kind of, falling on their faces when it comes to that.
Yeah, there's a lot of money being left on the table there.
As we were discussing before, Dan, I know you were mad about the fact that, there wasn't a waiting list for these pre-orders. They're just straight up, you can't order right now. And a lot of people were confused about that. But Dan Howley, always impassioned on the gaming front for us. Appreciate you joining us.
All right, we're off for another break. On the other side, we're going to do a quick check of where the markets stand right now as the Dow is down now about 90 points. We'll be right back. Welcome back to Yahoo Finance Live. A split picture on this Friday, just 2 hours into this session, and we're seeing the Dow down about 100 points right now. The Nasdaq, the only one in the green, up 14. Jared Blickery is tracking this for us. And Jared, we're seeing the work from home trade getting a lift again today on the back of that news from Pfizer.
That is right. And also taking a look at some of the leading stocks, pretty interesting here. So Zoom and Peloton are both up over 5%. Peloton's up 3.25%. I was also taking a look at Plantronics, similar ticker there. And if you take a look at the travel space by comparison, lots of red. But what's interesting is Uber here. Now, Uber just made a record high. Let's take a 1 month look. And a lot of times you don't see Uber and Zoom up on the same day because kind of at opposite ends of the spectrum, one lockdown, the other reflation, reopening. But nevertheless, we have seen markets kind of quiet down over the last few days. So I'm not making too much of today's sector action. We take a look at the Nasdaq 100. That's where the only strength really exists right now in terms of the indices. The Nasdaq 100 is up by a whopping 5 basis points here. But Apple and Facebook, those are each down 0.4 and about 0.75% respectively. Tesla in the red here. Just checking in on the EV space. And I'm going to sort by performance and take a look at the 5-day performance. First, I want to take a look at electromechanical vehicle. That is up 357% over the last month, 31% today alone. Then you take a look at green power. That's up 104% over the last month here. Just looking at the 5-day performance, you can see there's been a lot of money entering this space, guys.
A lot of excitement around that EV space, no doubt, not just Tesla, but all those other names as well. Jared Blickery, appreciate you bringing us that. We're going to take another break here on Yahoo Finance Live, but when we return, taking a closer look at adding up all the unemployment numbers. Of course, we saw that unexpectedly tick higher for the first time since October in terms of Americans applying for jobless claims. But what does it mean for the overall recovery? We'll chat that after the break. Stay with us. Welcome back to Yahoo Finance Live. Yesterday, the Department of Labor report showed initial jobless claims rising for the first time since October. And of course, the headline weekly number, but the report gives us a lot more into the look of the shakiness of the recovery here on the unemployment front. How many jobs are still impacted by the pandemic? For more on that, I want to bring on Yahoo Finance's Brian Chung in this week's Yahoo U.
Well, Zach, class is in session, and there's a huge cliff coming, and it has to do with the millions of Americans that are still out of work amid this pandemic. Now, obviously, we all remember the extra $600 a week in unemployment benefits that expired a few months ago back in July. But there are two other really important programs that were passed by the CARES Act that are actually set to expire the day after Christmas. And their expiry could leave millions without help in an economy that may face further shutdowns with the virus cases still surging. So I just want to walk you through what these two programs are. So the first is the Pandemic Unemployment Assistance, or what they call PUA. And this covers workers that can't apply for regular unemployment insurance. So think about gig workers, right? An Uber driver, for example, or maybe a food prep studio technician that's contracted by another company. So they can apply for PUA. Then the second program is called Pandemic Emergency Unemployment Compensation. And this allows people to get another 13 weeks of payments if they've exhausted their 26 weeks of state benefits. Now, it's super important given the fact that 26 weeks is about 6.5 months. And as we know, we're in month 9 of this crisis. So here's how these programs all work together. Don't get intimidated by this. I'll walk you through this flow chart. But states are usually the ones that administer traditional unemployment insurance when there's not a pandemic during normal times. And it usually covers up to 26 weeks. It depends on what state you're in. But with the pandemic, the CARES Act sought to extend that. So they have PEUC right here. And this funds another 13 weeks of federally funded help, again, through this program. After that, the unemployed can turn to extended benefits, or EB, and that would cover another 13 to 20 weeks. Now, PUA factors in here as kind of a second channel here. And again, this is because there are people who can't access that first step because they're gig or contract workers. Now, PUA, interestingly, can also be a reprieve for those who have exhausted kind of the first line of defense here. And after you've gone through PEUC and extended benefits, if you still need help, you could actually then apply after EB to pandemic unemployment assistance here. Now, it's important to know you can't get PUA if you're already at 39 weeks of total unemployment here, because that's the idea, is that the safety net from the CARES Act was really only supposed to cover the period of 9 to 11 months, which is about 39 to 46 weeks. So here we are, though, 9 months later, we still have the worst numbers yet for the pandemic. So it's becoming clear that these programs expiring on December 26th will not cover the need for many people. So here's what's at stake here. This is zooming in on the pandemic unemployment assistance. This shows you the initial claims in purple, and then the pandemic unemployment assistance added on top of that in blue. So for the last few weeks, you can see that the numbers have kind of come down, but they've been plateauing at about 1 million people in total filing for unemployment claims. Again, it's much lower than what we saw at the beginning of the crisis. But what's important to note here is that these are initial claims. It's not the total amount of claims. It means the new people now filing for help. So if you add everything together, as of the end of October, according to the Department of Labor, there were about 8.7 million people in total using this program. That's a lot of people. Now, if we move on to PEUC, again, that extended benefits, as of October 31st, a record 4.4 million were turning to help after running out of regular state unemployment insurance. And the skyrocketing figures that we saw in around September or so kind of makes sense, right? As the pandemic extended past 6 months, I mean, this period is about the 26 weeks or so that covers the initial state unemployment, after which point people had to start turning to this program to get help. So the Progressive Century Foundation had a really interesting report this week. They estimated that 7.3 million workers are set to lose PUA benefits and 4.6 million workers set to lose PEUC, the extended benefits, when both of these programs expire in the end of December, the day after the Christmas. Now, Liz Pancotti, she's one of the authors of the report. I spoke with her earlier this morning. She was telling me that this is a bigger deal than when they lost the $600 a week in extra unemployment back in July, because at the time, at least you know that there was still going to be some sort of unemployment insurance help. It was just a little bit less. But for this instance, when that cliff happens in December, it's not going from $600 extra to a lower amount. It's going from whatever you were getting paid in unemployment insurance to zero. And that could be a really big deal with the amount of unemployment that's still out there, with the amount of COVID cases also hitting new highs, something definitely worth watching in the next few months. Zach, Nico.
We've seen more economists warning exactly about that and what it will do to growth in the coming quarters here. But Brian Chung in Yahoo, you appreciate that.
Coming up, we're going to be taking another check of the markets. We're seeing the work from home trade emerge yet again, potentially on the back of those huge upticks we've seen in COVID cases. Zoom up nearly 6%. We'll check in with Inez Ferre on the other side of the break. Welcome back to Yahoo Finance Live. We are seeing the losses accelerate in this session. The Dow down about 130 points. We're seeing a number of sectors here firmly in the red. Financials as well as industrials, the biggest laggards so far. Let's bring in Inez Ferre for the latest on all the market action. Inez.
And Akiko, just taking a look at the Nasdaq 100, you can see that some of the stay-at-home, work-from-home trades are in the green. The best performers right now being Zoom, up more than 5% today. You've also got Mercado Libre up there, NetEase up here as well. Yesterday, actually, they had great quarterly results. So over the last 2 days, you're seeing that this stock is up almost 9%. But we are seeing the worst performer right now on the Nasdaq 100 being Workday, down about 6%. The software vendor had a strong quarter benefiting from the work at home trend during the pandemic, but it did warn that the pandemic could affect new net bookings demand in 2021. And it's not giving a forecast for fiscal 2022, which begins in February. But still, year to date, you're looking at this stock that's up 31%. I also just want to mention another ticker this morning, and that's Foot Locker. After a better than expected quarter, a strong quarter, down 3%. Same store sales rose 7.7%, and back to school demand was strong, but it's not providing full year guidance. Akiko.
Okay, thanks so much for that, Inez. We've got much more coming up on the next hour of Yahoo Finance Live, including a conversation with the CEO of GoodRx about Amazon's entry into the sector. Much more ahead. We'll be right back. Welcome back to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. It is noon. Pretty flat right now. The only one in the green. The Dow now down about 145 points, and the S&P 500 down 10. U.S. Treasury Secretary Steven Mnuchin pulling the plug on several pandemic lending programs, clashing with Federal Reserve Chair Jerome Powell as the U.S. economy continues to struggle. And Pfizer and BioNTech making good on their promise to apply for emergency use authorization from the FDA for their COVID vaccine, with that application coming today as cases quickly approach a record 200,000 a day. Let's bring in our first guest for the hour. We've got Michael Sheldon, who's RDM's financial group at Hightower CIO. And Michael, it's interesting to see the response to the Pfizer news today, a bit more muted, largely because after that announcement about the efficacy, this was kind of expected. But we are seeing that work from home trade reemerge on the back of concerns of more restrictions coming ahead. How are you looking at all these dynamics playing out?
Well, I think the big news from Pfizer really came out in the markets about a week or so ago when they announced that their drug was going to be available likely before too long, and that it was almost 95% effective. So about a week ago or so, we saw a major rotation in the market into value stocks, away from the stay-at-home into the reopening trades. So that rotation in the market has been sort of going on in the markets over the past few days. One day it's off, one day it's on. I think for our perspective, looking ahead over the next 6 to 12 months, our thinking right now is that you're likely to have several effective vaccines, that Fed policy is likely to remain accommodative, and depending on what happens in Washington, we're likely to have another round of fiscal stimulus, although you never know in Washington. So I think that combination should set the stage for a positive outlook for the economy and the markets as we get into middle of next year, but we do have to get through the next few months first.
And Michael, I mean, it's important to raise those next few months because we've seen cases continue to rise, as Akiko's highlighting off the top there. I mean, when you think about the strategy here and your sector picks, it seems like you are still kind of splitting the difference and focusing on cyclicals in a barbell approach to also include growth stocks as well. It seems a bit strange to see some of these cybersecurity names rally each time we get bad updates on the pandemic front, but that seems to be a new safe sector to watch.
Yeah, I think within our portfolios, we sort of have a barbell approach. Over the past few years, we've been overweight growth, and I think that's still probably the right thing. But we are starting to add a little bit more in the way of parts of the market that may benefit from an economic rebound. It's uncertain to figure out how quickly the economy will really get back on track. Remember, we still have only recaptured 54% of all the jobs lost. Another stat I was looking at the other day is real income this year for the United States is up about 3%, which is a great number. That's a good number. But if you exclude all the transfer payments from Washington, it's actually down 2.2%. So there's still additional work that needs to be done. And we have for that reason, we have a barbell in place where we do have some exposure to growth, but we also have some exposure to some of the reopening trades. And sort of in the middle, we have some healthcare exposure, which is sort of our GARP, or growth at a reasonable price exposure.
Michael, we did get some headlines today on the stimulus front, although it doesn't say much about where things are moving. Treasury Secretary Steven Mnuchin saying that he will continue these talks with Mark Meadows and Mitch McConnell. Well, we've heard from Nancy Pelosi saying that she is still optimistic a bipartisan stimulus bill can be passed. What's the market pricing in at this point? And could it be a potential catalyst if we do, in fact, get something before the end of the year?
I think expectations right now are pretty low that we're going to get anything in this sort of lame duck session in Congress. It seems that most of the legislators are really thinking about going home to Thanksgiving, although hopefully they'll keep socially distanced. But I think really we're talking about early 2021 during the Biden administration, and hopefully the Republicans and Democrats can agree that it's some sort of package to help the states and municipalities, to help the unemployed workers you were just talking about, to help small businesses. Some of that funding is really needed to sort of bridge the gap until the economy gets back in it. So I think early 2021 is the more likely scenario.
Okay, Michael Sheldon joining us from RDM Financial Group at Hightower. Thanks so much for your time today.
Thank you.
Let's turn our attention to another story we have been watching very closely in the healthcare space this week, and that is Amazon's entry into this space. Amazon announcing on Tuesday that it is in fact moving forward with deliveries of a generic as well as brand name drugs, and that we saw a big hit to GoodRx on the back of that. Let's bring in Doug Hirsch. He is the CEO of GoodRx. We've got Anjali Kamlani joining in on the conversation as well. Doug, it's interesting. We were talking to you last Monday. The announcement from Amazon came on Tuesday, and we saw the significant stock move for GoodRx. How significant is this for your business, seeing a giant like Amazon entering the market as much as they signaled over the last several years?
I know it sounds counterintuitive, but it actually is not particularly impactful to our business. And that's because pharmacy is really confusing. And I think Amazon's announcement may have confused a lot of people in terms of what their actual intentions are. What Amazon is trying to do is they're trying to improve their mail order pharmacy, which is called PillPack, which they actually acquired back in 2018. And look, I think Amazon would love to ship your medications to you, but it's really, really hard to do. And today, mail is only about 5% of the prescriptions that Americans take. It's not a one-click experience. And I think Amazon would like it to be, but there's only so much success. Even in COVID, actually, mail has not grown. The part that confused people was also some stuff they did in the retail pharmacy side, which I'm happy to describe if you want.
Well, Doug, let's break it down, right? So we're looking at a number of aspects of this. Number one, yes, it's mail order. Number two, yes, it's a small portion of what prescriptions are filled. And we're also looking at the discount part of it. I think that's what got everyone's attention when it comes to comparing GoodRx. But simultaneously, what others have pointed out is that the likes of CVS, Walgreens, and Rite Aid and other brick and mortar locations, as well as what GoodRx offers, are diversity of products and services. Whether you're talking about the clinics as well as the telehealth side that GoodRx is getting into. So break it down for why it's so different and what you have that separates you from Amazon Pharmacy.
Sure. So again, mail's over here. Amazon's trying. I wish them luck. They're a partner of ours, actually, but it's really, really hard. People have been trying it for literally 20 years and have not got it right. People like going to retail pharmacies. On the retail side, Amazon also partnered with Express Scripts, which has an entity called InsideRx. We actually were the launch partner of InsideRx. And if you were to go to their website, buried deep, deep, deep at the bottom of their website, you'll see that you could theoretically use this discount card at a Walmart or a Walgreens. The reality is Amazon only did that because pharmacies, and this is where pharmacy gets crazy, actually can't control their own prices. They need to use a third party. Otherwise, they violate their insurance contracts. And so Amazon basically is using InsideRx to provide a discounted price that they can show on their website. This does not mean that Amazon expects you to take an Amazon discount card into Walmart. I don't think either of those parties would really be excited about that. Amazon doesn't want you to leave Amazon.com, and Walmart definitely does not want their arch rival showing a better price than Walmart can offer you. So the problem is Amazon needs a third party to show this discount. It's the same in all of healthcare. You can't actually just, if you walk into my pharmacy and I say, hey, I really like you, Anjali, I'm going to give you 50% off, I'm violating all those contracts, right? And so I know it gets complicated and I don't want to bore your listeners too much, but the short answer really is it's not really a plan that Amazon expects to have all these armies of people walking into their arch rivals, by the way, purchasing at a lower price than their arch rival could theoretically offer. The prices also are not great. I should point out, GoodRx Gold, our discount program, has lower prices over 90% of the time than the mail order pharmacy. So I'm honestly not worried about it. I'm actually excited about the opportunity to work not only with Amazon, but all their other competitors, because everyone, would like to act around this news.
Yeah, and that would seem to make sense too. If you look at it as another pharmacy, obviously you guys work with a lot of pharmacies there to kind of present the cost savings you're talking about. Is that what analysts are missing though, is kind of the misappropriation of what's really going on here? Because Deutsche Bank cut their price target in GoodRx, JP Morgan cut their price target as well. JP Morgan, they said that the hit is going to be a 7% bite out of your guys' revenue next year. Growing to 30% by 2024. So, what is being overlooked there in terms of the complementary aspect of Amazon entering the space?
Yeah, first of all, this happened back in 2018 when they did PillPack. Everyone thought pharmacy was over. It obviously wasn't. Back in 2000, drugstore.com, pharmacy was over. It's not. But I think what people saw is they saw the headline of Amazon, and then they saw the bunch of retailers. And they thought, oh my God, Amazon has partnered with Walmart, and Amazon has partnered with CVS and partnered with Walgreens. They did nothing. They literally used a third-party contract, which almost anybody can get, right? And then they buried it at the bottom of the website because they don't really expect or want you to use it, but they need to do it so that they can show a price on when you go to Amazon.com and search for a drug. Now, look, I'm not Amazon. I don't work there. We are close with them, though. They're a great partner in GoodRx's marketplace. I want to emphasize we have 2 billion price points a day in GoodRx. We have the Insider X prices. We have Amazon prices. We have all these prices. So you're never going to find a lower price point than GoodRx. But I really don't expect armies of Amazon users to start marching into Walmart and CVS. And I don't think either of those parties actually think that's a thing either.
Doug, to that point, I think when everyone looks at the potential, the idea is that because of their great logistics, which is what their real power is, that is where some of the real competition comes in, because mail order hasn't been as popular in large part because it's pretty arduous. I know that there were some individuals who tried to sign up saying that it was really easy to do so. So outside of being able to just simply contract with these distributors and wholesalers, what is it that would be necessary, in terms of really building up to really compete? I know some people are bringing up the idea of storage in the warehouses, and especially because some drugs do, like we're seeing with the vaccines, require different storage. That seems to be playing a role in how some people are processing this. What are your thoughts on that?
Yeah, so just to reiterate, I don't see anything changing at retail. On the mail side, you're 100% right. Amazon has an incredible shipping network, and I hope they use that to reduce the cost of prescriptions at mail. Common sense says more people should use mail. The problem is that all sorts of forces arrayed to get in their way. For example, these PBMs, these insurance companies that manage your benefits, often have an exclusive relationship, so you can only get mail through them, right? And you've probably seen that maybe with your own plans. In addition, getting a prescription from someone is really hard. It can take up to 5 days. It's no one-click, shopping kind of experience when it comes to healthcare. And so it's a really difficult thing. I should mention Amazon's not even offering 90-day prescriptions, which makes up a big chunk, because the contracted with the insurance company is basically saying you can't do that, we do that. So there's lots of restrictions. Again, I would like them to succeed. I would love to have drug prices be lower. I would love to show them on GoodRx. But I want to emphasize it's a hard road, and there's plenty of companies out there you can look up today that have low prices at mail, and they're still not winning market share. It's people like to go to the pharmacy, they like to see the pharmacist, they like to pick up their other things. I'm happy to support it, but I think it's going to be hard.
We'll be watching to see how the competition shapes up. Doug Hirsch, the CEO of GoodRx, it's good to talk to you.
Thank you, guys.
Let's turn our attention back to the conversation about stimulus. Senator Kirsten Gillibrand adding her voice to these growing calls from lawmakers to try and get something done on a stimulus package by the end of the year. Our very own Rick Newman speaking to the senator earlier today. He joins us with that conversation. And Rick, I see you're muted, but I also have a strong feeling you want to say something very strong about the Steelers. Is that a Steelers jersey that I see you wearing there?
It's a Pittsburgh Steelers jersey, number 58, Jack Lambert, one of my heroes when I was a kid growing up in the Steel City.
But that's not what you're here to talk about. Yes, we're looking ahead to the NFL, but let's talk about the stimulus, because that is an ongoing conversation. We had a guest on earlier who said, look, in terms of where the market is right now, there's not a whole lot of expectation that there will, in fact, be a stimulus deal done in this lame duck session. What are you hearing from the senator?
Yeah, I asked her the very same tiresome question, because we've been talking about this for literally months now. What's likely to happen? Are we going to get something before the end of 2020, or do we need to wait for the Biden administration to come into office? Here's what you had to say about that.
Well, I certainly hope we can get back to the negotiating table. I've heard from a lot of New Yorkers, and they are truly struggling. People don't have enough food. They don't have any sense that they'll be able to provide for their families in the new year. Unemployment insurance runs out at the end of the year, and they're concerned about whether anything will change. And so we really need relief going to our state. We need money for state and local governments, for healthcare workers, for food stamps, for rental relief, for unemployment insurance, for small businesses, for our restaurants, for all the industries that have been crippled because of COVID.
Overall, I did not take that as a high vote of confidence that something's likely to happen by the end of the year. And part of the problem is the 2020 election is not over yet. We still have these two runoff races for Senate seats in Georgia, and those races are going to determine whether Democrats or Republicans control the Senate. So it seems likely that Congress is not going to get serious about another stimulus bill until we know the outcome there. And then the outcome of those two races is going to go a long way toward determining what that bill looks like. There's a huge gap. As we've been discussing many times, Democrats want around $2 trillion of additional stimulus, and Republicans only want around $500 billion. So Those two Senate races in Georgia are really important.
I mean, no question, a lot's riding on those Senate races. But in the meantime, we're talking about a few months out because that race isn't until January. What are you hearing from the senator about how they're shaping their legislative priorities under this new Biden administration, even with the control of the Senate still in doubt?
Right. So again, this is another reason that those Senate races in Georgia are so important, because if Democrats control the Senate, that means they will be able to control the confirmation process for Biden's cabinet appointments. Very important, because then it's a little more likely he could get some more liberal progressive appointments, which seems very unlikely if Republicans control the process. And then we can talk about, all of Biden's various plans, which are going to be hard to get through, even if Democrats do have a very thin majority. Senator Gillibrand did say there are some areas where there is bipartisan agreement on things like infrastructure, for example, perhaps child care, other legislation. And once there are no more elections to have to look ahead to, they probably can get to some kind of coronavirus stimulus bill. But both sides are just waiting to see who's going to have the leverage after January 5th, which is when those two Georgia races are.
Yeah. In the meantime, millions of Americans still waiting for additional help from the government. Rick Newman, appreciate you bringing us that interview. I want to get to some news that we're getting out of CNBC now, saying that 5 federal agencies have now started telling their employees that they could, in fact, get the vaccine from Pfizer or Moderna in as little as 8 weeks. Certainly significant given the news out of Pfizer today in terms of applying for that FDA emergency authorization. CNBC citing unnamed sources here, but also saying that when you look at the playbook, essentially that the CDC has put out, likely essential federal workers to get the vaccine first. But again, CNBC reporting here that 5 federal agencies have already begun to tell their employees they could get that vaccine from Pfizer and Moderna in as little as 8 weeks. Much more coming ahead here on Yahoo Finance Live. We're going to take a quick break. We'll be right back.
Country continue to spike. The NFL is instituting new safety measures to protect against cases at their 32 teams, including increased testing at practice facilities. Of course, it's only week 11 here, but I don't think it's too early to start talking about the Super Bowl and what plans might look like around there. And a new report from Yahoo Sports is highlighting the fact that tickets there are expected to shoot up quite significantly here. It's been a theme that we've seen play out through the season. And for more on that, I want to bring on Charles Robinson, Yahoo Sports reporter, joins us now. And Charles, I mean, when we look at it, it's been the theme this season because we know that capacity has been constrained in a lot of these stadiums. So what are you expecting to see when we approach Super Bowl time here, and how much it's going to cost?
Well, I can tell you right now, what a lot of people in the market are worried about is that there's going to be a ticket desert. And essentially, with the NFL taking in COVID data as they head into the Super Bowl and potentially limiting capacity at Raymond James Stadium, right now the grid that the league is looking at is somewhere between 10 and 20,000 fans getting into Raymond James Stadium for the Super Bowl. Now that could change. That could dramatically rise. It could lower. They're looking at some of these reports out of Moderna, Pfizer. They're hoping that the vaccine kicks into gear pretty quickly. I think there's a possibility the NFL, if that were to happen, could even look at setting up vaccinations for fans for the Super Bowl if it moves quickly enough for that to happen in February. Now, that seems unlikely, but as it stands, ticket brokers and a lot of people in the ticket industry are sitting there and they're looking at this and they're saying, if capacities are cut, if we have somewhere between 10 and 20,000 fans, and I think they're thinking it's going to be on the lower end of that, the question becomes, what's ever going to make it to the market? The NFL is working right now with its partner NFL On Location to sell a lot of these fan experience packages. But remember, NFL players have a contractual right to purchase 2 tickets. Each and every one of them have a contractual right to purchase 2 tickets from the NFL for the Super Bowl. Most NFL players fulfill that option. That could take as many as 5,000 tickets out of a pool that could only have 12,000 tickets. You remove 5,000 tickets, next thing you know, you're dividing 7,000 tickets amongst sponsors, networks, teams, owners, all these different entities. And so the question is, where does the trickle down happen? This isn't the typical 65,000, 70,000 seat capacity stadium where there's plenty of trickle to get out, and that affects the market. If there's no market, if there are no tickets, that's going to absolutely constrain the ability for people to get anything on that secondary market. And you could see prices, rise to $10,000, $11,000, $12,000, which would be far and away the most pricey Super Bowl in the history of the NFL.
Charles, what about the cost to just make this a safe Super Bowl? You kind of alluded to the fact that they may be looking at potentially vaccinating those who are going to the Super Bowl if that is available. But when you look at how the season has played out so far, there are so many teams that have had to deal with their own outbreaks. What has the league learned from that? And what's your expectation of just how stringent things are going to be for the Super Bowl?
Well, as you said, I mean, it has been sort of a trial and error process. The NFL has 32 hubs out there that not necessarily on game day, but at least in their own facilities with their own personnel are dealing with COVID protocols. So they can not only look at it on a micro level, which is sort of, hey, how do we keep the team safe? How do we keep personnel safe? Reporters, basically everyone orbiting a franchise. And then on a macro level, as you said, there's a handful of teams that have been able to get fans into stadiums. You look at the Dallas Cowboys, they had over 30,000 fans in early November for the home game against the Pittsburgh Steelers. And remember, that's at a time that Texas is on fire with COVID infections, and yet the Dallas Cowboys are ushering in more fans than anyone ever thought was possible in the NFL. So what that's doing is it's giving the NFL an ability to sort of take all of these situations with teams on a case-by-case basis and say, what's the cost outlay for your testing? What's working? What's not working? I think what's interesting, the Kansas City Chiefs for the season opener, fans who were in suites for the Kansas City Chiefs all received a COVID test with their ticket. And they all had to take these COVID tests. And then essentially the medical data that came back was anonymous. It was assigned, each person was assigned a number. And the NFL was essentially alerted. Okay, here's the tickets that were laid out for these suites. Here's the anonymous numbers. Here are the people who tested positive as part of this ticket package. And now they had to reach out and alert they had to have medical officials reach out and alert these fans that, hey, you're positive. Now you can't go to this game. I think at the bare minimum, every single person who ends up in Raymond James Stadium in February is going to be COVID tested.
Yeah, and at the Kansas City game earlier this year, we saw a fan slip through that process too, and the team had to address that all happening too. You think about how many games have been rescheduled this season and how complicated it would be to reschedule the single greatest sporting event in the nation each year, the Super Bowl. No one wants to see that, but we'll see what happens as we get closer. Charles Robinson, Yahoo Sports reporter, appreciate you coming on.
Thanks for having me.
Coming up, college students now bracing for closures yet again as we see the infection numbers rise on the coronavirus across the country. We're going to be speaking to one university president, Jem Specter, the University of Pittsburgh Johnstown president, is going to be joining us on the other side of the break. Well, many universities across the country are facing the prospects of more closures as we see the infection numbers rise on the coronavirus. I want to bring in Jem Specter. He is the president of the University of Pittsburgh Johnstown. We've also got our very own R.T. Swaminathan joining in on this conversation. And Dr. Specter, it's good to talk to you. Certainly a very timely conversation, given that there's a lot of students that are headed to Thanksgiving break right now, not sure whether they're going to be returning to campus. We've seen a number of universities like the State University of New York taking really strict measures here, requiring students to test, for example, before heading out and only allowing them to leave campus if they test negative. How are you looking at this upcoming break and the potential for controlling this virus on your campus?
Well, we've taken diligent efforts to protect our students. Before heading out for Thanksgiving break, students are required to shelter in place for a period of time as a measure to ensure that when they go home, their families will be safe.
And when you talk about that, the families being safe, I mean, how are you expecting classes to resume after Thanksgiving? Or are you sort of looking at what a lot of universities have done is to say, once you go home, classes will not resume, at least in person, until January?
Classes do not resume in person until January. That's correct.
When we're talking about this too, I mean, there have been a lot of concerns about the cases on college campuses, but that hasn't necessarily been the case in this last wave. Obviously, a lot of your efforts seem to be tied to students going home for the Thanksgiving season here. But when you talk about those precautions and testing on campus, what have been the constraints on the testing sideline there in demand for tests and students getting this, and how quickly you can get results back?
Well, we have had a consistent program of poll testing conducted through the University of Pittsburgh, and that has been fairly consistent. And for the most part, the prevalence rate has been very low on our campuses.
Dr. Specter, so when we talk a little bit about state funding and how a lot of states are cutting their budgets, especially for higher education, how does that factor into how you're seeing the next semester go ahead? And we don't know when this virus is going to go away, but has that had an impact on just getting ready with testing and everything?
Well, funding is always a challenge in higher education, but for the most part, the testing regime has been very strong and has been robust throughout the term. And we feel that we have taken very active and proactive measures, I should say, to ensure that students have been safe throughout the semester.
One of the interesting things that has come up when we talk about this health is some of the partnerships that schools are doing with online education. So I'm very curious, what made you take on this decision from your standpoint?
Well, it was an opportunity to partner with a like-minded company as far as the issue of access and the issues of affordability and reduction of student loan debt. Outlier.org is a leader in this space, and Aaron Rasmussen put together a program for frontline workers that can help reduce the burden of taking college credits, especially at this time during the pandemic, for those who are sacrificing so much, the frontline workers, to help us get through this period.
No question, Doctor. There's been a lot of concern around affordability of higher education. That was sort of brought to the forefront at the beginning of the school year when we saw a lot of universities try to incentivize enrollment, giving discounts, for example, in some cases for courses for those who are working full time. How are you looking at enrollment numbers as you head to the second half of the year? Do you expect a drop off given the experience a lot of these students had in their first semester?
Well, our enrollment has been relatively stable, and the experience, while it's been challenging, the students on our campus have, for the most part, acclimated to the circumstances, and they've made the best of it. While it is not the traditional student experience that they've been accustomed to, the faculty, the staff, folks have gone all out to make it the best experience possible, and to convey that sense that we're all in this together and we'll get through it, and this too shall pass.
Yeah, the right attitude, certainly for a lot of students who feel like they're kind of missing out on the usual college experience because of the pandemic. Dr. Jem Specter joining us from the University of Pittsburgh, Johnstown. It's good to talk to you today.
It's been a pleasure. Thank you.
All right, we're going to take another break here on Yahoo Finance Live, but when we return, spotlighting the one luxury retailer here today scoring a big boost on hopes that they could supercharge their e-commerce efforts, as well as a boost from China in the overall sector. We'll spotlight that right after this. Welcome back to Yahoo Finance Live. I want to spotlight shares in the parent company of Versace, Michael Kors, and Jimmy Choo here. Capri Holdings catching a boost today. The company scored an upgrade at BTIG, with analysts there noting that the apparel company has a strong COVID-19 recovery plan, as it shed about $350 million in expenses as well. Digital sales for its luxury brands have also accelerated notably, and that's been one trend here that has separated the winners and losers in the retail space, as well as those who have capitalized on a boost in Chinese luxury shopping there. So let's break down some of the trends that we are seeing play out in retail writ large here with our next guest. Erwin Ramberg is the author of Future Lux, What's Ahead for the Business of Luxury, and he joins us now. Erwin, appreciate you coming on to chat here. I mean, we've been getting earnings reports from a lot of these retailers this week. We're going to get more next week. But what's been your take here on how luxury itself has been impacted? Because we've talked a lot about brands seizing the opportunity on e-commerce, but luxury seems a little bit different when we think about shopping.
Yeah, I think luxury has proven to be a lot more resilient than what people had in mind just a few months ago at the start of this outbreak. I think if you look at the two main nationalities moving the needle, the Chinese have been back now for quite a while. Obviously, it's been a repatriation of growth, but since the months of April or May, speaking to people in Shanghai, they'll tell you that they consider COVID-19 as a vague negative souvenir. I'm based in New York, so obviously it's not the take that I'll have. But Chinese growth has been compounding nicely. And here in the US, if you're a Trump fan, you might talk about a V-shaped recovery. If you're a Biden fan, you might talk about a K-shaped recovery. The reality is similar. If you're a wealthy consumer pre-COVID, you were feeling good about yourself. Now you're feeling even better. So it's a bit counterintuitive, but I think the rebound we're seeing in the US is incredibly steep. It's a combination of things. You've had, historically equity markets quite well correlated to luxury demand in this market. You've had the property market, notably for secondary homes, doing quite well. I don't have the luxury of owning a place in the Hamptons, but if you do, that's gone up quite dramatically over the summer. And then you've had the positive impacts of staycationing. Obviously you can't travel to many places, even within the US right now. And so people have been staying at home. They haven't spent much on, air travel, on fancy hotels, on Michelin star restaurants. And as a consequence, they've freed up quite a bit of spending that is supported for luxury. So again, quite counterintuitive, but I think the rebound you're seeing right now in luxury in the US, it was unexpected and should actually continue into the holiday.
When you talk about the big box retailers, sort of, the Targets and kind of the Walmarts of the world, we've been talking so much about how much digital acceleration has happened. And you could certainly extend that to the huge growth that we've seen in Amazon during this pandemic. How do you think shopping habits have shifted in the luxury sector here? I mean, I'm thinking about somebody purchasing, for example, a $3,000 bag. Are they comfortable sort of just going online and doing it? Or do you think the inability to go into a store because of the restrictions could ultimately hurt some of these retailers?
Yeah, I mean, I happen to cover sporting goods, for example, and a few cosmetics companies. And when Nike tells you eventually more than half of our business will be online, I trust them. If a premium European luxury were to tell me that, I would think, well, either they're not premium luxury or they're taking big risks in terms of brand equity. So, one example is Moncler, the down jacket company, giving out a guidance recently saying, hey, listen, our sales online were about 10% of contribution in 2019. That goes to about 20% eventually over the next 3 years. That seems like a reasonable ballpark. I think it's quite, to your point, the price points are quite different. It's not exactly an everyday purchase. But more importantly, we are still in a sector which is driven by first-time purchases. And if you're a first-time purchaser, which you likely are if you're based in China, and which you might be also if you're based in the US, it's a lot about storytelling, not necessarily the story that the brand tells consumers, but more the story between the consumers themselves. What are you going to tell your girlfriend? What are you going to tell your buddy in terms of your first branded handbag purchase? Unlikely you're going to tell her, I was on a website, I clicked twice, and I got shipped after 24 hours. That's not a story. That's dull. That's boring. So give it some time. We are still in the infancy of recruitment in luxury. Most of the purchases are first-time purchases. Again, going back to the example of Moncler, but it's also true for Gucci, it's true for Cartier, it's true for other brands in the space. What moves the needle is your capacity to recruit. It's great if you can make consumers loyal. It's great if they can come back, but that's not what the market is made up of right now. It's still we're still in a recruitment phase.
Yeah, Erwin, I mean, you talk about that, gifts for loved ones there. I mean, we've seen a lot of counterfeits in Chinatown, obviously here in New York City. That's something you see play out. I'm not sure if that was the gift that my ex got or why she's my ex, because it wasn't a true Michael Kors bag. But I mean, when we're talking about that, clearly knockoffs is a risk in the luxury space. It's why we've seen kind of that pushback in selling through Amazon. The Bain 2020 Fall Luxury Report did highlight, though, the growth in e-commerce sales for a lot of these luxury brands, saying that the shares of purchases made online nearly doubled from 12% last year up to 23% in 2020. So when you're talking about a benchmark for these brands seeing that growth, is that about average that you would want to see from across these luxuries, about 20% or so coming from e-commerce sales?
Yeah, so I think 20% eventually over the next short term, everything was shut, right? So it's higher than that. But let's imagine that we're in a normalized environment. Let's imagine that we're allowed to travel again. I think going, the space going from high single digit to low double digit, contribution of online to 20-25% over the next 3-4 years, that's reasonable. Again, if you tell me we're not in a recruitment phase anymore and we're gradually going to more of a repeat purchase market, then that can go higher. But I don't see that happening before the late 2020s, if I can say. So give it some time. Obviously, contribution to sales of online are going higher. Everyone's talking about Amazon. I think the most interesting reaction I got from a luxury corporate on Amazon, asking him the question, how relevant will it be for you? His answer was to say, ask my successor. And I'm not leaving anytime soon. So, he's basically implying it's going to take more than a decade to actually move the needle. But you are seeing, the deal between Farfetch and Alibaba and Richemont with an injection of cash from Artemis, the holding company of Kering. You're seeing stuff starting to get structured, a bit like in wholesale. You saw a bit of Darwinism. I think online you'll see fewer, stronger players ahead. But again, if the brand is in a recruitment phase, it's not the key priority. It will grow as a percentage of sales, but brick and mortar, even though it might sound counterintuitive today, has great days ahead.
Erwin, when you look at the luxury retailers, I mean, the demand out of China certainly has been a strong one. It's been a good story for these retailers. But one of the things that's created a bit of a bumpy ride for these brands has been the geopolitical element. You saw the pushback against a brand like Canada Goose, for example, even some of the luxury names, as they sort of try to navigate these geopolitical waters anytime China sort of pushes back. And I'm curious how you calculate that risk. Is there a risk to these retailers? Do you think that they're going to continue to go after the Chinese consumer because the demand is just so big? How do you think the calculation has shifted?
Historically, you've had a bit of pushback from Chinese consumers at periods of tension against Japanese brands or against Korean brands. I've actually never really seen it relative to Western brands coming from, most of the luxury brands are basically French, Italian, British, and a few American. There's never been pushback against Tiffany, for example, in China, or pushback against Nike in the sporting goods industry.
But we have seen, for example, Dolce & Gabbana, because of a certain ad that they did. We saw people on Chinese social media posting photos of them burning their own goods.
I'm sorry, I didn't get the gist of your question. I think the gist of your question is, can you have blow-ups and can you have brands mismanage their relationship and basically rub some Chinese consumers the wrong way? Yes. And Dolce & Gabbana is a phenomenal example of a blow-up. And I still think they're struggling to make up for that. Such as you've had a few blow-ups here in the US. Products coming out of Prada or coming out of Gucci, which have been seen as culturally insensitive relative to the African-American consumer here. It all depends on how luxury development includes quite a bit of risk taking. It all depends how you make up for it, how you explain it, how you make amends. And I think, the Dolce & Gabbana example is a textbook example in terms of how to not manage well a crisis. Whereas, if you look at Prada or Gucci here in the US, they managed through very efficiently, very quickly. They apologized and they managed to move on. But honestly, the good thing, if I can say, about the Chinese market is, for the time being, you don't have a lot of local substitutes. So if you're looking to fit in with some family members, with some coworkers, if you're trying to move upwards and onwards, European premium luxury brands are still the way to go. You don't have many local substitutes.
Yeah, and as we know, I mean, that's an important market there. The Bain report showing that it's expected to be the only region to post year-over-year growth in terms of the luxury market. But we'll leave that there for now. Erwin Ramberg, the author of Future Lux, what's ahead for the business of luxury? Appreciate you coming on the chat.
Thanks for having me.
Zach, we're getting some headlines out of Georgia now. Remember, there's been a recount underway on the back of the very close presidential election there. We did hear from the Georgia Secretary of State saying that the state plans to, that the state has certified Joe Biden's win after its audit. The Secretary of State saying Joe Biden did, in fact, beat President Trump in the state by a margin of 12,284 votes. The governor of Georgia set to approve the state's electors on Saturday. And we did hear in that press conference from the Secretary of State saying the numbers don't lie. As Secretary of State, I believe the numbers that we have presented today are correct, and the numbers reflect the verdict of the people. So a bit of news from Georgia there as they wrap up that recount. Coming up, we're going to be talking about Bitcoin. We alluded to that earlier this week, the big surge that we have been seeing there. Dan Roberts will join us on the other side of the break.
Welcome back to Yahoo Finance Live. I want to highlight the market action we're seeing play out here as we approach 1 p.m. Eastern time here in the session. You can see there the Dow off nearly 200 points, the S&P also in the red, Nasdaq Lone Index in the green. For more on those moves, want to get to Yahoo Finance's chart master, Jared Blickery, with the latest. Jared?
Well, after a couple days early this week, which were boom and bust, it looks like that we're going to close with a whimper here. Anything can happen into the close, but you got to imagine traders are getting ready for next week's vacation. A lot of people are already heading out early. Nevertheless, let's take a look at some of the heat maps to see what the big movers are. And we can take a look and see the big caps largely in the red, except for Amazon. That's up 16 basis points. Apple's down 0.4%. Nvidia's off over 1%. But sorting by winners and losers, Zoom is the big leader here, up 6%. Let's take a look at what it's done this week, and we can see up 9%, slowly rising, getting some green on Wednesday, coming into Friday. So we've seen the rotation trade rotate several times this week, and that is par for the course. Moderna up 5% this week, up at 9%, followed by Microchip, NetEase, and Pinduoduo. So a lot of tech names on top here. To the downside, Workday is the biggest loser after reporting earnings after the bell yesterday. That's down 7%, followed by Intuit and Dexcom and Expedia. That's down 2%. Looking at the sector action, we only have two in the green. It's utilities and communication services, which houses Alphabet, Facebook, Netflix, and others. To the downside, energy, the biggest losers, as well as financials. Just taking a quick look at our bank heat map, lots of red there. Wells Fargo off the most, and that is down 2%, guys.
All right, Jared Blicker, appreciate that update there. I also want to spotlight the action we've been talking about all week as Bitcoin inches ever closer here to those record highs that we've seen, getting close to 19K here. I want to bring on Yahoo Finance's Dan Roberts with the latest in the incredible Bitcoin run we've seen. Dan?
Yeah, Zach, Akiko, I'll start by saying, as I always say when the price is running up, that it's never really just one thing. People like to point to one headline, for example, after PayPal came out and said that PayPal will soon allow buying and holding and paying with cryptocurrencies, not just Bitcoin, but a number of cryptocurrencies. Everyone said, okay, price is rising thanks to PayPal. That is certainly one thing that has contributed. But really right now, there's a lot happening. There's a lot of momentum. There's been big institutional adoption over the last couple years. Grayscale, for example, they are a frequent guest on our live shows. They just came out and said that their overall crypto assets now exceed $10 billion under management. Very interesting. They've got a number of different funds. There's PayPal, there's Square, which of course back in 2018, Square started allowing buying and trading of Bitcoin from its Cash App. But also this year, Square went ahead and just invested in $50 million worth of Bitcoin separate from Cash App as an asset on its balance sheet. Paul Tudor Jones, within the last 6 months, a big name on Wall Street, came out and said he's putting 1% of his portfolio into Bitcoin. And just today, the CIO of fixed income at BlackRock came out and said that he believes Bitcoin is durable, that it's here to stay. You're hearing a change in rhetoric from a lot of these people. You're seeing institutions invest something, in many cases, just dipping a toe in. But even that fuels the idea that even if certain firms aren't saying, boy, this is the future, we're all in, they're saying, we believe it's going to stick around. We believe it's here to stay. Now, it's also really interesting, sort of from an inside baseball media perspective, this huge run we're seeing right now, I'd argue has been almost a little quiet in sense of the media. I mean, we all remember exactly 3 years ago, the end of 2017, it was a frenzy of coverage, people freaking out, everyone saying, oh my God, what's happening here? The running joke was that everyone was talking about it with their grandparents at the Thanksgiving table. I don't think that's going to happen this time because of COVID, but it's a little quieter this time. And maybe actually, arguably, that shows that people are less surprised by it. They're more aware that Bitcoin is an asset that exists. Some see it as digital gold, and there's increasing adoption by various companies.
Dan, yeah, I agree with you. 3 years ago, it was impossible to trade Bitcoin. When Bitcoin was hit 18,000, 19,000, it would take 10 minutes, 30 minutes for a transaction to clear. The costs were high. Now it's much more organized. You got institutional involvement, as you've been talking about. Just looking at the charts here, it is up 70% over the last 2 months. And it looks like it's starting to go parabolic. Doesn't mean it has to finish its move anytime soon. But I think for some perspective, just look at the 5-year chart here. We consolidated for 2.5 years. It finally broke out, and now we're getting some momentum to the upside. I have some pretty high targets to the upside, but we'll have to see how this plays out, Dan, guys.
Yeah, I mean, as we've talked about, the run up here has taken a little bit more time too. Perhaps that's why maybe some media outlets have given a little bit less coverage than last time because it's not so sudden, but we'll see where things go. Dan Roberts, appreciate you joining us on that. I want to spotlight one thing too here as we approach the last weekend before Thanksgiving here. Of course, Akiko and I have been talking about travel here. That is one thing. We covered yesterday that the cost of a Thanksgiving dinner down by about 4% to the cheapest we've seen in 2010, but also travel perceivably cheaper, as well as more Americans follow those CDC guidelines to not travel around Thanksgiving this year. AAA report showing that the fall in travel is going to be the largest that we've seen year over year since 2008 during the Great Recession. Skyscanner also showing some airline flights there. When we look into prices and airfares that Americans might be paying, down by as much as 40%, at least when you look at New York to Dallas. Kiko, I'll just pluck that one out of the air because that's the route I'm going to be taking here. But clearly, not just food that's going to be cheaper, but Americans out there who are daring to travel perhaps going to be paying less as well.
Yeah, you pointed to that AAA data. You look at the traffic for travel down about 47.5% compared to this time of year last year. And then there's this chart that they've put out, which I think is quite significant. When you look at the mode of travel for anybody who is traveling during the Thanksgiving holiday, 94% driving to their destination. Of course, there's a lot of concern about airlines, even with a lot of these carriers coming out and saying, look, study after study have in fact it has shown that it is safe to fly. But you got to wonder, with these infections going up, daily case counts now, well over 180,000, whether there in fact are going to be a lot of cancellations going into next week. We heard American Airlines president speak to that earlier this week, saying that with the increase in infection rates, we've seen a dampening of demand. So these airlines, no question, have been hurting as a result of this pandemic. They were certainly looking to make up some of this demand during this period. But, even those who have those tickets getting a little nervous right now as they continue to hear day after day those warnings from doctors and the CDC saying if you don't have to travel, don't do it, because that could lead to more infections.
Yeah, and it's not just air travel. I mean, we're seeing a 50% drop in air travel, but also in that AAA report highlighting the fact that automobile travel also going to be declining by about 4.3% as well. So fears there also very real. That'll do it for Akiko and I here in the 11 to 1. Want to spotlight the action here as we go to break. The Dow's still off by about 200 points. We got much more live action coming your way right after this.
Welcome to Yahoo Finance Live. Happy Friday. I am Kristen Myers. Checking the markets right now, they are a mixed bag. The Nasdaq, the only major index in the green, up over 1/10 of a percentage point right now. The Dow, essentially the laggard on the day, down over 1/2 of a percentage point. The S&P 500 down roughly 1/4 of a percentage point. Markets right now are reacting to rising coronavirus cases, which we will be getting into in just a moment, but also the move from the Treasury not to extend the Fed's emergency lending programs. Now, the Fed had been pressing for an extension. We'll have Yahoo Finance's Brian Chung a little bit later in the show for more details
on that. On a sector basis right now, we are seeing industrials, financials, and technology all in the red. The laggards on the day, industrials down 0.75 percentage point right now. Utilities, healthcare, and communication services, only 3 sectors right now currently in the green. Utilities, the leader on the day, up roughly 0.5 percentage point. Markets are also digesting the news that Pfizer is actually going to be asking for emergency use authorization for their vaccine candidate. As we all remember, that was the vaccine candidate that originally had a 90% efficacy rate. That efficacy rate has now been bumped to 95%, besting Moderna's vaccine candidate. That stock right now is doing well, up 1.3 percentage point right now. I want to take a look over at some of the stay-at-home plays because we've seen them do very well as the coronavirus continues to surge. So let's take a look over at Zoom, up over 6.5% right now. We see Peloton, another stay-at-home play, up over 5% as well. Amazon also in the green today. And on the coronavirus front, currently there are more than 11.7 million positive cases of coronavirus in the country, nearly 11.8. And the death count currently sits at nearly 253,000. This is all according to Johns Hopkins. So let's start the show there with the pandemic and digging into the latest. We're joined now by Dr. Rishi Desai. He's the Chief Medical Officer at Osmosis and a former Center for Disease Control and Prevention Epidemic Intelligence Officer. Doctor, thank you so much for coming back and joining us. Always great to chat with you. I want to start with this news from Pfizer, that we have this request for emergency authorization. They have not yet, however, released any data in a peer-reviewed journal. I'm wondering if this move should be applauded or should we be meeting it with a little bit of skepticism?
Well, there are 2 vaccines, the Pfizer vaccine, the Moderna vaccine, that have been widely announced, both efficacious around 95%. So on the face of that, that's awesome. You know, we've been looking for good news for a long time. This is by definition good news. And in terms of skepticism, what we need to think about next is, so we have a vaccine, we think it works in the lab setting. How is it going to work in the real world setting? That's where you have to think about cold chain. You know, the vaccine has to be kept cool. So you need freezers for that. Do those freezers exist in the offices of doctors and nurses around the country? Well, for Pfizer, you need a really deep, deep freezer. Most folks don't have that. For Moderna, you have a freezer that's actually much more widely available. So that's actually good news on the Moderna side. The other thing is, how long does it stay kind of cool for, and can it be used for a while? The Pfizer vaccine seems like it's roughly 5 days. Moderna is roughly 30 days. So these are logistic issues that we're going to have to figure out in the coming months. So should we be happy? Yeah, absolutely. Should we be skeptical? Yeah, definitely, because we have to now do the hard work of getting this vaccine out from just sitting in a laboratory into people's bodies.
Okay, so I want to pick up on that because you have been pretty critical of the federal government and the leadership underneath President Trump throughout this pandemic. As you were just mentioning, there are some hurdles essentially to this vaccine distribution, not just for how many people need to get it, but just the basic logistics of freezing it, if you can keep it out, et cetera, et cetera. I'm wondering if you have any confidence, because I was reading that this emergency use authorization means that Pfizer could start really rolling out this vaccine as early as next month. So we would still have the current administration essentially in charge of that rollout. Given your criticism, do you have any concerns, any worries about relying on the current federal government, the current administration to roll out this vaccine, given all of those hurdles?
Well, let me put it to you this way. The Trump administration was responsible for getting PPE out. Well, what is PPE? It's a mask. It doesn't need to be kept cold. You can stack it in boxes, in cardboard boxes, and ship it wherever it needs to go. How effective were we at getting the PPE out? Well, those masks, did they get out everywhere? Nope. Did they get out in time? Nope. Do we still have areas in the country where it's hard to get good PPE? Yup. This is months ago, right? So now think about 1 month from now trying to get a vaccine that's never been really gotten out there before. And now you have to keep it cool. It can only stay there for a few days before kind of going bad. How's that going to go? I'm not confident that this administration can do it, just because we know that history is a good predictor of the future.
All right, so I'm going to just, I guess, ask you pretty bluntly, do you think that the Trump administration would bungle any vaccine distribution over the next month or two?
And I'll answer equally bluntly, yes, I do. I think that the fact is that
we haven't seen anything that's been very complicated that's been effectively done by the Trump administration thus far. If they turn it around, that'd be awesome. And do they have the resources? Absolutely they do. Everyone's motivated to get this vaccine out there. And so the business community, the FDA, everyone's motivated to do this. So there's no reason they couldn't do it. But do I think that they will likely bungle it? Absolutely.
I want to move now to the surge that we are currently seeing, because it is getting worse and worse and worse. 11.7, actually, it is almost 11.8 million, I should say, to everyone at home. I believe just yesterday it was 11.4, I think was what I told everyone yesterday. So huge spikes, huge surges that we are seeing here, 170,000 new cases on Wednesday. Where do you think we are going to be by Jan 1 when it comes to this virus, especially because we don't yet have this vaccine being rolled out?
Yeah, you know, the date that I have in my mind is January 20th. That's when there's a new administration that's going to come in. So between now and then is about 2 months, right? So the next 60 days are going to be rough, really rough. I mean, we've already seen the last 60 days have been brutal. So the next 60 are going to be equally brutal. And I don't expect that things are going to get better tomorrow. I think that things are going to continue to get worse tomorrow, the next day after that. And the next 60 days, hopefully, we'll start seeing some positive signs, because then we'll have a better sense of how to get the vaccine out there. But it's winter, Thanksgiving's next week, Christmas is a month after that. So you've got lots of families coming together. Even where the families aren't getting together, people are spending time indoors. Why? Because it's freezing cold in most parts of the country. So people are indoors much more, and that's what the virus likes to do, is infect people inside of households, because that's easier than when you have folks kind of outdoors, and so that's why the summer times are usually better.
So, Doctor, you're picking up on the holiday, and I do want to ask you about that. We've already heard doctors and Dr. Fauci even saying, listen, this year is not the year to gather together with your friends and family for Thanksgiving. It just isn't. It's an unfortunate reality that we're currently facing. However, to your point, as you were saying a little bit earlier, history is a pretty good indicator of the future. And frankly, we saw folks getting together for July 4th. We saw them getting together for Memorial Day. We have seen bars crowded. I've seen on Instagram people going to clubs, apparently partying. So let's just assume that people are going to probably do similar things this holiday. What do you think is going to be happening by the time mid-December rolls around, by the time Christmas rolls around, at least in terms of the cases, but also maybe the deaths and the hospitalizations?
Yeah, both deaths and hospitalizations are creeping up, and our healthcare system is right now in some places teetering on the brink, where you might have to start shutting down hospitals because they simply don't have enough beds, or start kind of thinking back to getting parking lots and things like that opened up again so that you have enough bed space. So we're starting to see that in some areas. And it's really scary, because I know it's going to get worse as people get together for Thanksgiving and Christmas. They're going to do it because they're fatigued. And I get that fatigue. What I would say to folks listening is that we have some good news on the horizon. Come Easter of next year, things should be looking much better than right now. And we didn't know that a month ago. So that's good news.
All right. I want to lastly ask you, before we wrap here, about the school closures and also some lockdowns and restrictions that we are seeing around the country. Wondering from you if school closures is a good idea, but even more broadly, given the reality of where we are and where you say we probably will be after the holiday, given this coronavirus fatigue that we have from so many people, do you think that lockdowns might be something that is definitely coming down the pike if we continue on the path that we are on?
I think a mask mandate and lockdowns are both going to be on the docket for things that we need to do and need to look at as this gets worse.
All right. Well, there it is. Dr. Rishi Desai, Chief Medical Officer at Osmosis and former Center for Disease Control and Prevention Epidemic Intelligence Officer. Doctor, always great chatting with you. Thank you so much for breaking all of that down for us.
Sure thing.
All right. Well, coming up, as we've been discussing, cases of coronavirus are surging. We'll be chatting with the mayor of Miami about it and about its impact on his city next.
Welcome back to Yahoo Finance Live. There were over 9,000 cases of coronavirus in Florida yesterday, with almost 2,000 in Miami-Dade County, which encompasses the city of Miami. We're joined now by Miami Mayor Francis Suarez. Mayor, always good to chat with you. So we've all just been talking about coronavirus and how the cases are surging and spiking around the country. Wondering if you can break down for us how Miami is being impacted right now.
We're just like every other major city in America. We're seeing a surge as well. We had gotten things down by having a mask mandate with fines. We had gotten it down to about 350 cases a day, up from a high of 3,500 cases a day in Miami-Dade County. So we just yesterday had 1,900. So we're rapidly going back towards the high point. Our hospitalizations went from in the low 300s to the mid to upper 500s. So they've almost doubled in a very short period of time. So we're definitely seeing some alarming trends that have us very concerned.
So alarming trends. Are there any plans for any restrictions in Miami? Any lockdowns do you anticipate coming down the pike?
We have an issue with that because our governor, who at the beginning had given us a tremendous amount of local control to basically do whatever it is that we want to do. We were the first city that locked down. We were the first city to implement a mask in public rule. He's taken away our ability to do those things. So I'm hoping to talk to him over the next couple of days and at least impress upon him that as things get worse, to give us back that local control so we have a variety of tools in our toolbox. The one that we saw that was extremely effective was the mask in public rule. We were fining people $150 for not wearing it, and we saw a 90% decrease 2 weeks after we implemented that rule, which is about right with the incubation period. So we're just hopeful that we get that local control because we want to be able to do what we've done before effectively.
So Mayor, I'm really glad that you mentioned that, essentially how you're not really able to do certain things because of Florida's Governor Ron DeSantis. And I want to remind everyone at home, just in case anyone thinks that there's some sort of partisan politics going on here, Mayor Suarez is a Republican, just like the Republican governor in the state of Florida. So I want to ask you, Mayor, do you think that currently Governor DeSantis is essentially hobbling other mayors inside the state of Florida in your attempts to keep residents safe from this virus?
Yeah, look, there's absolutely no disputing that his order prevents us from doing some things that we would like to be doing. There's just it's not a debatable thing. It is what it is. He has a slightly different philosophy than what we have. And, every time I talk to him, we sort of debate back and forth on what we think is the best thing. I think at the end of the day, what I want to press upon him and what I hope I'm able to communicate to him is that, we should have the control that he gave us at the beginning. He was very good about giving us the control to be able to make decisions, and we used it effectively. We did, we're the first ones, again, to have locked down. We were the first ones to implement a mask in public rule. We shut down major events. We're the first city, one of the first cities in America to shut down major events. In anticipation of the coronavirus really taking hold in the city. So we just want the control to be able to make decisions. And we are consulting with the National Coronavirus Task Force with Dr. Fauci and Dr. Birx on a weekly basis. And they agree that we should be methodical in the remediation measures that we take to protect people.
I know that you say that you're essentially have your hands tied by the governor. Is there no room, or what would happen if you decided to essentially flout the governor and say, listen, I'm the mayor of Miami. I know what you said for the state of Florida. I'm going to do what I need to do for the residents in this city. We're going to implement some measures.
Yeah. Well, the problem would be like, let's say, for example, the fining with the masks. Let's say we started fining people and we didn't have the ability to fine people. All they would have to do is sue us. And they would essentially get a court order that prevents us from doing that because it would be prevented by the governor's order. One thing that did get held up was our curfew. We do have a curfew, and the governor's order did, to some extent, there was a debate about whether or not it impacted the curfew. One business sued. And they lost a suit because they were trying to invalidate the curfew. So that is a tool that we still have at our disposal. But other than that, we have very, very little tools. He's increased the capacity of all businesses to 100%, which is obviously an issue for indoor activities. And that's one of the things that we're seeing and that we believe is part of the spread. He also opened up all bars and nightclubs, which were previously closed with his order.
Are you hopeful that once we get a new administration in the White House, that I know what you're saying from the governor, but at least federally on a national level, that there will be some mandates coming down that are going to even supersede what the governor wants or doesn't want inside the state?
You know, for me, this is not political, as you mentioned. It should not be political. I certainly would hope and know some of the people, for example, on the vice president, president-elect's task force. And it's and those people obviously are very, very qualified people, just like Dr. Birx, Dr. Fauci, Dr. Redfield from the CDC, and Dr. Adams, the Surgeon General. So I really enjoyed working with the coronavirus task force, and I know former Surgeon General who's on the vice president's task force as well. And that president-elect, that to me, I think is important, because we need that kind of federal guidance. So that we have sort of a second opinion, if you will, to make sure that, that everything that we're doing is on the right track.
So I want to move now from coronavirus. I'm so grateful that we have so much time to be able to chat with you today, Mayor. So I want to ask you essentially about your perspective on the ground, at least on an economic level. We heard that Treasury Secretary Mnuchin essentially is moving to end the Fed's lending programs, those emergency lending programs. And he's essentially citing improved economic data, right? That these programs aren't really needed. I saw your face react just now. I'm sure everyone did at home. So give us what's happening on the ground. How is the city of Miami doing financially? How are the residents doing financially and economically?
Well, I can just tell you right now, right before this interview, I was with Magic Johnson for a healthcare company that he works with, giving out free turkeys to people in our city for Thanksgiving. And we had 500 cars stacked up, bumper to bumper for several maybe miles. So I can tell you that the need is incredibly great. We also just got our first tranche of CARES money that we put out immediately to small businesses and to residents in our community. And the need far outweighs the supply in terms of help. So I'm not sure what data, Mnuchin is relying on to make that determination. I can tell you on the ground in an urban city like Miami, and I'm sure it's no different in any other major city in America, the need is incredibly great. And people are still struggling because our economy has not come back completely and still has a long way to go.
Now, Mayor, the last time we talked, it was the end of September. So I do want to, lastly, before you go, ask you about the elections. I think people were pretty surprised to see how well, actually, Trump had performed among Latinos in the city of Miami. I wonder if you're thinking that the politics and perhaps the dynamics are changing in the city, that more folks are voting Republican.
What happened, I think, is the president for 4 years, to his credit, systematically came down to Miami and just continued to harp on the issue of socialism. When you look at what happened in Venezuela, when he recognized Guaido, the interim president of Venezuela, his basically rolling back all the Obama era policies with regards to Cuba, he essentially ingratiated himself tremendously with those major communities in this country. And I mean, in this county. And so he did, to his credit, he did a good job. And I think it was just very difficult for the Democrats at that point, after 4 years of the president being president and dealing with those issues in ways that spoke to our residents. It was just too difficult for the Democrats to be able to message around that. And so not only did the president do well in Dade County, where he had lost it in 2016 by 30 points to Hillary Clinton, he ended up losing it by 8 points to President Biden. He did very, very well throughout the entire part of South Florida. And that difference, that basically 300,000 vote difference, is what accounts for the difference between him winning Florida by 100,000 votes in 2016 and him winning Florida by 400,000 votes in 2020.
All right. Always great chatting with you, Miami Mayor Francis Suarez. Thank you so much for joining us today.
Great chatting with you too.
All right. Well, coming up after the break, we will be talking Macy's. Do you guys think that it's an essential business? Their CEO, Jeff Gennett, does. We'll be talking that next. Welcome back to Yahoo Finance Live. Checking market action right now. The S&P 500 and the Dow remain in the red. The Dow, the laggard on the day, down roughly 0.5 percentage point. The S&P 500 down almost 0.2 percentage point. The Nasdaq, the only major index currently in the green, up over 0.1 percentage point. Markets right now are digesting news about surging coronavirus cases. And of course, the Fed having to shut down some of those emergency lending programs in December. We also have some news from Pfizer about seeking emergency use authorization for their vaccine candidate. Pfizer right now up over 1.5%. But I want to talk now about Macy's. Their CEO, Jeff Gennette, saying that their stores are essential businesses during this pandemic. We have Yahoo Finance's Brian Sozzi here with all of those details. Hey, Sozzi. Hey, Kirsten, I don't know if Macy's starts suddenly selling chicken or turkeys or tomato soup, but to me, and I think a lot of other humans out there in the United States, Macy's is not an essential retailer. So these were comments made by Macy's CEO Jeff Gennette on the earnings call yesterday, which is they are now only starting to gain steam for their absolute ridiculously. The stores were closed from March to May at the height of the pandemic. Then they slowly started to reopen. All the 700 plus stores opened in early July. Of course, they're open now. And Jeanette's argument is, you know what? We're essential too. People, I guess, need stocks. They need their $90 bottles of perfume. So that's why they see them as essential retailers. And Kristen, the reality is if these stores are forced to close, Macy's is just not going to be in a good shape next year. They'll be around, but the business could really be severely impacted. I'm surprised to hear you say that because you always love stores closing. You say all of these retailers need to close their stores and move to online anyway. So maybe this is a move that Macy's should be.
This is dope. Well, let's be very clear here. Closing stores is absolutely depressing. Now, Macy's, to their credit, they have a $3 billion unused credit facility. That's good. Over $1 billion in cash. That's cool. That'll keep them in business for a while. But you don't want to see these stores close. Macy's is already closing hundreds of stores. They need a blowout holiday season. I don't think they're going to have it, but you don't want to see the stores close right now for a chain like this. A lot more jobs could be at risk for a company that has been firing thousands of people for about 24 months.
Absolutely. Brick and mortar continuing to struggle. We'll see if they manage to scrape by with that essential rating. We'll be keeping an eye on that. Editor at large, Brian Sozzi, thanks so much for bringing us those details. All right, well, coming up, we will be digging into the Georgia Senate runoff race. Our reporter is live in Georgia with those details. That's next. Welcome back to Yahoo Finance Live. Let's go to Georgia now. The state completed a recount of the votes there, and the results are officially in. President-elect Joe Biden has taken the state, which means that all eyes are now on the Senate runoff races for not one, but both Senate seats inside the state. And if Democrats manage to take them both, they will gain a majority in the Senate. We have Yahoo News national reporter Marquise Francis live in Georgia now with all of the details. Hi, Marquise.
Hey, good afternoon, Kristen. Thanks for that. Yes, I'm in Canton, Georgia, where the vice president actually is speaking right now, joined by Senator David Perdue and Kelly Loeffler. And as you mentioned, Georgia was confirmed to go to President-elect Joe Biden, but President Trump still has not conceded. And just shortly minutes ago, the vice president said the Republican Senate majority could be the last line of defense. And that could is quite, significant because a lot of Republicans here are still not comfortable with the fact of saying Joe Biden has won the state. And I talked to the Secretary of State, a Republican, earlier this week, and he said, look, I'm a Republican. I've voted for Trump twice. I've given him money, but I will make sure that this race is done fairly. Yesterday, I was in Perry, Georgia, where Senators Perdue and Loeffler were joined by Senator Tom Cotton, and they're really making this race a national race. One of the things that they talked about is being the last line of defense. One of Kelly Loeffler's go-to lines is, we are the firewall, Georgia. They're really empowering Georgians to go and vote. And once again, the Secretary of State actually mentioned earlier this week as well, he believes Trump actually lost himself the race by suppressing the votes with these mail-in ballots and discouraging people to do so. So there's definitely been a lot more rhetoric around early voting, getting these mail-in ballots up. And I want to go to a soundbite where Senator Perdue yesterday talked about this being a moment for Republicans. We can play that now.
Every generation seems to have its moment. Our parents, most of us, were members of the Great Generation. My dad and mom lived through the Great Depression, World War II, the Korean War. My dad served in World War II in Europe and in Korea twice. And, they had their moments. So this is ours. This is the moment of the truth. We're the last line of defense. Believe it or not, right now in Georgia, none of us asked for it. I shouldn't have asked for it. Kelly Loeffler didn't ask for this, but here we are. This is our moment of challenge.
Right. So that soundbite is really indicative of what the Republican senators here who are seeking re-election are saying to Georgia voters with this January 5th runoff, which, as you mentioned, really will control the power of Congress. It hasn't been since '92 that Georgia went blue in the presidential election. It's been some time since they've had a Democratic senator, if at all. So there's a lot of stakes on the line right now. They have Vice President Mike Pence in town. He's here. He's going to Gainesville in just a couple of hours. But like you mentioned, all eyes are in Georgia because this is such a pivotal race.
All right. Yahoo News national reporter Marquise Francis on the ground in Georgia, giving us all of those details. Thanks so much, Marquise.
Thank you.
All right. Well, Georgia has officially certified the race for President-elect Joe Biden, as we just heard from Marquise. So let's bring on Yahoo Finance's Rick Newman in his Pittsburgh Steelers jersey. A little bit of a celebration on this Friday.
9-0, baby.
So give us all the details. We have Georgia, we've got Michigan, we've got climate change, we've got a lot to hit with you. So let's start with Georgia.
Well, Georgia's basically over at the presidential level. I think we can just stop talking about it. They did a hand recount, and it very slightly improved the margin of defeat for President Trump. So he gained 0.02 of a percentage point in the gap, but Joe Biden still won. The margin there was very small. It was 0.25 percentage point. But look, Biden flipped Georgia for Democrats. The first time Georgia has voted for a Democrat for president since Bill Clinton in 1992. So now we can now switch channels and go to the drama regarding Michigan, where a few legislatures who have a role in certifying the election outcome there are on their way to the White House to talk with President Trump. And it seems pretty clear that Trump is just trying to find a desperation move to overturn what the voters said they want in Michigan. Joe Biden won Michigan by a couple of percentage points. It wasn't really that close, not as close as in Georgia. But there's this theory that a legislature can refuse to accept the official results from a state and put forward its own slate of electors. This has never been done, to my knowledge, before. It seems like it's technically possible, but an extreme long shot. So President Trump still grasping for some way to win an election he has clearly lost.
So, Rick, I'm wondering if what happened in Georgia might be a nice indicator of what we're going to be seeing in some of these other states that he has continued to challenge. Michigan would be one. He actually invited the Senate Majority Leader, Mike Shirkey, there to the White House today. A lot of folks have said that this is actually undermining the election and the election results, at least in that state. Of course, Michigan did go for President-elect Joe Biden. Wondering what you make of what's going to happen in Michigan.
Let me repeat, Joe Biden won the state of Michigan. This is extreme desperation by Trump. And it seems, I mean, I'm not an election lawyer, but people who are election lawyers say there's essentially no chance he can get this off. And by the way, even let's say Trump even were able to steal Michigan and their electoral votes, it would still not be enough for him to win. He'd still have to steal another 2 or 3 states. And the reason this is all becoming kind of coming to a head right now is these states are now certifying their votes, which makes the final outcomes official. And then the final date for all of this is December 14th, when all of the electors from the states get together and they simply make official the vote tallies that we already know. So Trump is just trying desperately to undermine the outcome of this election in the very last seconds of the game here.
I should mention for everyone that those state legislators also asked Secretary of State Jocelyn Benson to essentially have an independent audit of the election results there. But as we are seeing, these audits do not seem to be moving the needle at all, really, for President Trump, perhaps by a couple hundred or 1,000 votes, but not enough to turn.
And Michigan is not close. We should just make sure people understand. Michigan is not close. There is zero case to say the outcome there in which the voters chose Joe Biden. There's no case to say that's illegitimate.
I want to ask you now about climate change. This is a nice big political roundup here with you, Rick. What's going on there? I know that Biden's got some new senior advisors that folks are saying probably are not going to be friendly to the issue of climate change moving forward.
Yeah, I'm looking into what will the Biden plan be on climate change, and not just what is his plan, because we know what he has said he wants to do, but what will he actually be able to do? So it looks like one of the first moves is likely the announcement of Mary Nichols as his appointee at the Environmental Protection Agency, the EPA. She is the chair of the California Air Resources Board, known as CARB. And CARB, in many cases, California and CARB, they have passed pollution rules and other kinds of environmental rules that are stricter than national standards on auto emissions, for example. She has tangled with the auto industry for years. She does not shy from any fights. And the reporting, Biden has not yet nominated her, but the reporting is that she's likely to be the nominee there. And then Biden's probably going to start doing some things right off the bat through executive actions. He may establish something called a National Climate Council at the White House, which would be a powerful agency similar to the National Security Council or the NSC that has a lot of power to coordinate with agencies and get things done. I think we could look for changes to the Trump rules on auto emissions, perhaps more permits for windmills at sea, and a lot of other stuff by executive action. Of course, Obama needs to get some people in place. We don't know how long that's going to take, but I think climate action is going to be one of the very first things Biden wants to do once he takes office on January 20.
All right, Yahoo Finance's Rick Newman. Thank you so much. Sorry, I can't root for the Steelers, but glad that you did.
Go to 10-0.
All right, well, coming up, we will be talking about the Fed. They are ending their emergency lending program. We'll be talking that next. Welcome back to Yahoo Finance Live. Checking market action right now. The S&P 500 and the Dow remain in the red, actually pairing some of the losses there. The Dow down just over 0.4 of a percentage point. The S&P 500 down just over 0.1 of a percentage point. Nasdaq, the only major index right now in the green, up roughly 0.2 of a percentage point. Well, the Treasury announced a move not to extend several Federal Reserve emergency lending programs. The central bank had been asking for an extension of these programs. So for more details on what's going on, we're joined now by Yahoo Finance's Brian Chung. Hey, Brian.
Hey, Kristen. Well, a lot of moving parts here, but we need to back up and begin with what these liquidity programs even are. For those that aren't familiar, back in March, the CARES Act authorized the Treasury and the Fed $454 billion to use however it felt needed to backstop financial markets to prevent an economic collapse. The Federal Reserve did exactly that. They had 13 liquidity facilities backstopping everything from corporate debt markets to corporate bond markets. And the expiry date for 9 of those 13 programs was December 31st. And obviously we're in November. The question was whether or not the Treasury, which authorizes the use of this money, was going to tell the Federal Reserve to close them down as of that date or extend them longer. We got the stances from both of those parties yesterday. The Treasury sending a letter to the Federal Reserve saying they want 9 of those 13 liquidity facilities to close down as of the end of this year. They authorized an extension of only a few, but those programs that will be closing down concern the municipal liquidity facility, which is backstopped state and local government funding, in addition to the Main Street lending program, the Federal Reserve's ambitious effort to try to offer credit to small and medium-sized businesses. Now, it remains to be seen what's going to happen now, because the Federal Reserve, for its part, has said it doesn't agree with what the Treasury has said there. The Federal Reserve saying in a statement yesterday that they would prefer that the full suite of emergency facilities established during the coronavirus pandemic continue to serve their important role as a backstop for our still strained and vulnerable economy. This is a very pointed statement from a usually pretty vanilla institution where we don't hear things that barbed or different from what the Treasury is saying here. So definitely remarkable that the Federal Reserve is taking that side here. The question is whether or not the Federal Reserve will actually return the money that the Federal Reserve has not used so far. Of course, they are bound to that December 31st expiry now that the Treasury has ordered them to do so, but a very unusual and rare disagreement between the two agents that have really tried to save the economy over the last 8 months.
All right. Yahoo Finance's Fed Whisperer, Brian Chung, thank you so much for breaking all of that down. I want to dig into this just a little bit more now with Keith Fitzgerald. He's the Chief Investment Officer of the Fitzgerald Group. So, Keith, we were just hearing Brian break down some of those details. I was watching you nod along in agreement, at least in regards to the Fed, coming out some pretty strong words, at least strong for the Fed. Treasury Secretary Mnuchin pretty much said, we don't really need to extend these lending programs. He says the markets will be fine. They'll be stable. The economic data is pretty good. What's your reaction here?
Well, I tell you what, I think that Secretary Mnuchin is operating in territory he may not fully understand. We cannot pass a budget. We can't balance a checkbook. We can't even elect the leader of this country without consternation. So to take a program away from the Fed, which normally I think is out to lunch and out of control anyway, this is one of those rare instances where I side with the Fed. The Fed would be prudent to have those things there. Traders know it. Investors know it. I think psychologically, Secretary Mnuchin has made a bad error here. And my fear is that it comes back to bite the markets.
So to that point, I'm wondering what you think the reaction for the markets is going to be in the near term. And just to set the scene for everyone, right, we have these lending programs that are going to be expiring at the end of December. We have coronavirus cases surging throughout the country. We don't have a vaccine yet. We don't have a stimulus yet. And we still have, on some level, an election that is being currently contested. I know that we like to talk about the markets in the longer term. Everyone comes here and says, listen, I have a longer term view. I have a longer term view. But I'm wondering from you, Keith, what is the near term view given all of these headwinds, all of this chaos out there right now? Well, I tell you, that's an excellent question, number one. Number two, that is a long but hardly distinguished list of factors that could negatively give us a nasty end to the year. I think an abundance of caution is relevant. I think that investors should use any kind of pullback we get as an opportunity to focus on companies that are going to make a difference 3, 5, 10 years from now. So I still view the markets optimistically, but I think volatility, the risk here is that volatility accelerates because of the role of computerization, because of all the big money that is going to chase the slightest nuance out of either the Fed or the Treasury Secretary.
Is there at all a chance that investors are going to be able to make a bit of a comeback into the end of the year, especially given the pullbacks that we had seen in September and October?
Well, I tell you what, I believe so. I think that, you've got great companies out there who are succeeding in spite of all that's going on. Companies that are going to be critical to growth, to putting this country back to work. Some of my favorites, for example, are Palantir, Microsoft, Apple. At the other end of the spectrum, I'm looking for JP Morgan, I'm looking for Visa, I'm looking for Pfizer, all of which I own, by the way, full disclosure. But it's a barbell approach to me. You've got to swing the pendulum back and forth between what we have to have and what we're going to need to have to stay out.
So I'm glad you mentioned that, because I want to dig into some of these picks. Looking at Pfizer right now, up over 1.5 of a percentage point right now. I'm wondering what the upside, at least for Pfizer, is beyond that vaccine once it does get rolled out.
I've thought long and hard about that. I don't have a specific number, but I do have the expectation because they have a long, big, broad portfolio of oncology drugs, for example. They are much more than just a vaccine. They've gotten on a lot of people's radar because of the vaccine. But to me, I chose this company early on because of everything else plus the vaccine. It's like getting a full meal deal. You get fries with that sandwich,
So I want to pick up on some of the other picks in a moment, but since you mentioned the vaccine, I do want to ask you about this. We had Pfizer asking for an emergency use authorization, which means we might be getting that vaccine as early as next month. It seems as if we have had some boost to the market every time we've had a new vaccine news, and then the markets have really taken a bit of a pause. I'm wondering how much of a boost or what they anticipate, what the reaction is going to be from the markets once we actually do have those rollouts of this vaccine coming through, even though those rollouts are admittedly going to be facing a lot of hurdles.
Well, my expectation is that the markets are going to go sharply higher. Now, there's going to be a sort of sell the news, buy the rumor phenomenon at work, and there's going to be a lot of profit taking. So it's not going to be a straight line higher. But again, the markets are a future-looking organization, a future-looking organism, for lack of a better term. So knowing that's the case, I think that, again, we're going to be sharply higher into 2021. I think that it could be a year for the record books. The biggest risk that most investors have, frankly, is being trapped on the sidelines or not having enough of the securities they're going to want to own 5 years from now.
So let's go back to the other piece of that barbell. You were mentioning some tech names, Microsoft and Apple, and we have been talking a lot about tech because we have been seeing a rotation out of that sector, folks trimming some of their exposure, at least to those big tech names, the Zooms, the Amazon, Facebook, etc. I'm wondering for you, is the upside there really just in the near term? How much pressure do you think they're going to be coming under next year once the vaccine is being rolled out and folks are starting to anticipate being able to go back to work, go back to the office, see their friends again, and take the mask off?
I think that's a great question. I think that companies like Apple and Microsoft won't come under very much pressure at all because they're growing in spite of all of this. On the other hand, companies like Zoom, for example, which I don't own, companies like Peloton, which I don't own, I think are at tremendous risk because the moment those things roll out and everybody does return, those stocks, which are darlings today, could be a disaster tomorrow.
So I want to ask you now about the jobless claims figures that we had yesterday. They were a little bit disappointing and actually reversed a trend. They came in higher than expectations. And I just want to kind of go back to the economy and some of your expectations here. I know that we have the vaccine kind of floating in the background of everything here. But what are you anticipating if you think that there could perhaps be a reversal, which would be negative in some of the economic data that we have been getting, which is showing that the recovery is continuing, but it is a little bit sluggish. But if you think that we can actually start to see some negative trends coming through as the virus continues to run rampant throughout the country?
Well, if we look at history, if we look at history to our guide, we are going to have an ebb and a flow. It's not just going to be simply snap and we're done with this thing. economic data, particularly if it's government data, can be more cooked than the Christmas goose, frankly. So you got to take it with a big grain of salt. I think you've got to look for the ebbs and flows. It's natural that we're going to get some retracement. People are still concerned. It makes me madder than you know what that our Congress cannot get their act together. America's hurting. This isn't a political issue. This is a get everybody back to work issue. So the question is, how do we do it? I think we're going to have some ebb and flow. It doesn't bother me one bit because long term, there's one thing you don't do, and that's bet against this country.
All right, well, we will leave that there. Always great chatting with you, Keith Fitzgerald, Chief Investment Officer of the Fitzgerald Group. Thanks so much.
Thank you.
All right, well, coming up after the break, we will be talking about the coronavirus and what it's going to mean for the cost of your Thanksgiving dinner. We'll be chatting that next. Welcome back to Yahoo Finance Live. Let's talk now about Thanksgiving, less than a week away from the holiday. And thanks to the coronavirus pandemic, the cost of your Thanksgiving dinner is going to be cheaper, the cheapest it's been in a decade. I want to bring on the original 1 p.m. OG Yahoo Finance's Zach Guzman now with all of those details. Hi, Zach.
Hello, Kristen. Yeah, it's good to be back in this hour. I mean, we were talking about some of those fears in terms of supply here. Not the case when it comes to turkey or the fixings, according to the American Farm Bureau Federation out with their report. Again, they've been tracking this for the last 35 years, and this year's Thanksgiving dinner on an average basis compared to last year's down 4%. As you said, that's the lowest we've seen in about a decade after factoring in all of the fixings there. But the main centerpiece of the table, the turkey, cost less than last year as well. $19.39, the average cost for a 16-pound bird, according to the Federation. That's down about 7% from last year. Of course, you know, maybe other people out there maybe aren't eating turkey for Thanksgiving, but that's the most popular centerpiece. It's what I'm going to be having on my Thanksgiving table. So yeah, Chris, I mean, when we look at it, it's tough to find silver linings this year in 2020 when everyone's Thanksgiving is going to look a little bit different, but at least it will be slightly cheaper.
And good news there, because I know that your article, which I want to direct everyone, is up now on yahoofinance.com in case they want some more details on the cost of Thanksgiving. This is for a 10-person Thanksgiving dinner, which I want to remind everyone is the cap in a lot of states and cities for anyone's Thanksgiving dinner anyway. Zach, I want to ask you now about travel. We've seen the airlines have been heavily impacted throughout this pandemic. Right now, the airlines are in the red. We actually have United down over 2.5% right now. Talk to us about Thanksgiving travel this year.
Well, I mean, we know that the CDC's come out this week, just yesterday, kind of reiterating their recommendation that Americans don't travel in the pandemic as cases continue to rise. But AAA was out last week looking at their Thanksgiving travel forecasts. And even then, before the CDC recommendation, they were forecasting about a 10% decline year over year in total Thanksgiving travel. That would include both flying and driving. When you look into that data, of course, we've been seeing a drop in Americans flying pretty much all year since the pandemic began. But specifically when it comes to Thanksgiving travel, that's expected to be down by about 48% over last year. The share of travel falling dramatically. When you look at airlines versus driving for Thanksgiving, that's also falling pretty considerably, down from 8% share to 4.7% as more Americans shift over to driving for the holiday. But even driving is taking a hit, according to that forecast there, down 4.3% this Thanksgiving versus last Thanksgiving. So clearly Americans taking heed of that advice here from the CDC, perhaps staying at home, not going out to celebrate with family. And we know that that's having an impact on prices. You mentioned the airline stocks trading lower. You can look at some data here. Skyscanner, I asked them for their data in terms of pricing. They've noted that we've seen considerable decline in airfares. When you look at New York City to Dallas, that's the route I'm going to be taking this Thanksgiving. So perhaps some home cooking there in terms of me asking about that flight route. But prices there down about 41% versus last year. Just goes to show the drop in demand clearly having an impact. Perhaps, if you're not going to be eating Thanksgiving dinner, at least cheaper flights out there as well for those willing to brave the travel this year.
All right. Thank you so much, Yahoo Finance's Zach Guzman. It's been very hard to fill the shoes you left behind for 1 p.m. hour. Have a great Thanksgiving, and thank you for that update. Let's do one last look at the markets right now. They remain a mixed bag. The S&P 500 and the Dow continue to be in the red. The Dow, the laggard on the day, down roughly 0.5 percentage point right now. The S&P 500 down about 0.25 percentage point. The Nasdaq paring some of its gains, up right now only 0.1 percentage point. So trying to cling into the green there. Of course, markets are right now reacting to the rising coronavirus cases, as well as that move from the Treasury not to extend some of the Fed's emergency lending programs. We obviously had Yahoo Finance's Brian Chung explaining some of that. But coming up next on Yahoo Finance Live, Alexis Christoforous, and a first on Yahoo Finance, we'll be chatting with Austin Russell, the founder and CEO of Luminar Technologies, on their outlook for doing a SPAC this quarter. And there will be some embargoed news that we'll be breaking. You're not going to want to miss it. That's next. Hello, everyone, and welcome to Yahoo Finance Live. I'm Alexis Christoforous. Stocks are looking to end a choppy week mixed. Encouraging news on the vaccine front this week is being offset by a continued surge in coronavirus infections. We also learned this week that the job market recovery is losing steam, with unemployment claims back on the rise. And the U.S. Treasury announced it will allow several emergency Federal Reserve programs to expire. And that has deflated some of the enthusiasm we've seen surrounding stocks this week. With about 2 hours to go before the closing bell on this Friday, here's where things stand right now. The Dow Industrials off more than 130 points, a loss there of about 0.5%, but the broader market is mixed. Tech stocks holding their own today. The Nasdaq adding about 16 points, and we have the S&P 500 off about 6.5. Jared Blickery here now with the stocks he's keeping his eye on this week. And Jared, I know Boeing has had quite the week. It's been a Dow leader as it prepares to return its beleaguered 737 MAX back in the air. What can you tell us there?
It's about time. A lot of people have been waiting a long time for this. The FAA finally gave a clearing directive yesterday, and Boeing is up 8% on the week, just about off of its highs from Wednesday, but still a decent week. Now, they still have a few more milestones. They got to get the pilots trained. They got to get these planes into service after repairing them. So we're looking at next year at the very earliest. But, you know, I remember a year ago when Dennis Muhlenberg, the prior CEO, said, guess what? Still holding to that December 2019 take for the FAA, or deadline for the FAA to finally release. So here we are. Now, they still have to go through other aviation authorities throughout the world. China yesterday refused to acknowledge the FAA's decision. They said they're going to wait until their own conditions are met. And they were the first to pull the Boeing 737 MAX out of the sky. But we just got news today that it looks like the European Union Aviation Safety Agency is going to give a 28-day public consultation period, and that puts the MAX on track for final clearance by year end or early in next year. Alexis.
All right, also looks like the work from home trade is back on. I know Zoom and Peloton had a tough go of it earlier in the week, but I guess investors are jumping back in now.
Yeah, Zoom is having a nice day. It's up 6.5%. And if we look at the work from home heat map over the last 5 days, we can see a lot of leadership here. Plantronics up 15%, CrowdStrike up over 10%, Twilio, which we were talking about yesterday, one of those software stocks that was up nicely, up 9% for the week. So that's kind of a turn of events. It was last week that Zoom was down about 20%. Now, if you compare that with the reopening trade, and this will only take a second, we'll look at the travel sector just by way of comparison. This is over 5 days, too. And you can see we're sitting on some nice gains for most of these stocks, too. Travelzoo's up 17%, Carnival up over 8%, Southwest up nearly 4%. So we're actually seeing some broad-based gains this week, even though the indices just seem to be treading water.
Want to move away from equities and talk about Bitcoin, which we don't do a lot during this hour. I know it's headed for its best month in something like a year and a half.
Yeah, really incredible price action, finally breaking out of a multi-year trend. And let's take a look at the 5-year chart, and we can see those highs that we had 3 years ago. I remember talking about it with you in our old office, and we finally broke out of this negative trend line, which I will try to draw on here. And it was kind of off to the races eventually. It was a slow start, but now we're accelerating, and we're in line to test those highs potentially very soon. Now, not to get ahead of ourselves, Ethereum also on a nice tear here. Now, it is up over the last month nicely as well. Not near its record highs that we saw in that chart just now, but 37%. So looking at some of the other coins, Litecoin up 75%, Ripple's XRP up 31%. So the crypto space really heating up, and it seems a bit different than this time because we have that institutional involvement and it's not so new to the public anymore.
That's for sure. Also heating up this week, electric vehicle makers, right? You've got Tesla having its biggest week in months, also NIO. I think it's its best week ever.
Yeah, we have a number of stocks here that are having their best weeks ever in the EV space, which is certainly on fire, probably taking a lot of speculative money, maybe a little bit too much on fire. Kind of reminds me of the cannabis space a couple of years ago, but nevertheless, we have, let's see, IRO is up 121% over the last 5 days. And we have Caxin Holdings, that's up 89%. And then Solo, which Citron Research just issued a short report on thinking that it's going to go all the way back to $2. Well, it's up 80% over the last 5 days. If we take a look at what's happened today, pretty strongly off the highs there. But I would say there's going to be a lot more money flowing into the space, but you got to choose your winners and choose them smartly because there are going to be some losers.
Got to pick and choose. All right, thanks, Jared. I want to stick with the markets now and bring in Brian Levitt, global market strategist at Invesco. Brian, good to see you again. I want to talk about this market action we've been seeing over the past week or so. Would you say this is just a healthy pause after what we saw was a pretty vigorous post-election rally?
Yeah, it's a pause as market participants attempt to assess this bit of a tug of war that's going on between some optimism around the vaccine and obvious concerns about rising COVID cases and a potential for further restrictions on the U.S. economy and then, quite frankly, on the global economy. And I think the way investors should think about it is there's likely to be some disappointment in the near term. And things are getting a bit worse relative to expectations. And, that's when you start to see some downward pressure on markets. But for, investors thinking beyond a few weeks or even a few months, we should be focusing on what is likely to be an economic recovery as we progress in 2021 and beyond.
When you look at 2021 and beyond, where are you seeing some of those opportunities? What is sort of the recovery trade as the economy strengthens in the months ahead?
Yeah, recovery trade would be classic. I mean, we're coming from depressed levels, so you would expect interest rates up and the yield curve to steepen. You would expect some pressure on the U.S. dollar, which helps the commodities patch, and then equities over bonds, credit over treasuries, and within the equity market, it's the cyclicals over the defensives. It's smaller and mid cap over larger cap. And it's, dare we say, even the more value oriented parts of the market. It's a classic recovery trade. Now, obviously, it's going to play out with some fits and starts as we're dealing with some of the uncertainty that we're living in right now. But if this recovery takes hold, as most of us suspect it will, then that type of recovery trade would play out.
What do you make of the U.S. Treasury this week coming out and saying it's going to let some of those emergency facility programs from the Federal Reserve expire December 31st? I mean, we saw the Fed do something it really hasn't done much of, which is make a statement objecting to that. They sort of wanted those programs there as a backstop. If they do indeed expire and nothing's there to take their place, what's going to happen to the economy?
Yeah, so it's not helpful to tighten financial conditions during a weak economic recovery. And so it wasn't necessarily the right approach. The good news is if you're watching markets today, we saw the Treasury market rally a bit, but we have not seen financial conditions tighten meaningfully. We've not seen the dollar rally significantly. So the markets are taking it in stride. The reality is some of these facilities were there as, in sort of Hank Paulson's term, you have a bazooka so you don't have to use it. They were there. There wasn't a huge uptake on it. And so they're returning that money perhaps to fund other parts within a fiscal deal. The Federal Reserve is not going to run out of ammunition here. The good news is if you look at the municipal bond market or you look at the corporate market, there's a lot of investors that have insatiable demand for income that are back involved in these markets and expecting an economic recovery. If you were to need additional support, I am very comfortable believing that the Federal Reserve will come up with additional ways to provide support to the markets.
We saw this week unemployment claims rising for the first time in 5 weeks. I know not 1 week doesn't make a trend, but are you concerned at all that the labor market is going to lose steam and then that will start to cascade into a loss in confidence? Consumers might not be as freely to spend in the coming weeks. Are you concerned about that?
Well, let's first stick with the optimism. We've come a long way. Jobless claims have come down meaningfully week by week, and the number of unemployed has come down. So positive signs, but we've got a long way to go. And quite frankly, there's 6.5 million jobs open in this country. Now, there may be some skills mismatch that prevents those jobs from being filled. So there is some optimism to look at. Now, of course, we're dealing with more uncertainty here. We're dealing with greater restrictions. We're likely to see the economy slow. We're likely to see jobless claims pick up. We're probably going to need more fiscal support to bridge us through this. But let's not lose sight of the optimism. Remember what we woke up to on Monday. I think it was Monday. It's hard to even remember at this point with the news from Pfizer, the news from Moderna, the news from AstraZeneca,
95% effective on vaccines, emergency approval pending. And so, there's things to look to suspect that we will see a better environment and we will stage an economic recovery and a jobs recovery. Unfortunately, what we're dealing with right now is this period of uncertainty until we get there.
Sticking with that optimistic outlook, you are out with 10 reasons for investors to be grateful this Thanksgiving, and of course the vaccine news among them. But you also listed shipping, the shipping side of the U.S. economy strengthening as being something we should be grateful for.
Yeah, absolutely. I mean, we've seen the goods sector do quite well. We've seen shipping up pretty significantly. We've seen the trucking industry doing very well. Rail car. I mean, it's this part of the market has been doing very well in this type of an environment because there's a need to get goods to where people are. We're not traveling as frequently. We're not congregating, and I see speaking of shipping, I see the Amazon truck here just about every day, unfortunately. So that part of the market, that part of the economy is doing very well. As you talked about earlier, the at-home part of the economy is doing well. We need to see the reopening trade, the reopening parts of the economy perform better, and we'll ultimately get there. I'd also point to, look at what's going on with Chinese economic activity, and if you don't believe the numbers, take a look at Japanese exports. That's a V-shaped recovery. And so it's proof that if you can compress cases, change human behavior, get some medical or scientific breakthrough, you will stage a recovery. And that should be investors' expectations into 2021.
We'll leave it on that optimistic note. Brian Levitt, Global Market Strategist at Invesco. Thank you and have a good holiday.
Thank you. My pleasure. You too.
Luminar and Intel's Mobileye team up to develop a fleet of robo-taxis. We'll speak with the CEO of Luminar, Austin Russell, next. Luminar Technologies, the self-driving sensor startup that's about to go public, announced today it is teaming up with Intel's Mobileye to develop autonomous vehicles. Joining us now for a first on Yahoo Finance Live is Luminar's founder and CEO, Austin Russell. Austin, good to have you here, and congratulations on this announcement with Intel. This is your third major partnership announcement this year. Tell us how Mobileye is going to use your LiDAR technology in its self-driving cars.
Yeah, absolutely. It's definitely an exciting one in continued acceleration momentum. Just a couple of weeks ago, we announced the Daimler deal, too, for Daimler trucks, and excited to get those on the road. And now with Mobileye, this is a really special partnership here in that sense, just because what we're doing is we're getting our LiDAR designed into their autonomous vehicle platform, so to say. They're calling the AV series solution. And that's where the initial use case they have for that is internally to their own driverless fleet. While in parallel, these guys have been incredible leaders in the assisted driving market, and from that perspective, pretty much owning it altogether. They've shipped tens of millions of product out into the industry. Real deal, and know what it takes to put something into series production. So with this, what's interesting though is that it's not just about their own internal efforts, but also now being able to work with everyone else in the industry as part of the up-leveling from assisted driving to autonomous driving.
You mentioned the Daimler partnership. I know you also have a partnership with Volvo. When do you expect your technology to actually be planned for use in production vehicles?
Yep. So Volvo has been very public about the start of production date for 2022. It's crazy for this kind of thing when it's out of just the R&D phase and going into series production. That's really the thing of where we come into play, of being able to help solve all of these edge cases that are a challenge for autonomous vehicles and allowing them to ultimately get out on the roads. So with that, that's what we've gone all in on Volvo, Daimler, and now Mobileye with. Mobileye has also been public with the 2022 timeline associated with this. So we're gunning for that. The thing is though, is that this stuff doesn't really this doesn't happen in a vacuum. We've had to work with all of these guys for years in advance. In this case, I think it's a Mobileye for the better part of a couple of years, and same with Volvo and Daimler throughout the development process. And now when we're at a stage of when you're getting ready for series production, that's the huge revolution here, and that's what's unique to Luminar. We've been the only ones to actually win these kinds of series production deals for the industry when it comes to autonomy to get these deployments out, and exciting to be able to up-level the space.
You mentioned that you're doing something pretty special and unique there with the LiDAR technology, but there are other companies in the space looking to go public as well via a SPAC. We saw it with Velodyne and also Avaya. Is there enough investor appetite, you think, for LiDAR technology, especially all of it sort of happening at the same time, it seems?
Yeah. No, it's definitely, there's a lot of continuing interest for sure. And, when it comes down to it, I think just as much as we are a LiDAR company, we are, a system level solution as an autonomous vehicle company, and partner to a number of these different major automakers, where we're now working with 7 of the top 10 major OEMs at this stage, towards this vision of series production. And from a development perspective, it's progressing very quickly. So for us, we're particularly focusing in on the consumer vehicle as well as the autonomous trucking market, of course, in the case of Mobileye, they've dominated the landscape when it comes to assisted driving system for consumer vehicles. They know what it means and takes. But really, we're the only solution that can successfully enable autonomy at highway speeds. And that's really key to enabling this to work. Of course, there are other companies, other developments that have happened from a LiDAR perspective. And that's where when during the R&D stage, you don't always necessarily need the capabilities of Luminar off the bat. But when it's time for series production, that's where we really come into play. And for these volume opportunities to be able to solve the problem. So there's no question that I'm sure there'll be a lot of great continued developments, but we're the only ones that meet the spec to actually get into production, and now have the deals and the scale to be able to do so.
You have a pretty compelling story, Austin. I know you dropped out of Stanford at the age of 18 to start this company back in 2012. You're set to go public now in just a couple of weeks with the SPAC, the Special Purpose Acquisition Company, Gore's Metropolis, valuing the company at nearly $3.5 billion. I mean, you're set to become one of the youngest self-made billionaires. When you look back in hindsight, what do you think you've learned, or what would your message be for other up-and-coming entrepreneurs?
Yeah, I would say, it's certainly an exciting time for us. The thing is that there's just a huge amount of work that has to go all this from day one. The amount of blood, sweat, and tears, from all folks involved, and the team has been nothing short of incredibly impressive, and it takes a lot of work. I would say and continue to encourage folks in just the next generation of entrepreneurs to be able to really think deeply about the problems that you want to solve, be passionate about it, and figure out creative solutions in an interdisciplinary capacity to solving problems. Like in this case, we really had to take a blank slate approach about thinking about how you would solve something, like throw out the legacy approaches and how would you do it to be able to have the best possible solution. In our case, it ended up taking, 8 years, from end to end to go through the whole development cycle of this, and we had to bring on a couple hundred highly specialized engineers to build out these different components, and of course a significant capital investment of $250 million that we've put into through this development to be able to get to this stage and now be in this position. So it's a journey, but you have to build it step by step. Continue to encourage people to create. There's a lot of, we were living in the age of consumerism, but I have a huge amount of respect for creators, whatever it may be. And ultimately, some things are just really interesting on their own. Some things are meant to be, businesses. In this case, we went all in on this, and exciting to be out there with it.
Yeah, I know Peter Thiel also backs your vision, also the founder of GoPro. They're two investors in the company. In the 30 seconds I have left, all these partnerships that you've got in the works right now, can you share any timeline on profitability?
Yeah. No, it's a good question. So as it relates to this from a forward-looking order book perspective, this is really a key metric here. And right now in the industry, it's all of stuff in autonomy has been stuck in R&D mode. And for the first time now, we're actually able to translate that into series production to be able to get on these vehicles. And that's where it really made sense from going public perspective. We always talked about that was going to be the first time when you had that strong forward-looking visibility to do that. So with a combination of Volvo, Daimler, Mobileye, and one other undisclosed one, we've actually built up an order book and confirmed this to an estimated 1.3 billion. So that you have some strong visibility there. And then when it comes to the economics for our core business, we actually only needed about 200 to 250 million to get to cash flow positive. But as part of this, we're expected to gross proceeds approaching roughly about 600 million. So we get a ton of strategic capital to be able to continue to accelerate these programs and continue to ramp. And I think you have to lock these things in years in advance. So we have that strong visibility, and from it's a high margin business, and yeah, you could certainly expect that in the coming few years.
All right, Austin Russell, CEO and founder of Luminar Technologies, going public through a SPAC on the Nasdaq, December 3rd. We hope to see you back that day. Congratulations.
Thanks so much.
Coming up, we're going to hear from the local New York sheriff making national headlines for not complying with Governor Cuomo's Thanksgiving mandate. Before we do that, though, I want to get to Emily McCormick, who's been standing by patiently to tell us about Workday. I know that they were out with earnings that beat, but there is a COVID-related warning. Tell us about it, Emily.
That's right, Alexis. So we did see these third quarter results from Workday topping consensus estimates, but looking at that fourth quarter backlog guidance, that did come in weak, actually pointing to a deceleration compared to the growth that Workday had posted earlier this year and in its fiscal third quarter. And that's what really has the street worried. We do see shares of that stock still off more than 7% in intraday trading. Now, heading into earnings, remember that Workday had been one of these software names that had been expected to hold up quite well since it does sell human resources and accounting software for its company customers. So in other words, it was expected to be a beneficiary of the fact that its customers were transitioning to working from home. But with the pandemic, what Workday is really guiding towards is the fact that its small and medium-sized business customers and potential customers are actually being hit to the point where they might not actually be able to invest in some of these services. Now, specifically, Workday said it expects its subscription revenue backlog growth in the current quarter to come in between 14% and 16%. Now, that would be a pretty significant deceleration from what the company reported in the third quarter. That was 23.4% subscription revenue backlog growth. So again, the company here really pointing to that deceleration. Now, more specifically, want to highlight a quote that Chief Financial Officer Robin Sisko said during yesterday's earnings call, saying, quote, "While we have seen some recent stability in the underlying environment, headwinds due to COVID remain, particularly to net new bookings. And given our subscription model, these headwinds that have impacted us all year will be more fully evident in next year's subscription revenue, weighing on our growth in the near term." So a bit of a red flag and some warning signs coming from management there. Now, I also want to highlight what Wall Street analysts have been saying around these results. Analyst Derek Wood of Cowen saying in a note this morning,
warning, quote, "Reaccelerating growth remains tough due to Workday's reliance on new customers, which comprise about 75 to 80% of new bookings, which have been harder to land in this environment," end quote. So a little bit of skepticism here just around what the future might hold for Workday. Again, those shares still have been up strongly for the year to date, up more than 30%, but taking a bit of a hit today because of that guidance, Alexis.
All right, Emily, thank you. And still to come, that local sheriff making national headlines for not complying with Governor Cuomo's Thanksgiving mandate. That's up next. Welcome back to Yahoo Finance Live. One local sheriff is getting national attention after announcing his office will not be enforcing Governor Cuomo's new rules in New York restricting the size of private gatherings and homes on Thanksgiving. Yahoo Finance's Sabine Marcellus got to speak with Sheriff Richard Giardino, and she joins us now. Hi, Sabine. What did he have to say to you?
Hi, Alexis. That's right. So we're seeing across the country planning for Thanksgiving has turned into this anxiety-driven exercise where you have to decide whether you're going to let grandma come or some close friends. And what New York Sheriff Richard Giardino decided is that he is not going to be enforcing Governor Cuomo's executive order limiting Thanksgiving gatherings to 10 people. He said that's unconstitutional and that he doesn't have the resources to police people's homes and count how many cars are in their driveway. Here's what he said to me.
I believe his intent is appropriate. He's trying to do the most he can do to try and stop the spread of CV. But let's talk about CV first. The vast majority of cases, over 97% of the people who contract COVID-19, it's mild and moderate symptoms that go away within 2 to 3 weeks, and then they bounce out of it. These restrictions on what you and who you can have in your home and the number, I believe are unconstitutional. And in order to understand why that's unconstitutional under the 4th, 5th, and 14th Amendment, we have to first look at what is constitutional. For over 100 years, the United States Supreme Court and the law of the land recognizes when you have a public health threat, the government can set certain restrictions on your liberties. And the Bill of Rights and the Constitution say, provide your rights, freedom of speech, freedom of religion, freedom to be safe in your own home, and governmental interest and limits governmental overreach. I believe it's an overreach. The reason, as I started to say, is you look at the original intent. Like if you say masks in public, limit the number of people in restaurants, limit the time you're open, those all are related
to limiting contact, wearing the mask. Most doctors, most medical people agree with washing and all that. So the governor can do that in businesses. He can do it in bars, restaurants, because he's administrative oversight of the health department, the state liquor authority. So with you getting a license for a bar or restaurant and a gym, you also have to abide by the rules, or they can suspend your license, fine you, or revoke your license to operate. You living in your own home, I would argue, is a higher level to breach that sanctity.
Do you believe Governor Cuomo has overstepped his boundaries here by trying to get you to police people inside their homes? And have there been any repercussions? Have you heard from Governor Cuomo about your refusal to abide by his executive order?
I haven't heard from him, but his spokesman has said that sheriffs and police are playing politics by refusing to enforce this. First of all, in the last 6 months, what have we seen across the country? In addition to the rise of COVID virus, we've seen law enforcement under attack for half a dozen acts of police officers that are misconduct. We've had riots, we've had protests, and they're trying to heal that and bring the country together and do police reform. So at the same time we're doing police reform, we're going to send police officers to knock on your door at Thanksgiving.
And what about Christmas? Do you think for the rest of the holiday season that 10-person cap on people having at your home is going to still be in effect? And what would you do about that?
I think it's still going to be in effect, but I would argue two things. People in my community are adults. They paid attention. We have a very low rate. Most of them are wearing their masks. County-wise, we have a very low rate, knock on wood. But I think that there's a difference between people having 600 or let's say 50 people in their backyard raising a ruckus. But in your home, if you choose to have 15, 20, or 25 of your family and friends, and you have elderly family members, sick, or people who are high risk, either choose then to not have a big event on your own. But I don't think that it's appropriate to be told you can't have such events. I also think that we don't. I have 3 deputies for 500 square miles on a shift, and 55,000 people. I can't be entering everyone's home or counting cars. Also, Sabine, what's interesting is a few sheriffs started early on last week about this, and now local police chiefs, town police chiefs, and more sheriffs are standing up and saying we don't have the resources and we don't have the legal authority to be enforcing an executive order of this nature.
And how have you enforced the business restrictions? For example, the 10 p.m. curfew on restaurants. Have businesses given you a hard time? Have you given tickets, arrests? What does it look like?
Most businesses have been pretty good. There's some that I get multiple complaints. We call them. We explain that the health department can shut them down or fine them. We talk to the owners or the managers. I've had several businesses. We don't have a lot of people, so if I get a complaint, I'll personally make a phone call and say, can you post a sign that you got to be 6 feet away? Can you post a sign not coming in without a mask? And that's been pretty successful. The one area that I've opposed against the governor is he said in a press conference early on, he said, if you see somebody without a mask, please approach him and ask him to wear one. Well, we've had 2 incidents in New York. One was an 18-year-old kid who was kicked in the face at a convenience store by a parolee when he approached him and asked him to wear a mask. So I publicly stated it's not a good idea to approach people and ask them to wear a mask. I think people can make their own decision as to a risk-reward situation. And I do think that people should take precautions, and I do think it's a serious disease. I just oppose the fact that it's the governor overreaching with an executive order to try to get into somebody's home and to make the law enforcement, have to do the dirty work, so to speak.
And looking at the situation nationwide, what are your thoughts on the new restrictions being reimposed on businesses? And do you think it's a waste of time for law enforcement to have to deal with these new restrictions, given that there are already the social distancing and mask guidelines?
I think that the reimposing of some of the restrictions is necessary in the general public areas and businesses and schools. A lot of counties and now in a lot of states are starting to shut down the schools permanently instead of mixed virtual. So I think we're going to see the spread continue. They always said it was going to get worse, but I think we still have to remember that the vast majority of people recover. 97% or more mild situation, they recover. I think the businesses and the damage done to social isolation and to some of these restrictions is not repairable. We have a doubling of mental health calls in our county and in many states. Mental health calls are skyrocketing. We also have a surge of domestic violence. And a lot of this is due to loss of jobs, furlough, fear that they're going to lose their mortgage, even though there's a halt on mortgages and rent. But what about the landlords? Every time you say that, okay, there's a ton of people that live in the apartment house don't have to pay rent, you got a landlord who's got to pay his mortgage and his bills or her bills, and it's affecting them. I think that the mental and the anxiety and the mental health issues that are raised by doing this or exacerbated to other people are going to be much longer term damage and much deeper than getting a mild flu and getting out of it for most people.
Well, it's definitely important to weigh all the risks as we deal with these new restrictions. Sheriff Richard Giardino, it's great to have you on. Thanks so much.
Thank you very much for having me. You have a nice Thanksgiving, all 10 of you.
And there, Alexis, you basically see the sheriff, making fun a little bit about that 10-person limit, but he says that he expects it to still be in place come Christmas.
All right, really insightful interview, and he was definitely very candid. Thanks a lot, Sabeel. Coming up, we get a read on the travel industry as we move closer to Thanksgiving. The oil market closed just moments ago. Jared Blickery here for a look at how things settled. Jared?
Yeah, we settled up nearly 1% to the highest settlement level in about 2.5 months. You'd have to go back to early September to see these levels. So been a nice run for crude oil. And let's just take a look at the charts here and talking about some of the factors. Still don't have any incremental news on OPEC Plus and their decision on whether or not they're going to extend those production cuts into next year by potentially 3 to 6 months. No developments with respect to the UAE either, kind of backpedaling from its from reports that said it wants to withdraw from the cartel as well. Here's a look at the last 3 months, and you can see we have been flagging. This is very similar to some of the indices, the stock indices that we track day to day, and we are above $42 per barrel. And if you look at the year to date, kind of entering the territory, or at least potentially to test those highs that we saw many, many months ago, even before the COVID era. So positive development for crude oil here, a lot of it on the back of hopes for reopening and the successful reopenings that we're seeing over in Asia, but remains to be seen what the lockdowns that we're facing here in the US and in Europe, those renewed lockdowns and pauses, what have you, what effects those are going to have on demand going forward.
All right, thanks, Jared. The recovery for the battered travel industry was put on ice this week after the CDC strongly urged Americans not to travel for Thanksgiving. It's one of the sharpest warnings to date as the number of COVID-19 cases and deaths continue to rise. Joining us now is David Steinberg, founder and CEO of Zeta Global. We're also joined by Yahoo Finance's Alexis Keenan. Thanks to you both for being here. So, David, what are you seeing right now in terms of air travel and hotel bookings as we move closer to the Thanksgiving holiday?
You know, as you would expect, Alexa, the news is not good, right? We're seeing across the board where we were starting to see recoveries in both foot traffic in airports, bookings of tickets, and traffic on websites associated with research travel and research booking. All of those have changed course pretty radically over the last week. And we're seeing things now really not just down from what was starting to be a bit of a recovery, but down from what was even a few weeks ago.
David, Alexis here, Alexis Keenan, that is. Want to ask you about some of the numbers that you shared with us and that will show our viewers. You have tracked the airport traffic from October all the way through the current time, and it shows that it's down year over year overall 57 to 63%, and then some breakdowns with the Northeast having much less traffic, that is, compared to the West and Southeast and the Midwest and the Southwest. Also, some recent activity that you were just talking about showing 7 to 15% down just over the last few weeks. And also comparing that to what TSA is anticipating, CBS says that TSA is planning for 6 million travelers over the week of Thanksgiving. And if we just look at last year at the same exact time, they had 26 million travelers. So compared to your data and what they're planning for, are they on target for the right number, or is that overdoing it?
Well, I would say that, you know, there's not going to be long wait times this year, you know, as it relates to travel, which is sort of one perk. But no, as I think you so eloquently pointed out, we're seeing across the board cuts. The deepest is in the Northeast, foot traffic in airports, down 80% year over year. You know, the least shrinkage is in the Southeast, which is about 68%. And as we said, these were all starting to recover a few weeks ago. We're now seeing these come down fairly dramatically. You know, I think TSA is doing the best they can to try to estimate what's going to be there. But I think that if we had almost 30 million travelers last year over Thanksgiving, my guess is we're going to see a minimum of a 70 to 80% shrinkage this year.
Wow, David, do you think that one of the beneficiaries here could be the car rental companies? Because people who are going to take trips, they're going to be shorter, local trips they can drive to, and they're going to want to do it in their own sort of sealed-in environment, if you will.
Yeah, great question, Alexa C. I think that the real, you know, the guys who are going to lose less, I hate to use the term winner around travel, hospitality, or entertainment in today's world. I mean, that's a vertical that is just really getting hammered, is car rental companies. The other sort of good news is we're starting to see a moderate uptick in the research site traffic around luxury hotels. And that is then relating to people going to the booking sites that are going to luxury hotels, which I think is dead on for your point. I think there are people who just want to get away. I think they're going to rent a car. I think they're going to go to properties that are within 50 miles of where they live. And I think they're going to check into more luxury properties, because they're probably not traveling as much, so they have a little more travel budget there. And B, I think there's a real perception on what we're seeing that luxury properties are going to be cleaner and safer. I'm not suggesting that to be the case. I'm simply saying I think that's the perception of that. And I think we'll see a faster rebound in rental cars. Absolutely, especially in major cities where people are trying to sort of get away from there, and more luxury hotel properties.
David, quickly, American Hotel and Lodging Association, they say that according to their research, 70% of Americans say they're not going to travel at all. Does that match what your data shows?
It does, but if you're looking at 70% not traveling, and we're looking at 80 to 90% decreases in airports, it does sort of bode well that the sort of one pocket of potential opportunity would be closed. For example, I would not want to own a luxury travel property on an island right now, right? I mean, I'd want to be sort of within a range of a large metropolitan service area where people are trying to feel like some level of normalcy. And back to the last segment, whether people are going to be 10 people, 15 people, 20 people, I do think the perception is that people are going to have smaller Thanksgivings. So, one of the funny statistics we were looking at was the downgrading of sales of turkeys above 20 pounds, right? So you could start to look at those types of things. I do think people are going to stay in hotels. I was sort of joking with my wife. I'm sort of glad we're only going to have 10 people this year, less sort of fighting with the political climate. But in all seriousness, I think that we're going to see hotels and rental car companies have less shrinkage. Airlines have more shrinkage. And I think they're going to continue to be challenged until we can sort of get back to some level of normalcy.
Yeah, I already bought my smaller turkey. So I hear you. David Steinberg, founder and CEO of Zeta Global, and Alexis Keenan, thank you.
Thank you very much.
Owner of the New York City restaurant that will soon require a COVID-19 test to dine there. We'll be right back. In what may be a first for a New York City restaurant, City Winery will soon require all customers to take a rapid coronavirus test at the door before being allowed to eat inside 2 days a week. Joining me now is City Winery's founder and CEO, Michael Dorf. Michael, good to have you here. Walk us through how this test-to-table dining is going to work.
Well, we're going to pilot this on Tuesday and Wednesday next week. We're not confirmed that we're going to do this every night. And in fact, we're not even sure if the state is going to allow us to have any indoor dining next week. We're all getting nervous about the recent closures happening in the city. But we're going for the safest test that we can come up with. We're keeping every other
protocol in place, the mask wearing all the way to the table, and when you're interfacing with our staff, the temperature check and the survey we're doing at the front door. So everything that we're doing today, we're keeping in place. We're just going to try Tuesday and Wednesday a rapid antigen test at the front door. It costs $50, which is actually a little less than it's costing us. So it's expensive right now. And you do get a glass of champagne while you wait the 10 to 12 minutes for your results. Only negative results will be able to come in. If you're positive, we're going to recommend a further test for you to take, and those are usually 24 to 48 hours for a deeper nasal test. Mm-hmm. But the negative test takers on the rapid test will be allowed in, and we feel we've created then a bubble of a little more safety. I mean, nothing is perfect, but this virus is tricky, but this is the state of the art. We've hired a company that has a certified practitioner nurse who will be administering the tests, and it goes through a machine, and it's the safest way we can see creating a hospitality experience in New York right now.
Michael, some might say this is a little aggressive or invasive. They might say it's a little expensive. Why are you deciding to do this? As far as I know, you're the only restaurant doing this in the city right now.
Well, it is expensive, and I really wish the tests were cheaper. I wish they were paid for by the state or city. Actually, I think our insurance companies should be the ones paying for it, since they continued to not pay any business interruption insurance, and they're keeping all of our liability premiums full, even though we have very little risk because half of our locations are closed. Or a philanthropist, who knows? But right now, no one is except for us. So we're basically splitting it with our consumer. This is better than having no one in the facility or being closed. While we had warm enough weather to have outdoor dining, us restaurants were able to at least serve some people. But as we know, in the last couple of days, it's gotten colder. And because of the cold, people are not going out as much. Sorry, my dog is barking. He needs to go outside. But the indoor dining is getting more complicated. And until the vaccine is in people's arms, and we don't think that that's going to be until the summer of next year, what are we going to do to have people be willing to come into dining? So while it does limit the number of people that maybe are going to be able to afford it, if our choice is staying in business or say sort of appealing to an audience that is willing to spend the $50 to take this next level of safety, that's the decision we've made. So we're going to pilot this on Tuesdays and Wednesdays for the rest of the year, assuming Cuomo lets us keep our restaurant open, and we're going to try it. We're still unable to have live music, which is really what we know how to do and put on shows. And we're at limited capacity and socially distant tables. It's very tough right now.
That's right. You bring up a good point. You have you're a live performance space in addition to being a restaurant. It's sort of a double whammy for you. Quickly, in the 30 seconds I have left, if Governor Cuomo mandates that indoor dining has to end next week because New York State moves into the orange level, if you will, with this virus, will you have to shut down some restaurants permanently or lay off workers?
Well, not permanently. I hope we can stay open. It also depends on what those people in DC decide to do with some support for us businesses to help us pay our workers while we're shut and not open. We're going to do everything we can to not lay off more people. Our company had 1,400 people nationally back before the pandemic. We're down to 450 nationally, and we're doing everything we can to stay open and keep our staff employed.
All right, Michael Dorf, CEO and founder of City Winery, best of luck to you. Thanks for being with us.
Thank you. We need it.
And we'll be right back.
There are reports that Disney is thinking about taking its new Pinocchio and Peter Pan movies straight to its streaming service. Dan Howley is here now with the latest. What are you hearing, Dan?
Yeah, that's right. According to Deadline, movies such as Pinocchio, Peter Pan, and Cruella could be coming to Disney Plus rather than having a big box office release in the theaters themselves. This follows Disney's decision to also premiere Mulan on Disney Plus. Now, there's no idea yet on whether or not Disney will charge an extra fee for these movies through Disney Plus, but it does follow some decisions from other companies to do this. Obviously, we've seen that Wonder Woman 1984 is going to be coming to streaming services as well as available through theaters in December. So this is something that a lot of theaters have to grapple with, and we'll see where it ends up.
All right, we will be watching and waiting. Lots and lots of those movies going to streaming first. Be curious to see, too, if Disney Plus subscribers will be able to view them for just the cost of the subscription or extra. Still yet to be seen. All right, thanks so much for joining us. I'm Alexis Christoforous. Lots more of Yahoo Finance Live to come as we lead you into the final hour of trading on this week.
We've got about an hour left in the trading session, and markets fall on news that Treasury Secretary Steve Mnuchin will let taxpayers-backed Federal Reserve pandemic lending programs expire, but the Fed, in a rare public rebuke, says it would prefer they continue. Pfizer and BioNTech submit their request to the FDA to grant emergency use authorization for their coronavirus vaccine. We will get an update on just how soon U.S. citizens could actually get the vaccine. Bitcoin races higher, up more than 150% year to date, trading higher than $18,000 for the first time since 2017. And it looks like it might go even higher. Dan Roberts will give us some insight on why the cryptocurrency is breaking out of the range that kept it depressed for 2 years. As we said, an hour till the closing bell. I'm Adam Shapiro.
And I'm Shauna Smith. Like Adam was talking about, we are seeing some pressure here across the major averages with the Dow and the S&P in negative territory, just under 60 minutes to go. In terms of the biggest laggards here in the Dow today, Boeing and American Express, those two names are the worst performers. Adam mentioned the news that we got out of the Fed, but also what's on investors' radar is, of course, the rising COVID case count. That's hitting another record. And because of that, we're seeing some of that stay-at-home trades back in favor today. One of those names that I want to focus on, Adam, is Zoom. It's getting a huge boost today, up just around 6.5%. And that rising COVID case count, I think, is enough of a reason
for investors to buy some of the names that have been working over the last 7 to 8 months. Record number of cases today, 187,000. Zoom this year up 550%. Now it has had quite a wide trading range, as you can imagine, with a gain of 550%, trading from $62 all the way up to $588. Right now, it's right around $440 a share. So shares up, like I said, over 550%. I also want to take a look at Workday. That's actually one of the laggards in the market today, off just around 8%. Now they beat the street's expectations, earnings coming in better than expected, revenue also topping what the street was looking for at $1.1 billion. But we're seeing this stock under pressure. And that, of course, is because of some of the comments that the company, that its executives made about COVID. So their CFO, Robin Sisko, saying in the earnings call, warned that COVID will weigh on growth here for Workday in the coming year. So that, of course, enough to put pressure on the stock today. But for the year, though, Workday has been a winner and has been an outperformer, with shares up just around 35%.
Shauna, in hospitals across the country, they administer remdesivir, the drug from Gilead, to help fight COVID-19. But today, the WHO said remdesivir should not be used as a treatment for hospitalized COVID-19 patients. So what's going on with shares of Gilead? You can see they are off about 1%. They've been trading down all day in that range, about 1%. To let you know, it was just last month that the Food and Drug Administration approved remdesivir to treat patients over the age of 12, those patients who are hospitalized with COVID-19. Year to date, Gilead shares are actually down about 7%. But then there's Neil. Let's turn our attention to the electric car maker, because shares have been up about 2% during midday trading. And right now, they're not quite as high as they had been, but they're still up about 0.75%. Analysts from Citi and JP Morgan both releasing bullish notes on NIO this week after their positive earnings report. It was JPM that raised the price target to $50 from $46. And remember, we heard from NIO that they're going to produce as many as 7,500 vehicles a day beginning early next year. They've been averaging about 5,000 new vehicles. Year to date, take it with a grain of salt, the stock is up 1,100%. But remember the 52-week range. This stock was trading around $1.88 not too long ago. The other news today that we are following has to do with what we learned last night from the Treasury Secretary about allowing programs that are taxpayer-backed but Federal Reserve run to expire. Brian Chung has more on what this means, whether it's legal or not, and where we're headed from here. Brian?
Well, Adam, it's a little bit of a complicated story, but essentially the Federal Reserve and the Treasury, which have been working together pretty seamlessly over the last 8 months, have appeared to come to a crossroads over the expiry date and the use of money that the CARES Act authorized the Treasury and the Fed back in March to backstop various financial markets. Now, this has to do with the Federal Reserve's 13 liquidity facilities, and you'll recall that these liquidity facilities are designed to backstop everything ranging from corporate bond markets to municipal debt markets. And the Federal Reserve essentially had a stop date of December 31st. Now, the Treasury said in a letter to the Federal Reserve dated yesterday that they want those most of those facilities to wind down as of that December 31st date, only saying they will allow 4 of those 13 liquidity facilities to exist once the calendar flips over to 2021. That means that emergency lending programs to municipal issuers like the MTA will expire as of December 31st, in addition to the Federal Reserve's Main Street Lending Program, which you'll recall was the Federal Reserve's efforts to offer credit to small and medium-sized businesses. Now, the remaining question right now is whether or not, A, the Federal Reserve will actually return the money as the Treasury has requested. They hope to use that, as Stephen Mnuchin told CNBC this morning, to reallocate that towards a new round of PPP funding, for example. But another question also concerns whether or not this changes the calculus for another fiscal package. Again, it does seem like the Treasury Secretary would like to redirect over $200 billion that was unused towards another fiscal package. But as we know, and we've been talking about over the past few months, unclear what the appetite is on Capitol Hill and the White House, especially during this lame duck session, to actually do just that. So the public spat between the Federal Reserve and the Treasury, which is fairly in the weeds, does have fairly large consequences and is definitely going to be something worth watching in the months to come.
Brian, what if these facilities, what if they are needed again? What if it proves that, hey, it was actually too soon to end some of these programs? Could the Fed then request for them to be approved? I guess, what would that process be like?
That's an important point that you bring up. The Treasury Secretary did make it very clear in his remarks to CNBC this morning, in addition to the letter that he sent the Fed yesterday, that if there were the circumstance where they felt they needed to reopen those facilities, they could do so. But the either or, you would only have a smaller pot of money to do that, because the Treasury is asking the Federal Reserve to essentially remit most of the $454 billion that were allocated to it from the CARES Act. The Fed has only used up about $25 billion of that on the programs that it's set up so far. The Treasury is saying you can hold on to that $25 billion, but you will have to return the rest of that money to the Treasury. Now, again, it's unclear legally if the Fed is going to have to do that, or whether or not they could say, actually, we want to hold on to that money. It's something for lawyers to determine. But regardless, the Treasury does say they can also use their exchange stabilization fund. There's a number of allowances in there that they could use also to re-up those facilities if they needed to next year as well. But again, for right now, it does seem like the Treasury Secretary pretty clear in saying he doesn't see the need for them, at least for now.
Brian, thank you. Let's keep this discussion going on what it could mean for people's investments. And to do that, we invite into the stream Sonal Desai. She is Franklin Templeton's fixed income CIO. Good to have you here. And I was curious, as we get ready to talk to you about a great many things, this tug of war between the Treasury Department and the Federal Reserve, for instance, municipal bonds. Could it have a negative impact on municipal bonds, on whether a government's ability to issue them at the local level or an investor's willingness to purchase them?
You know, I'd say that we should take a deep breath and recognize it's very marginal. Yeah, the programs were great. Their existence did a lot for market sentiment. But I think you'll have seen in today's municipal bond prices, the take-up was really not that enormous. So I would say two things. One, I agree with a lot of what Brian said right now, but I would just note that if it does go back to the Treasury, there is a greater chance of that money actually making it out into the economy. The Fed has not very successfully had massive take-up of these programs. I also understand why the Fed would prefer to retain that firepower, but it hasn't been mobilized. The take-up was simply not very large. And so while it is a big headline, I would actually take a breath and say, look, it's not the end of the world.
I actually have a question about what you're saying just in terms of the low take-up of these facilities, because I think we've heard arguments from both sides that, yes, this is a good thing, or, hey, actually, maybe it was a bad thing that we didn't see more interest in that. Why do you think that this is necessarily a good thing?
So the good thing means that the rest of the market is behaving as it should. Market participants are financing everybody who needed financing, and that's a good thing. Now, it would be a bad thing that there is not a take-up, only to the extent that we believe additional liquidity into the markets would further support economic recovery. Frankly, it would be better if we could get that cash out. The economic recovery, though, has proceeded quite well. So, it's not so much a good thing or a bad thing, it's why. It wasn't that the reason that the take-up didn't happen to a large extent was because market financing was available. If we had market participants stepping away and we did not have the Fed backstop, that would be a bad thing. That simply hasn't happened. So I'd say that, to me, if I look at this, I recognize it creates a great deal of concern, on the one hand, certainly to market participants, but from a broader macro perspective, if our concern is to try and get more cash into the hands of individuals, into companies, perhaps there are better ways to do it. And maybe that's something that the Treasury could control, is what I would say.
So when you talk about the economic recovery showing an encouraging degree of resilience, that's not across the board, though. There are sectors within the economy that have been hit very hard. So what is it that helped it be resilient? Was it the stimulus? Was it the Fed? And what is necessary going forward so that investors don't get burned, but so that people don't lose their jobs as well?
Okay, so I would say it's all of the above. The Fed took the first steps. It was enormous. Within something like 4 weeks, 8 weeks, the Fed had done, within a few months, essentially the Fed had done more than QE 1, 2, 3 put together. Enormous backstop for financial markets, largely, but just a way of calming the free falls that we saw in the early days of shutdown.
The other side of it, the fiscal package, the CARES package, the extended unemployment benefits, those were definitely factors which were probably more directly useful to people and to the real economy. And that takes us back to the issue that you didn't have as much take up from the Fed, in large part because it stood ready to intervene if needed. And it's not just a question of munis. I'm thinking about their program to buy high yield, their program to buy IG. They never needed to do anything. Markets normalized. So I think that while at face value it looks terrible, I would take a step back and say there are things, if we are more concerned, for example, about the fact that there is cash which is not getting out to people who are on the verge of losing their unemployment benefits, actually it could be better used not by the Fed, but by the Treasury because it has that cash. So I'm not sure this is how it will go, but I do tend to be of the view that the Fed's backstop is important as a backstop. I would also say if those funds are returned to the Treasury, I wouldn't rule out that we would have another set made available as needed. And I think that while the market reaction has not been positive, it hasn't been extreme. And the reason it hasn't been extreme is for the reasons that I've just described, I think.
I guess, how should investors be allocating their money right now? Because there's so much uncertainty going off of everything that you just outlined, and especially when it comes to COVID. I think, yes, the economy has shown that it is very resilient, but I think there are a lot of unanswered questions just between now and what the next couple of months are going to look like.
Yeah. So I think that there are the different types of unknowns, and the unknown here is how policymakers react. Now, I would be surprised if we saw a universal reaction as we did see during the first couple of months of COVID. And I would note that while the absolute number of cases is at its highest level ever, the percentage of the cases that result in hospitalizations is not. It is the absolute number of hospitalizations which is climbing up, but given by how much the total number of cases has gone up, in percentage-wise, it's not as much. Why is this important? Well, it's the severity of the disease, which is in question. Either people who are more resilient are getting the disease, or the version of the disease is different. Whichever it is, it's important to recognize that this is something which should play into policymakers' response to this current wave. Over the next couple of months, undoubtedly, things will slow down in terms of the recovery. After that, either via the vaccine or because every time people do clamp back on economic activity, of course, virus cases go down, but it's not that the virus goes away, it's out there, right? So my point is, when we reopen, economic activity has reacted positively to that. I think I am not a fan of the idea of going all the way back to full shutdown, because a lot of those temporary job losses are being converted into permanent job losses the more absolute shutdowns we have, because people go bankrupt as opposed to simply being, bridged from a point for a minimum amount of time. They're bridged from one side to the other. So I think so far what we're seeing, be it in Europe or be it here, it has been more targeted in terms of the shutdowns. It's not been universal across the board. And that's probably on balance better for the economy.
And we know the Federal Reserve is concerned about the temporary job losses becoming permanent.
Yes, as
Sonal
we should.
Desai, Franklin Templeton,
Thank you very much.
CIO. Good to have you here and good to see you. Coming up, Pfizer and BioNTech submitted their request to the FDA for emergency use authorization. They did it roughly 30 minutes ago for their coronavirus vaccine. How soon will regular Americans actually get those inoculations? We're going to discuss this after the break.
Pfizer in the last hour filing for emergency use of its COVID-19 vaccine is the first step in bringing the vaccine to market. And for more on that, we want to bring in Yahoo Finance's health reporter, Anjali Kamlani. And Anjali, now it's up to the FDA to determine whether or not this should be approved. But what's the timing like on this? I guess, how long should it be for us to expect this process to take?
Well, I'll give you two different answers. One is the official version, and one is what we're seeing happen behind the scenes. So as it stands right now, we know that Pfizer and their partner BioNTech did apply today. As anticipated, they did let us know that that was going to be taking place a couple days ago, as well as this morning. And so what we're looking at right now is a few weeks in which not only the FDA, but their advisory committee, the vaccine advisory committee, is set to meet and then go over all the details of the data, as well as what the plan is, in terms of moving forward from the trial. And that includes questions like, will the individuals who participated in the trial and did not receive the vaccine, so those who are part of the placebo arm, will they then be able to get the vaccine? And if so, at what rate? As well as the questions moving forward, of course, about the ultra cold storage conditions that are necessary and how that impacts where this vaccine can in fact be delivered. Health experts, of course, pointing out that it might be really hard to administer that vaccine in some of the more common places, considering the timeline under which it breaks down because of the temperature sensitivity. So a lot of questions still at play. Of course, what we're hearing from government officials, both within the federal government and at the state level, is that they are anticipating receiving shipments and getting those shipments of those vaccines pretty shortly. States looking at mid-December to get that first set of shipments. Meanwhile, reports today that the federal government has been letting employees know that in about 8 weeks, they should be expecting to have a vaccine offered. But the general public still has a long way to wait. So while that emergency use authorization might be granted, a lot of things going forward from there, including the process for a full approval of the vaccine. Meanwhile, possibly March, April is when you're going to start seeing the general public be able to get those vaccines. Shauna?
All right, Anjali, thanks so much. For more on this, we want to bring in Dr. Marcos Sanchez-Gonzalez. He's the Vice President for Research and Academic Affairs at Larkin Health System. And Doctor, it's great to have you on the program. We just heard what Anjali was talking about, how the public shouldn't expect to see this vaccine until March or April at the earliest. But I'm curious just to get your thoughts on the vaccine developments that we've gotten over the past 2 weeks when it comes to Pfizer, and also what Moderna has in its pipeline. How encouraged are you by what we've heard?
Well, one of the things that they're being reporting in terms of the vaccines are the effectiveness of them, or the efficacy. So efficacy, basically, it's to take an example, if we have 20,000 volunteers and let's say 100 of them, they get sick, how many of those were not vaccinated versus how many were vaccinated? So we're right now, for every 100, pretty much only 5 people under the vaccine get sick. So these numbers are very encouraging. And if we think about the considerations for efficacy, FDA is pretty much going to move forward anytime we see 60 or 50% efficacy. So I think they're going to look into the possibility to accelerating this process. The good news as well is that throughout these months, we have been learning better about the disease. We're managing it well. Patients are not spending that much time in the hospital anymore, which is great. Vaccines, they don't really cure disease. They are part of the arsenal of strategies. So states, they have to focus their efforts in actual programs to basically eradicate at some point or decrease the infectious rate. That's really, really what's going to make the difference in terms of the vaccination in public health.
Doctor, I do want to ask you about managing the disease, but before we go there, this vaccine, have you been contacted, are medical centers being contacted by the federal government as to how the regimen will look like when it's time to inoculate all of us? I mean, I remember as a kid getting it was a big gun-like thing, and we all lined up to get, I don't remember what it was. It was first grade. But is it going to be like that? We're going to be reporting to centers somewhere in our cities to get shots?
That's a very good question. Right now, since as we see the different policies in different states, there's not anything standardized. I think we're going to spend some time starting from January and February in the new administration, if that's the case,
to establish some standardized procedures to make that happen. Who's going to have the priority? There's going to be healthcare workers, or those that are mostly exposed? We don't have that answer right now. Many of the companies and research endeavors have been contacting medical centers to test new and emerging treatments. Some of them, they involve anti-inflammation. Some of them, they involve anticoagulation. Some of them also have to do with the vaccine, but we don't have an actual clear idea how this is going to be implemented, which it could fall in the responsibility of the states, or it could be something more standardized. We don't know for sure.
And very quickly on managing the disease, a buddy of mine is at University Hospitals in Cleveland getting remdesivir, and has COVID. And yet we heard from the WHO today, remdesivir does no good. So what are we doing that manages the disease, that improves outcome for people?
Well, right now we understand better how it spread. We know that there's a 9-day window from the time you develop the first symptoms that you basically are shedding the virus out. People that is asymptomatic can also have the possibility to spread the virus out for at least 3 to 4 days. So we're more incentivizing policies revolving nasal hygiene, nasal sprays to basically decrease the viral load. We're also looking into anti-inflammation, more aggressive than in the beginning of the pandemic. And we do have more cases, but the amount of people in hospitals, at least in the South Miami or South Florida area, with COVID is not that high, which is with our good news, meaning that we have more people, but they're asymptomatic. And also the centers that at the beginning have no clue. We were fighting, basically in the dark room against an enemy we didn't know. Medical research has advanced tremendously. From March, if you do a search in terms of the medical literature, from March, we were roughly at 20,000 references. Now we have almost 80,000 references of reports that are helping physicians and clinical facilities to manage the disease better in patients.
The other part of the story that we haven't talked as much about is what's happening to all the medical needs that aren't being met because of COVID. What kind of health complications are you seeing as a result of this? And how big of a crisis is this almost within the COVID crisis?
Well, the latest report suggests that COVID has become the third leading cause of death. We still have second cancers and number one, cardiovascular disease. And it is true that both populations, they're most likely to have complications from COVID-19. In terms of chronic conditions management, early in the disease, in the first basically peak of it, we did very poorly in terms of managing those patients. There was many cancellations. Now we have telehealth, telemedicine. We have new and more specific guidelines statewide that has been helping us to get those patients back on track. So I'm not sure if we're just right there in terms of getting those patients back on track, that they're on their medications, on their treatments, and so on. But I believe, I'm very hopeful, and I have the faith that if this gets into another level, we're going to be able to provide the patient the service they need, despite having a third, at this point, wave of cases.
Dr. Marco Sanchez-Gonzalez, Vice President of Research and Academic Affairs at Larkin Health System. We thank you so much for taking the time to join us today.
Thank you.
Coming up, we're going to talk about the surge in Bitcoin. We have Bitcoin racing higher, up more than 150% this year, crossing above 18,000 for the first time since 2017. We'll talk about what's behind the drive right after the break.
Remember the scene in the movie Dodgeball where one of the players says, "Oh, snap." Well, you might say that when you look at Bitcoin. Wow, it's up today. It's over $18,500 a share. In fact, Jared Blickery, it's trading over $18,000, not a share, but $18,000 a coin for the first time since what, 2017?
Yeah, it was 3 years ago that we had our daily crypto corner event at Wi-Fi, Yahoo Finance, under the stairs at our old building. And shortly after that, the market peaked, and then it was downhill ever after until now. Now, we have seen a resurgence, and let's get straight to the Wi-Fi Interactive and look at what's happened this week in the crypto space. These are the top 18 coins, or Ether, I guess that's an exception, by nature. By market cap, excuse me. And you can see a lot of them are up quite substantially. Polkadot in the upper left is up 20%. In the upper right, we got Bitcoin up 11%. And then you take a look at what's happened over the last trailing month, up 55%. Now, it is getting a bit frothy here. It looks like it's trying to go somewhat parabolic. We do remember the last time that happened. We can take a look at a 5-year chart to see exactly when that peak was. And intraday here, we got all the way up to almost 20,000, and we're right up there right now. Now, we have consolidated for a number of years. It took a long time to break out of this negative trend channel, and we're in a much different place than we were 3 years ago. I remember that Coinbase, the leading exchange at the time, at least in the US, was suffering serious delays. It was taking 30 minutes to process a transaction, and there were high fees. We didn't have the institutional support that we do now, but now it looks like institutions are really gearing up. You take a stock like MSRP, which is holding Bitcoin against its payment assets, there are going to be a lot of firms that have to get into crypto simply to back people in the actual fintech space. So there's a lot of institutional support. Retail is not as frothy as it once was. I think people have heard of Bitcoin by now. They probably remember 3 years ago, a lot of people got burned. And so in the long scheme of things, I think we're in a much better place and we'll probably eventually get higher. Having said that, very frothy right now. And a lot of these coins are simply on fire. Just one more look at the heat map here. Look at year to date. We got Link, that is Chainlink, up 687%. So lots to be done here. It's not just Bitcoin. There are other assets that people can look at. All in all, a good month and a good week for Bitcoin, though.
All right, Jared Blickery, don't go anywhere because you're going to be coming back in just a minute. But so are we. As temperatures drop, are customers still going to want to eat outside? There's a company that builds outdoor seating for restaurants here in New York City, and they're betting on that. Why it may actually work right after this. Just around 25 minutes left in the trading day. We're seeing some of the selling accelerate here into the close. The Dow now off over 200 points. Jared Blickery, what are you watching as we just have a few minutes left in the trading week?
Yeah, I'm not too concerned about this price movement. It's big relative to the day, but not within the context of what we've seen earlier in the week. But taking a look at the Nasdaq 100 here, heat map, and the Nasdaq has been leading all day. Now we're seeing all the indices in the red with the Dow lagging, as you just mentioned. Apple is down 1%, Facebook down 0.8%, Alphabet's down over 1%. And looking at the biggest winners and losers here, we're seeing a return to that defensive lockdown trade. Zoom up 6%. And for the week, it is up. Let's take a look here because it was down 20% last week, 8.78%. Well, I want to focus now on a staple called Walmart. This is our Yahoo Finance Premium Investment Idea of the Day. And this is a call by Argus Research saying that they are seeing a bullish trend in Walmart. And their long-term price target has been bumped up to 166 from 157 after their strong third quarter earnings. And just a couple words about those earnings. Earlier in the month, Walmart announced a 15.5% increase in third quarter adjusted EPS to $1.34 per share, topped our estimate of $1.20 and the street account consensus of $1.18. Operating income up 22.5%, topping estimates, et cetera, et cetera. And then the conclusion, we estimate that debt, including leases, was about 2 times adjusted operating income, plus depreciation and rent for the trailing 12-month period through January 31st, 2020. This ratio is more favorable at about 1.9 times through the third quarter, very strong. On a net debt basis, which is where some consumer products company prefer, the ratio is about 1.5 times. So again, their price target has been raised to 166 from 157. And looking at the stock over the last month, up 4%. Over the last 6 months, up almost 20%. Guys?
Thanks, Jared. All right, we want to turn to the restaurant sector because restaurants are just one of the businesses that are doing all they can to survive right now in the midst of the coronavirus pandemic. Restaurants, many of them are building outdoor spaces so they can survive during this winter. For more on that, we want to bring in someone who's helping these restaurants do this. And we have Arshan Makami. He is managing principal at DB Partners. And Arshan, it's great to have you on the program. You see it all over right here in New York City. Restaurants are getting creative with their outdoor seating. What are you doing just in order to help these restaurants build these spaces?
Yeah, Shauna, thanks for having us. Thanks for having me. It's been a very interesting process in working with the restaurants in the city. Guidelines are changing on a weekly basis. I think restaurants are seeing their business model evolve over time. So we've been working with them in understanding what their business model is, what their restaurants are like, and sort of how we can expand the experience outside of the sort of indoor restaurant experience that they currently have.
I don't think any of us would wish the Byzantine bureaucracy of New York City regulation on anybody, but is the city kind of spearheading what can be built outdoors? And I ask that because we've had guests come on this week who've said, look, if you go to sit in indoor, outdoor, whatever structure that's been constructed, you have to have at least one wall totally open so that there's air exchange. Can you set the record straight for us on what does the appropriate outdoor structure look like?
Yeah, 50% of the structure should be open. And I think there are different guidelines if you're on the street or if you're on the sidewalk. And so that has been evolving. This week, the DOT came out with new regulations about sand and soil that's necessary in the structure. And so restaurants are evolving sort of on a weekly basis. You know, they're seeing the amount of people that they can put inside is decreasing. So it's very hard for them to adapt on such short notice. You know, it's hard to be in an industry that is driven by table and occupancy and then have that reduced and have your cost increase. So it's hard. And we're there to sort of support these businesses and these business owners and their staff, right? It's hard for everybody that's involved.
Arshan, before this strategy building office spaces, so now you're building these outdoor seating areas. How are you able to pivot your business so quickly?
So our business is really focused on the customer. So we really try to understand what drives our customers, what's beneficial for them. And for us, it's really listening, digesting, and then interpreting that in sort of the design and construction realm. So for us, whether it's hotel or office, which we were doing primarily prior to COVID,
Now, if it's helping out retailers, I mean, we're still doing building repositioning. That's our primary business. This is our way of sort of engaging with the city and with business owners that we know and that we've been working with, and it sort of evolved from there.
Is there any kind of city, state, federal financing to help pay for all of this, or is it really just between you and the restaurateur?
Yeah, I mean, for the most part, it's between us and the restaurateur. It's hard for them to finance these, and we've talked to many business owners who say, we need 3 brunches to pay for the structure, and we say, completely understand it. For us, it's really about maintaining their business, maintaining the city. I mean, New York as a whole really survives off of the retail corridor being alive. I mean, for me personally, I think for all of us, your apartment is you sacrifice a backyard in New York, and the city is the backyard. Where now we sort of are reducing that ability, and it's hard for a lot of people who live here to sort of reduce the amount of exposure and the amount that you can go out. So it's been hard, I think, for everybody involved, including people that live here.
So 2 questions here. One, how long does it take to build one of these? Is it something that can happen in a couple of days? Does it take a week or 2? And how much does it cost?
It takes us about, let's say, anywhere from 3 to 5 days to build them. I say on average it's about 4 days. They're very quick. I mean, previously, we're very fast builders. We were at WeWork previously, and so we're used to these sort of quick turnarounds, rapid transitions. Really gave us our luster. We're bringing those same principles here, and really focusing on what they can do. In terms of cost, it's very variable about what the client wants, right? There's certain structures that are immaculate, they're high end, and those have much higher price point and cost. And there's some where we understand the business needs a space to expand and just to maintain their table size. So the range has been pretty wide.
What are you hearing from the restaurateurs about their fears of making it through the winter, because the coldest of the weather hasn't hit yet?
Yeah, I think people everybody is first and foremost concerned about health, right? I think keeping everybody healthy, keeping everybody safe. And then after that, it's nervousness about if their business will survive. Can they afford rent? Can they keep everybody on staff? I mean, the restaurant industry, I think most businesses are very much like a family when they're small businesses. So keeping people that you've worked with for 10, 20 years on your payroll is tough when you don't have the cash flow. So for us, it's understanding, how many seats, how many people, how many tables do they need in their business to keep them afloat, and sort of getting there within the guidelines the city provided. So there is a lot of concern, to answer your question very directly, that they will not survive this winter.
Arshan Makhami, great to have you on the program, Managing Principal at DB Partners. We wish you all the best.
Thank you very much. Thanks for having me.
Got just under 20 minutes left to go in the trading day. We're seeing a little bit of a sell-off here into the close. The Dow off 160 points, so still off its lows of the day. We're back with more on that in just 2 minutes.
We've got about 15 minutes until the closing bell, and we're watching markets. Bit of a sell-off right now as we head towards the close. We want to invite into the stream Omar Aguilar. He is Charles Schwab's SVP Investment Management and CIO of Passive Equities and Multi-Asset Strategies. Good to have you here. Wanted to ask you something that we touched upon at the beginning, and it has to do with the issue between the Secretary of the Treasury and the Federal Reserve and all of those issues which are really boiled down to the economy, stimulus, and what's happening with the recovery. You say it's slowing down with winter upon us. Does that pose trouble for investors, or will we get through it?
Well, it certainly becomes a volatile environment, and certainly, you know, the rebound in the economy, which was what we have had so far from the second quarter into the third quarter, we really just started the recovery. So just to be very clear, we rebounded in the economy for a very bad period that we had after March. And then as we started to reopen the economy, we just rebounded. So the numbers that we have seen, and this is at a critical point in our economic, phase, because we just started the recovery. And yes, stimulus is very important. So the Federal Reserve has done everything in their power to continue to provide that liquidity. We have heard, Fed officials over the course of the last few months basically pushing towards the need for fiscal stimulus, just understanding the limitations that they may foresee of what the banks may have or the central banks may have. So I think this connection or these, discussions between what happens with Treasury and what happens with the central banks become really critical to just put a probability on what the fiscal stimulus might look like and the timing of it. And it is certainly very important for continuation of the recovery, because we have seen signs of fatigue in some of the areas that have rebounded the fastest.
So how should investors then be approaching this? Is it time to take more of a risk off type of approach?
Well, that's a great question, because, we are at this point where, things can go either way. And I think a lot of what, we have always discussed is that the recovery of the economy after a recession starts when you fix the source of the recession. And in this case is the coronavirus. Now, in this situation, the recovery of the economy really started the day that we heard the news of the vaccine. So as we continue to progress towards the vaccine being available, the vaccine being distributed, that recovery will probably take place a little harder. And therefore, what investors should be thinking about is this is the perfect time to rotate towards cyclicals, towards the small caps, towards, credit that will usually do well in all recovery. Now, that being said, we have the winter. We just talk about restaurants. We just talk about, the fact that it's going to take a while. The number of cases continues to go up. And there is a part of the economy that will stay the same way that we are today. So there are certain sectors of technology that will be part of our lives for the longer time. So it is not necessarily unwinding what has worked so far, but it's really barbelling to start getting their safe in the rotation trade, but at the same time realizing that the timing on the rotation may still take, maybe towards the winter months.
But consumer spending and retail sales, as you point out, depend on the path of the pandemic and the holiday shopping season. Assuming the holiday shopping season disappoints, what happens next?
Well, that is, the key part of what I think volatility will go for the next few weeks. And it's certainly, next week going into the Thanksgiving break. A big part of this, has to do with the fact that we still have 10 million people unemployed relative to what we had at the beginning of the year. So the labor market softness is actually going to put a lot of pressure in the amount of spending. That being said, the savings rates of the average consumer went up during 2020. And what that also tells you is with the optimism coming from the vaccine, the ability for consumers to potentially spend is much higher. So it is really an interesting point in time where, there's a little bit of optimism built because of the vaccine and the fact that the saving rates are high that puts a very promising outlook for retail. But at the same time, realizing that there is a softness in the labor market that clearly puts a lid of what the potential might be.
All right. Omar Aguilar is Charles Schwab Investment Management Senior Vice President and CIO, Passive Equities and Multi-Asset Strategies. Thank you for being here. We're going to be right back after this.
Roblox filed its paperwork to go public, the gaming company really joining Airbnb and DoorDash in their efforts to make their public debut before the end of 2020. We want to bring in Ines Ferre for a little bit more on this. And Ines, we know at least in terms of for Roblox this year, it's been quite a year for the company. They're one of the pandemic winners, I guess you can say, and it was evident in some of the numbers that were in this release.
Most certainly. I mean, Roblox was big business before the pandemic, and it really skyrocketed during the pandemic. I'll get to that user base in a second. But first, let me just tell you what this is. This is a company which provides these 3D games experiences, and it's also a developer platform. It's been dubbed the YouTube of the gaming world. So what they have are developers that create their own games, their own experiences, and they also have creators which create avatars. And for users, they don't have to pay for these games. However, there are in-game experiences that you can buy. So you can buy enhanced experiences, you can buy clothing, you can buy all these virtual products, and you do this with this virtual currency called Robux. There's also a subscription service that comes with this Robux currency. And the way that Roblox makes money is that it retains a portion of every Robux transaction and then it distributes the rest to developers and to creators. As far as the user base for this is so impressive. 31 million daily active users from 180 countries. The majority of the users are on mobile phones. 54% of the users are under the age of 13. In fact, the company says that in the US, 2/3 of every 9 to 12-year-old is on the platform. So 2/3 of 9 to 12-year-old kids in the US are using this platform. It's just amazing the growth that they have seen during the pandemic. The company still not profitable, but its revenue has been growing year over year. I'm just looking at the numbers with revenue coming in for the first 9 months of this year, 589 million, and that's certainly a growth from the year before. Its net loss coming in at 203 million in 2020.
All right, Ines Ferre, certainly sounds like December could be a busy month for IPOs. Ines Ferre, thanks so much for breaking that down for us. Just 5 minutes left to go in the trading day. All three of the major averages in the red, the Dow off just around 180 points. We're back with the closing bell in just 2 minutes. Just a couple of minutes here until the closing bell. We want to bring in Amanda Agati. She's PNC's Chief Investment Strategist. And we're also joined by Joseph Minarek, a Chief Policy Economist at the Conference Board. Amanda, let me start with you. Just in terms of some of the pressure that we've seen in the market this week, the Dow and S&P both on track to close the week in negative territory. What's behind some of the selling pressure that we've seen creep back into the market?
Well, thank you so much for having me. It's great to be with all of you this afternoon. I think really at the end of the day, this comes down to very much a story of kind of diminishing marginal returns, if you will. I mean, it all got kicked off certainly by the Pfizer news last week with their efficacy rates in excess of 90%. That literally shocked the market. That was not the consensus expectation, certainly getting that news. And so it really kicked off a firestorm and a record-breaking reversal in terms of factors and a rotation. The challenge is that even with Moderna's news earlier this week, still of a similar level of efficacy, I think the reality is setting in that it's still very much a long, dark road ahead between here and getting this economy fully reopened. And so, I think net, it's wonderful and optimistic and hopeful to see the news out of these vaccine trials. But just given where valuations are sitting in the market today, hard to see a meaningful positive catalyst to get this rally fueled here into the end of the year. And so I think in the absence of that kind of catalyst, it's sort of a reversion back to the stay-at-home trade, which has really been in charge all year.
Joseph, very quickly, is the market accounting for what the Federal Reserve fears most, which is those temporary job losses becoming permanent job losses? Because that is happening.
It is happening. The data show that temporary business closures have become permanent with unfortunate rapidity. We're coming to the end of the year. Some of the provisions of the CARES Act with respect to unemployment compensation are going to expire. We've got pending rental evictions. We've got folks who are behind on their mortgages. And the Congress and the president are off in their own worlds. We really do, I think, need more consciousness and more visual consciousness of the extent of the problems with the economy. And it just doesn't seem to be there.
Hey, Jared, as we get closer to the closing bell, we only have about 45 seconds left in the trading day. But the weakness here, I think, is what's interesting in today's action. We have some of the cyclical sectors, industrials, financials, and utilities as well, defensive play, leading some of the declines.
Yeah, and let's take a look at the charts here as we await that closing bell. You can see the Dow here at the week's lows here, and also in the Nasdaq a little bit better, although we are seeing where it give up some gains, peaked right around Tuesday, Wednesday, along with the other indices. S&P 500 also kind of at the lows of its sessions, but take a look at the last 3 months. All we've been doing is consolidating near highs here. It really didn't have an effective catalyst that could have gotten us to new highs, and along with the Dow at 30,000, which we came within inches of on Monday. And as we look at the bell here, as we look at the closing prices, let's take a look at these heat maps.
All right, so we've got the closing bell and we're waiting for the markets to settle, but some of the big losers today, BJ's Wholesale Club, that was down about 5%. We're watching what's happening to a lot of stocks because this was a day where some people took profit off the table, but as the markets settle, as we were just saying, the S&P 500 off a little more than 0.5%. The Dow looks like it's going to finish off about 0.75%, and the Nasdaq off about 0.5%. As we take a look at all of this, Amanda, the next step for an investor who might be worried heading into the end of the year about having money on the side and missing out on the next upside, is it too soon to jump back in?
Well, that is a terrific question. I wouldn't say that it's too soon to jump back in. I mean, let me step back and say we've been fully invested riding this crazy wave of this market environment and economic recovery all year. I wouldn't say that it's too late necessarily to jump in. I think the worst case scenario is just sitting on the sidelines paralyzed. And so I absolutely think that investors should be wading in, if they are not already fully invested, wading in and picking their spots very carefully. The area that I'm still very much concerned about, though, is the value side of the equation.
and in particular small and mid value. You think about the sectors and the areas that Jared was talking about earlier: energy, financials, consumer discretionary, even REITs, still under tremendous fundamental pressure, right? We've had this huge sentiment shift and reversal on the hopes of this vaccine breakthrough and efficacy rates, but we haven't seen that fundamental shift. So a lot of pressure continuing in those particular areas. I think it's going to continue for quite some time. That doesn't mean the entire market is under tremendous pressure. With the excessive stimulus that's sitting in the system here, certainly from the Fed, but also the lingering fiscal programs, it is putting an underlying fundamental of support here in for the broader market. You just have to be very picky and choosy at these levels.
Joseph, how would you characterize the consumer at this point? Because I think we've heard the perspective this week that retail sales climbing for the 6th month in a row. They're still in positive territory. That, of course, should be taken, I guess, as good news when we're in the midst of this pandemic now. But the pace of growth is slowing. So that, of course, could be a little bit worrisome here as we head into the holiday season.
Yeah, in terms of consumer sales, of course, there's the pace of growth, and then there's the level. As has been mentioned in just the last few moments, the savings rate is extraordinarily high. Many of the consumers who are doing well either have not found things to do instead of dining out and travel, or have decided that they want to be more cautious, and so they're holding back. And meanwhile, the lower end of the employment, the skill continuum, even though these are folks with relatively lower incomes and relatively less, therefore, to spend, are hurting badly, systematically. And so the economy does need a push, I would argue, and in particular, there needs to be a little bit more certainty, a little bit more confidence that we are going to have the support for the unemployed population that we need until we actually get those vaccines and turn them into vaccinations, and we get to the point where people can begin to try to go back to their normal lives.
Jared, a lot of us are lazy investors, passive investors who rely on others to, manage funds and just let us get out of the way. What have you got for us?
Well, I'm looking at a couple of spaces here that really did well in the week. So the indices really didn't do that much, but you look under the hood, there were some winners and losers. And guess what? Electric vehicles, EV space, just absolutely on fire. You take a look at our heat map here, Tesla, and this is over 5 days, Tesla up 20%, but that's potatoes. Look at this, IRO up 102%. And then some of these others like Caxton Auto Holdings. A lot of these are small plays, very speculative, very dangerous. I'll highlight Solo. This is Electromeccanica Vehicle. Now, this is a stock that Citron Research issued a short report on earlier today saying it's going to go back to $2, but it's still up 71% this week. So a lot of money flowing into that. Then you also look at the work from home space. Some of the big names off this week, but the smaller names doing well. You look at Plantronics, that's up 14%. Crowd is up 10%, Peloton 10%, Zoom 9%. So a lot of the leaders that got bashed last week, and Zoom was down 20% last week, are doing well this week. And it's not just the work from home. Travel reopening trade did pretty well as well. So Travelzoo's up 19%, Carnival up over 8%, Trivago 6%, and it goes on. To the airlines, Southwest up 3.8%. So not a bad week overall. We did have that sell-off into the close, but people are going to start going on vacation next week, and it's going to be pretty uneventful, most likely. And unless we get some huge catalyst, wait for Monday, 6:45 a.m. Last 2 Mondays in a row, we got some nice vaccine news.
And I was going to say, Jared, those are famous last words. Now, next week is going to be one of the busiest weeks that we've had all year. But Joseph, I want to go back to you just on what I guess one of the things that drove today's move to the downside. And that, of course, was the news that the Fed and the Treasury are at odds over letting some of those emergency lending programs expire. When you take a look at the fact that this is a public disagreement, this doesn't happen too often. What's your reaction to this?
It really is not the kind of spat that you want to have occurring in public. Arguably, this is not a step that you want to take at all.
it's, clearly the Fed has had some difficulties in standing up these lending facilities. This is something totally new, and it's not surprising that that would happen. You would have thought that there would have been private conversations if the Fed had a really strong reason for going where it wants to go. It would like to have the Federal Reserve standing next, the chairman standing next to the Treasury Secretary when such an announcement is made, or two names on the press release. I don't know why they're doing that, and I have a really hard time being comfortable with it.
Amanda, do investors worry about, the press is making a big deal about what the Treasury Secretary is doing, but that money, as another guest pointed out, could wind up being put right back into the economy as opposed to sitting on the sidelines doing nothing?
Well, it doesn't seem as if investors are too fazed by it currently, which I guess is the good news, bad news. I mean, I personally think that it injects another element of tail risk into the equation here that we really don't need. The other thing that's sort of tail risk related is these additional lockdown measures that we're starting to see put into place. And so I don't think, given where the market, just keeping it simple, the S&P 500's forward PE of about 22 times, or just in excess of that, I don't think this is a market that's pricing for these types of tail risks. I mean, at the end of the day, Chair Powell put on a superhero cape and effectively saved the day when liquidity dried up in the spring. And I think we're clearly not out of the woods yet as it relates to the pandemic. This economic recovery is slowing, earnings revisions are slowing. This is the last thing you want to take out of the toolbox at this point. Whether it's being used or not, I would want to have that tool at the ready. And so while the market may not be worried about it today, in 4 to 6 weeks, we might need that, right? And so whether it comes in the form of fiscal stimulus or monetary stimulus or action by the Fed, I'm not sure that it makes a ton of difference other than just timing. The faster we can get it into the system when we need it, the better.
Hey, Joseph, one of the theories out there is that this wind down of the loan programs is seen to raise the odds of more Fed action, that the Fed will then provide more support to the economy. What do you make of that? Is that something that you think might actually come to fruition?
Well, that's pretty hard to imagine at the current time. Obviously the policy rate's at zero. What is the Fed going to do? Are they going to increase the size of their balance sheet more than they are already? I think that these lending facilities are appropriately thought of more, and I think this is what Amanda was saying, are appropriately thought of more as tools that could be used under stress in the future. And I don't see a particular connection between the removal of the funding to cover losses and the Fed's quantitative easing. I don't think that that's where the Fed would necessarily want to go. I think the emergency tools would be better to have at the ready.
All right, Joseph Minarek and Amanda Agati, great to have you both on the show. Thanks so much for joining us today. Have a good weekend.
Thank you.
Thanks. Coming up here on Yahoo Finance Live, gaming, whether it's on a PC, a console, or a mobile device, it is certainly gaining popularity. We're going to talk to Glue Mobile's former CEO on the biggest trends in the industry and why many publishers may tap the markets via the very popular SPAC IPO. More on that after this.
we got? Hold on. All right, welcome back to Yahoo Finance Live. Want to talk about what's going on not only in the electronic game space, but also how SPACs are helping fuel this, not only the electronic game industry, but SPACs in general, 35 plus billion this year alone. And somebody who should know that well because he's got 3 of them is Niccolo de Masi, former Glue. You're not the former, you're still CEO at Glue, aren't you?
No, I'm the chairman of Glue now.
The chairman of Glue Mobile, as well as DMY Technology Group CEO. How do you do 3 SPACs? And then 2 of them have already acquired companies, and they've done it pretty quickly because you have a 24-month window to fulfill all of that, don't you?
Yeah, that's correct. But at the end of the day, investors care a lot, as do we, about time-adjusted returns. So if we can move quickly and find a great partner or business who wants to work with us, why not transact quickly? Look, I think they always say it takes 10 years to be an overnight success. There's a lot of truth to that, right? So we are effectively monetizing a pipeline of entrepreneurs who we've known for a long time. There's a trusted relationship already. We're obviously seen as experts in the space. I've done 35, 36, 37 M&A deals in the gaming business as a public company leader in the past 2 decades. So it's a really good fit, I think, for where a lot of Glue's successes come from, via acquisition. SPACs are kind of the purest expression, I guess, of what I'm good at and what I enjoy doing professionally. And so we expect that we will transact, in a similar time horizon for our 3rd SPAC as well.
How has COVID affected this strategy at all? Gaming specifically, obviously, we've seen a huge uptick just in terms of the number of users, but also just how it's affecting some of the deals that you're making and also just possible opportunities out there.
Yeah, well, look, I've seen actually the same investors 6 times this year for my 3 SPACs and Glue Mobile. We did a secondary at Glue in Q2. I did an IPO for my first SPAC in February, found a deal in July and announced that, raised a PIPE for that. Second SPAC was August IPO, October PIPE deal announcement, and now 3rd SPAC. So 6 times similar thematic gaming investors. And I'd say this, the COVID, impact is a bit of rising tide lifting all boats. At the same time, there's permanent behavioral change that we believe has come into the market this year. So we're seeing an enhanced level of ARPDAU, average revenue per daily active user. We're seeing bigger spenders in both the gambling and the free-to-play space. And I think there's a lot of people now that are looking at their lives going, yeah, I'm not sure I'm more productive driving 3 hours a day to commute to the office. I'm not sure I need to actually be in a land-based casino. I'm having a lot of fun talking to my friends here online. So we think there is a tailwind that's going to last permanently for many years here. When the airline industry gets back to normal in 2023 or beyond, maybe there'll be some reversion to this behavior. But right now, I think it's guns blazing on gaming, and it's picking up a lot of market share of people's incremental time these days at home.
You were talking about the deals you did, Rush Street Interactive and Genius Sports. I'm curious, when you, as somebody who's launched a SPAC, are in negotiations with a company that you want to bring public, how do you convince them that this is the way to go as opposed to the old-fashioned, have the underwriters with the roadshow, that you're going to make them wealthier faster than the old-fashioned way?
That's a good question. A lot of it comes down to that trusted relationship, whether or not we as SPAC sponsors are seen as highly value-added board members. It's also really fundamentally a strategic decision for companies. You can go public in 2 years with a normal S1. If you're really famous, you might have a direct listing option. But in our size range, and we focus on the $1 to $3 billion enterprise, pre-money valuation zone, we offer really a full suite of services and value add. A lot of the companies that we work with don't have public company infrastructure. Rush Street Interactive just announced the CFO in the last quarter, but when we actually raised the PIPE and announced the deal in July, we were still searching. So Harry Yu, my partner, was the former CFO of Oracle, Accenture, and EMC, and he's instrumental in this process. I think that being able to
talk about your forecasts with the merger proxy that comes with a SPAC is very powerful. I think the extra liquidity is very powerful. The certainty of valuation, the fact that if you look at my SPAC deals, Rush Street is trading today at $13 or so. Genius is trading at, $10.50. Neither of these deals doubled or tripled the day they were announced. And that to me is a really good sign. It means that we are pricing fairly as SPAC sponsors, and we're not leaving a lot of money on the table for not the company, right? For other investors. So we're effectively providing a healthy tension with our underwriter, Goldman Sachs. And we do have the premier technology franchise underwriter in our camp, but we're also guiding valuation in that discussion with Goldman Sachs and the company to frankly get the company a better price. And we're also helping them get the PIPE investors in there to validate the price. Fidelity led our first PIPE transaction for Rush Street. And for Genius Sports, which is a really wonderful SaaS duopoly business that provides data to the global sports betting market, it's underwritten, in the PIPE by similarly powerful fundamental investors. We actually raised a bigger PIPE in Genius than we had in the SPAC trust account, which is a really big sign of confidence in the marketplace.
When you take a look out not only into next year, but beyond into 2022, 2023, how popular do you see SPACs getting? I mean, what's the percentage do you think of companies going public? They're going to prefer to do it via SPAC rather than direct listing or the traditional IPO avenue?
Yeah, well, look, the trends are pretty powerful. Believe it or not, I've been following the SPAC market since I sold my first public company in 2007. And they've come a long way from off the beaten path and almost a curiosity even 4 or 5 years ago. Today, it's 50% of equity capital markets volumes in 2020 are SPAC IPOs. So, I'm not going to sit here and promise that it's going to always be more than 50%, but they're here to stay because they're a really powerful feature with a quality underwriter, quality sponsor team, quality company, driving an ecosystem and bringing companies to the public market that frankly have been scared off in the last 20 years from the public markets. If you think about how many public companies there were at the time of the dot-com boom, twice as many as we have today. So there's been 20 years of private equity companies picking companies off and people being afraid to list their business earlier on. It used to be when you were Apple or Microsoft in the 80s and late 70s, you would IPO your company as a growth stage business. And people shied away from that. So I see my job as a public company entrepreneur and someone who's done 6 public companies and been, fairly successful, but enjoyed my time in the public markets, is really bringing in the next generation of great entrepreneurs and earlier stage growth opportunities to get everybody in the marketplace able to participate in that. So I think they're here to stay, to answer your question. And I think they're going to keep getting more institutionalized. You're going to see quality differentials between a Goldman Sachs 3 times issuer like myself and my partner Harry Yu at DMY and first-time issuers that can't command the attention of a Goldman Sachs for track record reasons. You're going to see differentiation in the pipes from quality investors like a Fidelity, a Wellington, a T. Rowe, a Capital Research, a Caledonia, et cetera. These are the kinds of people that you want in your pipe because they indicate quality. They do their diligence and they're long-term holders. And so you're going to see continued demand from fundamental investors coming into the SPAC space with the platinum teams, the top 5 or 10 teams that obviously we consider ourselves to be one of.
All right. Niccolo de Masi is the chair at Glue and the DMY Technology Group CEO. Congratulations on those 2 SPACs. And I imagine we're going to have you back after you close the deal on the 3rd. All the best to you. When we come back, Rick Newman is on deck. He's going to explain why he's a Steelers fan, wearing his Steelers shirt there. Also, he will grade this week, at least the grade that was for President Trump with his Trumpometer score. Hint, it's not very good. We're back after this.
It's time for this week's Trumpometer score, where we take a look at how President Trump performed the past week. Rick Newman, as always, is joining us here to grade President Trump. And Rick, clearly, I guess it was eventful and uneventful in some ways for President Trump, but how did he do from what you're looking at?
Not a good week on the Trumpometer. That's not a surprise. You know, the economy is probably getting worse, not better, because of all the shutdowns related to coronavirus. And a key question a lot of people have had about President Trump in his final weeks in office is he going to go quietly and, basically try to do the right thing with regard to markets and the economy, or is he going to try to burn the house down? Well, I think we should be concerned. I mean, look what happened yesterday. Steve Mnuchin, the Secretary of Treasury, basically saying it's time to end some of those stimulus programs that Congress put into place all the way back in March. And we got this very unusual response from the Federal Reserve saying, no, we shouldn't end them, but Treasury gets to call the shots in this case. So this looks a little bit like economic sabotage, to be honest. Mnuchin has said, no, he didn't do this for political purposes. But I mean, a lot of economists weighing in on this today saying, what is the point of this? Why would you do this? Why would you take aid off the table, given that we're still in a pretty deep hole? So the Trumpometer spiraling downward this week. The Trumpometer reads sad, the lowest rating. And I wish I had better news. I'm tired of being so gloomy, but Trump is doing nobody any favors so far after losing the election on November 3rd.
Rick, the droopy dog with the storm cloud over my head. I got to ask you this. I've been reluctant to ask our guests, but next week we might have to. Everyone keeps writing about how the alleged coup that could happen if a legislature refused to seat electors. I keep reading it won't happen, it won't happen. What happens to the markets if it does happen? We got this secret meeting that's not so secret with the two Republican leaders from Michigan. I mean, if they reject the will of the people, wow.
So let's say Trump found a way to remain president for another 4 years. I mean, that's what you're postulating. It's almost incomprehensible, but markets could not possibly like it. I mean, what do we say all the time on our air? Markets hate uncertainty. And it's hard to imagine anything more uncertain than if the results of a U.S. election are nullified. And that means we would have a dictator running the United States. Now, the reason that these election experts say it's not going to happen is this would have to, this would go through the courts, and the courts, one after the other, they have literally struck down at least 30 lawsuits by the Trump campaign. They've only prevailed in one of those, and it was small potatoes. So it doesn't look like it's going to happen. But I mean, it should be something we all worry about. And it obviously, once Trump is gone, perhaps we need to put in place some safeguards to make sure this can't happen in the future, because Trump is basically creating a roadmap for the next potential U.S. dictator.
All right, Rick Newman, as always, thanks so much for joining us. And of course, all of our viewers out there maybe didn't know what Rick was wearing. It's a Steelers jersey. They're
Jack Lambert, number 58.
So we'll let you brag today that you're a little Steelers fan. All right, Rick Newman, thank you. We want to get to a soundbite here from earlier today on Yahoo Finance Live. Julian Castro, former Secretary of Housing and Urban Development, he discussed Congress failing to reach another stimulus deal. And here's what he thought for who is responsible for that. Let's take a listen.
I had a lot of hope coming out of the gate in this when the CARES Act was passed, that Republicans in Congress would set aside their partisanship and work with Democrats to make the investments that needed to be made to make sure that people could stay in their homes, that the public health investment dollars were out there to combat this virus. They passed the CARES Act. That money got through. That stimulus money helped people to be able to stay in place and get by at a time when our economy absolutely shut down. But the HEROES Act was then passed, I think, in May, and that's been sitting on the doorstep of Mitch McConnell and the Senate for months now. Washington, D.C. absolutely has the foremost responsibility to make sure that people are not getting evicted right now, and that public health investment is there. However, because Leader McConnell and the Senate has failed to make that investment, and the White House as well, that means that the states have to be as resourceful and creative as possible.
You can get the full interview of Secretary Julian Castro on yahoofinance.com. Well, coming up here on the show, we're going to talk cars. Which cars in America hold their value the best and which are the worst for that? We're going to talk to Autoblog's Greg Migliori right after the break.
Baby, you can drive my car, and that comes with a discount if you're buying used. Let's talk about that with Autoblog's Greg Migliori. Good to have you here. And for those people who are about to buy a new vehicle, some will retain their value, but not many, right?
That's right, Adam, and thanks for having me back. Depreciation is basically the amount of value that your car loses the minute you drive it off the lot. So we've been examining some data from iCar.com, they're experts in this, and trying to pull together some trends and figure out which ones, lose the value the most and which ones hold their value the best. Generally speaking, trucks, SUVs, pretty good, especially if you go with sort of brands like Toyota, Honda, Jeep that have, good reputations and are desirable. Other brands don't fare so well. During the break, you were mentioning how luxury sedans are actually pretty good after a few years out. Well, one of the cars that holds its value the least, it's kind of an awkward way of putting it, but you get what I'm saying, is the vaunted BMW 7 Series. You're going to lose 73% of your value after 5 years. So I think that's great too. It's a great car, and I would drive a 2015 BMW 7 Series that you could get for 21 grand. That seems like a pretty good deal, just looking at the listings.
Greg, what's interesting here among the cars that lose, that depreciate, I guess, the fastest is there is an electric vehicle on here, the Nissan Leaf. It was the only electric vehicle to appear in the bottom 10. I'm curious just why that is. Why is that, I guess, why did that lose its value so much faster than some of its peers in that category?
That's a great question. And the Leaf is actually kind of a unique case. Nissan has done a nice job of keeping it updated. And of course, it's still a very, interesting electric car. That said, it's a pretty small car. It doesn't fit the lifestyle many people are going to actually need it for. You could get things that are larger and offer greater range, for that matter, for about the same price or maybe a little bit more. To me, the Leaf is kind of a car that it's a good commuter car. It's good for driving around like just, relatively short distances. And it's still a decent value, but it's also a car that I think time and technology have sort of passed by a little bit. To your point, though, Shauna, it's a pretty good deal. If you just need to drive maybe 15, 20 miles a day and you want to do it on electricity,
you could get a steal for one of those.
What about when you say that something like the Jeep Wrangler holds its value better? So if you go and buy one of these new Jeep Wranglers, what does that really mean that it holds its value? It's still going to depreciate.
It'll definitely depreciate. It will depreciate less than perhaps, some other vehicles out there. In the case of Jeep, they're good vehicles. They're rough and tough vehicles. They're not necessarily the most reliable vehicles, but they're highly desirable. There's always going to be a market for the Jeep Wrangler. They're, again, very capable, and obviously people want them whether you're going to take them off-road or not. So there's certainly a resale market for them as well.
Greg, how quickly do cars lose their value? I know you hear right when you drive the car off the lot, it's already depreciated in value. Is there any truth to that?
Oh, absolutely. I mean, basically the minute you cross the curb, your car goes from whatever you paid sticker to more like a wholesale value sort of price. And then, after 5 years, you could be looking at anywhere from 10 to 50% or more of the value of your car dropping. So really 5 years is a good barometer too, because that's a lot of times when you start to think, hey, I'm going to stick with this car for 10 years. And, it is what it is. Or 5 years, you're probably thinking, hey, I want to do something else. So that's one of the reasons we look at it that way.
Can I just, because I love this discussion, I go nuts over flipping cars all the time. Jaguars. I know people are terrified of Jaguars. Best deal I ever did was a 2003 Jaguar XK8 convertible. This was an $80,000 car. I got it for 12 grand, 34,000 miles on it, because they don't hold their value because people are terrified of them. So is that still the case with Jaguar? Because there's some nice Jags out there.
Jaguars are kind of up and down. I would say this, the XK8, that's a really good move in my opinion. It's the X-Type from that same era. You wanted to stay away from those things. Those things were not so good. But yeah, Jaguars are kind of up and down. I mean, really, they're in a different place now as a car company too. They're really getting into electrification, and their interiors are much better. And they're a little bit more reliable than perhaps their history and their reputation would lead you to believe at this point.
Look, if you want luxury with a bench seat, I got a Studebaker Cruiser. That was the luxury top of the line back in 1964. I can get you hooked up for $1,000. Greg Migliore from Autoblog, thank you so much for joining us.
Thank you.
Coming up, it's ride sharing for surfboards. Quiver CEO on how surfers are making extra cash in the booming surfing industry.
You've heard about the sharing economy for cars, you've heard about it for homes, but now there's a company that's using that same exact concept
for surfboard. So for that, we want to bring in Joe Wilson. He's the CEO of Quiver. And Joe, it's great to have you on the show. Let's just start with, how does it work? Because is it similar to what maybe me and a lot of our viewers think of when we go to rent a house on Airbnb, but instead of a house, it's just a surfboard?
Thanks, Tiana. Thanks so much for having me today. That's right. Quiver is a two-sided marketplace connecting surfers with surfboards on demand. Think Airbnb, but for surfboard rentals anywhere in the world.
I'm curious, how much does a surfboard cost, and why would someone want to do this as opposed to just get their own board?
We see different prices based on the owners of the boards, and that can range anywhere from $20 a day to up to $60 a day, depending on the condition and the type of the board in the area that it's going to be served.
Hey, Joe, you've been around for a couple of years. I think your company started 5 or 6 years ago. How has it evolved over those years, just in terms of how consumers' preferences has changed, and also just, I guess, how you've identified new areas of opportunity?
Yeah, absolutely. So what started actually as an experiment in California and New York has now grown into a community of surfers board sharing in 20 countries. So we've seen a lot of growth in different markets and where people are connecting and sharing boards. And it's really a special thing to be able to help that connection and see people meeting each other in different parts of the world.
Well, where are the biggest markets? Is it Australia? Is it California? I doubt it's Manhattan.
Yeah, the US and Australia are by far our biggest markets. We focus mostly on those two markets, but we have seen board sharing growing in other unique destinations as well.
Joe, what about COVID? Because I think a lot of players here in the sharing economy have taken a hit to their business. People are a little bit more hesitant to rent something from somebody else. They want to keep their distance. Have you seen any evidence of that?
Sure. Yeah, that's a great question. And actually, surfing is up across the board. Surfboards are flying off the shelves. People have more flexibility now with remote work, and they're using that opportunity to get back out in the water, disconnect from everything else. And surfing is a socially distanced sport, and it's also a sport that's not expensive. So we're seeing, especially here in the US, we're seeing a ton of surfboard rentals and a big increase in business.
So as somebody who's never surfed, I'm curious, the investment that someone who does surf makes in a board, is it $1,000? Is it $5,000? And what do you look for in a board? I would imagine they're different kinds of quality. Are they made of wood? Are they made of fiberglass? Tell us all about that.
Absolutely. There are so many different types of board constructions, different dimensions from the length to the width, the thickness, the fin setups. There are so many different types of boards that one thing about Quiver that's great is it allows surfers to experiment and test out different types of boards. Typically, you're looking to invest maybe $600 to $1,000 on a new board, depending what type of surfboard and what brand, etc. But with Quiver, it gives you the opportunity to really test out different boards before you invest into buying a board, to find out what you really like and what really works for you.
So has the majority then of your users been people who are trying it out for the first time because they don't want to invest in a board right off the bat?
We actually get a great mix of different surfers. So we get surfers, experienced veteran surfers who are traveling that don't want to travel with their boards and pay the excessive oversized baggage fees, which a lot of the airlines are charging. And we also get the newer surfer who's experimenting with different types of boards, but we're trying to give opportunities to all different types of surfers so they can all try different types of boards and experiment with different types of boards, regardless of how long you've been surfing and your experience level.
All right, Joe Wilson, great to have you on the show, CEO of Quiver. Certainly we'll check in with you in a little bit. All the best to you and your team.
Thank you so much for having me.
Coming up, legendary musician Chuck Leavell on the new documentary about his life, The Tree Man, and also what's next for the music business and live touring after we get past the pandemic. We're back with that in just 2 minutes. We want to invite into the stream right now Chuck Lavelle, the famous keyboardist and musical director with the Allman Brothers Band. There's so much to talk about, but you've got a new documentary out, and it's called The Tree Man. There are many elements of this. It talks about your relationship with your wife, your work with environmentalists, but also with the band and some of the music. So want to talk with you about all of this. Let's talk about the song Jessica, because I mentioned I watched a clip of the documentary, and part of the inspiration that they talk about for that song was a little girl jumping around. Can you tell us more about that?
Yes, absolutely. And wonderful to be with you. Thanks for inviting me on this evening. So, yeah, the story is the song was written by the great guitarist Dickie Betts. And I had joined the Allman Brothers Band, and Dickie had a little daughter at the time named Jessica. She was about 2 years old, a toddler, and he had been listening to Django Reinhardt. And for any of your viewers that may know who that was, he was a famous gypsy guitarist, and he had a very bouncy style of rhythm guitar. And so Dickie was listening to Django, watching his daughter at play, and he came up with this intro for the song on acoustic guitar that kind of put those elements together. And then later the melody came and he presented it to the band and we took it from there.
Chuck, you've been in the music industry for quite some time and it's really evolved over the last couple of decades. When you look back at your time with the Allman Brothers and then when you were with the Rolling Stones to what we're seeing right now, how has it evolved and changed over all those years?
Well, it's probably not the first time you've heard this, but once Napster came around and file sharing and then eventually downloading and streaming, that severely cut into the revenue streams of recorded music. Genie's out of the bottle, so it's not going to get back in, and this is the world that we live in now. So therefore, the revenue streams are focused more on the live music, and of course, as we know with COVID, that's been shut down for a time. Other revenue streams that songwriters and artists look to are things like getting your songs in TV shows or in movies, merchandise, if you're a pretty big name like the Rolling Stones, that Red Tongue does pretty well. But the recorded music, I forget the exact number, but I think for any given stream of one song, the figure is something like 0.0002 cents per stream. So as you can imagine, that's really not all that great.
It's kind of like advertising on the stream. It's like you get $1 if you're lucky per 1,000. But let me ask you this. Is this correct? You're self-taught, not only piano, keyboards, but also guitar?
Yes, I don't play guitar so much these days. I wound up working with these fantastic guitar players like Eric Clapton and David Gilmour and Keith Richards and Ronnie Wood. But keyboard is the main thing now. And I am self-taught. I learned from my mom when I was very young. She was not a professional or a teacher, but she played for family enjoyment. I was the baby of the family and used to tug on her skirt and ask her to play for me. And that's what got me started.
And Chuck, there's something that some viewers might not know about you. In addition to all of your accomplishments as a musician, you're also a decorated environmentalist, and that's behind the reason why this documentary, this film is called The Tree Man. Where did that interest start? How has that evolved? What are you doing now to further that interest?
Well, it's all my wife's fault. Rose Lane and I have been together now some 47 years. But the fact is that her family have been connected to the land for generations as farmers, tending livestock, tending forest land, and just being general good stewards of the land. And so in 1981, she inherited some land from her grandmother, and this responsibility fell on our shoulders. And I took it very seriously and investigated a lot of possibilities for land use. But there was an immediate connection for me with forestry. And that is, where does this marvelous instrument that has given me so much joy and a great career come from? And where does most musical instruments, the resource, come from? And that's the resource of wood. So I took it seriously. I did some studying. I went to the library, checked out books, eventually enrolled in a correspondence course when I was touring with a little Texas band called the Fabulous Thunderbirds. Took about a year to get through that course, and I began to better understand what sustainable forest management is, and that's what we've been doing all these years now.
You're in Georgia. Your farm is in Georgia, correct? That's right in the middle of the state.
I am curious. You can see that the documentary was originally in films, but now it's on your website. Tell everybody your website, but then it's also coming video on demand through different platforms, right?
Yes, it's actually still making the theater run right now, and that will go through the end of this month, through the end of November. And then it will go to video on demand. We are hopeful that it will be available as of December 1. And you should see it on those platforms. But right now, you can see it through the virtual theater offerings at www.chucklavellthetreeman.com. And let me just, if I may, we were talking about the title of the film. And at first, when my partner and filmmaker Alan Forrest brought this theoretical title to me, The Tree Man, I thought, I don't know, man, I'm more known as a musician, but I sat on it a while and I thought to myself, that's actually pretty cool because it's kind of like going in the back door. You don't make it so obvious concerning the musical career. And so I like that title and I'm glad we stuck with it.
Under the radar a little bit. Chuck, I'd love to get your thoughts just on COVID's impact on the music industry. And we've seen this rise of virtual shows and artists are opting to do that in order to make some money because like you're saying, when we're streaming songs, artists just simply are not making nearly what they were 10, 15, 20 years ago. To what extent are these virtual shows able to replace some of the lost revenue from touring?
Well, it's a fraction of it. But here's the thing. What else do? You have to do something. And so I admire these artists that are beginning to better understand these platforms and how to use them. And I think this is going to go on for a while. I mean, I'm so glad, as we all are, to hear about the great news about these vaccines. But as we know, it's going to take time to get these things distributed and to get people immunized. And are we really going to be ready for big arena shows, big sports events and stadium shows in the next 8-10 months? I don't know. I kind of have my doubts about that. So I think we're going to be with this platform for a little bit longer. And I think, interestingly, that it will mature and we'll find some ways to improve it.
Who are you listening to right now? Is anyone catching your ear that you want to share with us?
Oh, man, I'm all over the map. I love listening to great jazz. Some of my favorite players are Keith Jarrett, Chick Corea, Herbie Hancock. I like to dive into the older stuff as well with Coltrane and Miles Davis. But I'll put on the classic rock and roll every now and then and dance around and reminisce about some of the work that I've been privileged to do and some that folks that I've known have put out through the years.
Chuck, right now, when we see what's going on across the nation, we're more divided than it seems like we have ever been, or more divided than we've been in quite some time. What role do you think music can play in bringing us together and trying to bridge that gap that we're looking at right now?
I think it's already played a role. And when you look at some of the songs that have been released, trying to heal some of the wounds that our country is feeling now, I think that's a good thing, whether the genre might be country or rock and roll or whatever it might be. I think music has always served as a healing vessel and that it can help bring people together. And I certainly hope that's going to be the case as we go forward. You're right. This is a pretty strange time for all of us. And I just hope and pray that as we go forward, some of this harshness will dissipate and we'll get back to being Americans, everyone.
When you talk about the harshness and then us getting back to being Americans, everyone, in the documentary, it talks about when Jimmy Carter came to one of your recording sessions. Do you stay in touch with President Carter?
Absolutely. As the film shows, back in the early 70s when he was governor, he came to one of our recording sessions, and that began a friendship. And then the Allman Brothers Band supported him financially doing benefits. And this was the early days of when you could get the matching federal funds. And so with the money we raised for him doing these benefits, the federal agencies had to match those funds and really helped his campaign. As he became president and we remained our friendship, we've spent time through the years. He's given me generously given me some quotes for some of the books that I've written. And, you know, he had his 96th birthday, October 1, and he's still doing great. And one of the most incredible people I've had the privilege of knowing.
Chuck, ahead of COVID, Rolling Stones was preparing for a 3-month tour that, of course, has been canceled because of the COVID pandemic. But any idea when Rolling Stones is returning to the road again?
Well, I think when it first hit, the hope was, let's see if it's possible same time next year. But as I said earlier, I'm just not sure the world is going to be ready for that. I don't know. Of course, it's really up to the principal members of the band and to the people that they work with in terms of arranging these concerts as to what they think may work. And that will be their decision. But from my personal point of view, I just have my doubts that by spring or maybe even early summer, people are going to feel comfortable going into 50,000 seat stadiums, all packed and ready to rock and roll. But we'll see. One of the things that has been going around in the media concerning the Rolling Stones, is certainly no secret, and everybody's kind of aware of it at this point, is that 2022 will mark the band's 60th anniversary. So that could be a great way to celebrate.
Yeah, and Shauna wants tickets. So do I. We got to say thank you so much, Chuck Leval. The documentary is The Tree Man. As we wrap up, want to let you know that the Federal Reserve has responded to Secretary Mnuchin, said they will return the Unused CARE Act money as we head into the last 15 seconds of the program. Everybody have a wonderful weekend. We're right back here on yahoofinance.com next week.